Hello, you traders. Welcome to the Confident Trader trading course. You are here to master your mind and dominate the markets. This is going to be a very in-depth, thorough experience where you will go from unconfident to completely confident in your ability to trade the markets. This is presented by Trader Sage, me, and also in correlation with Solara Trading Solutions. So first things first, thank you for investing into your education. Although this course is free, you are paying with your time, and I promise I will not waste your time. There are plenty of YouTube videos and trading courses out there that are out there to just essentially regurgitate old information and waste your time, and I aim to not do that. I provide you with 5 years of personal trading experience, over 10,000 hours of screen time, and 50 plus years of trading knowledge I've accumulated from mentors, books, and real life experience. This will transform the way you think as a trader. Before you begin, the mindset for mastery, extremely important. How you approach this process will determine whether you just consume content or actually transform as a trader. We live in a very consumer-based society where people just consume. They consume and don't even know what they're consuming and wonder why they are not where they want to be in life. I don't want you here if you are not able to think long term. You will waste both of our times, and this is free, so really you're just wasting your time. Go find another strategy to hop to and another lying mentor to study from, because this isn't one of them. This isn't a get rich quick system. This isn't a flip your account in a weekend kind of course. That's not real trading, that's gambling. What I'm teaching you is real high-level trading. Real trading requires you to step into the uncertainty and embrace the probabilities. This course is teaching you how to think, not what to think. How to think, not what to think. Okay? There's a really big difference between those things. Really big difference. One is principles. The other is patterns. Patterns are the subsequent manifestation of principles. If there is a head and shoulders pattern, then it's because there is distribution taking place. If there is a strong rally, it is because there's a massive amount of accumulations happening on the asset. Your ability as a typo there, your ability to look at a chart and understand the narrative taking place is what will create deep confidence in your trading. This isn't for you if you want a get rich quick scheme. I already said that, but I really need to emphasize that because the trading space is completely filled with that type of ideology. No, that's not what you're here for. If you refuse to journal and backtest or reflect, goodbye. If you blame the market instead of taking ownership over your own trades, goodbye. If you're just here looking for the next secret indicator, goodbye. See ya. Hasta luego. If you aren't willing to unlearn bad habits, goodbye. This program requires effort, discipline, and honesty. Honesty. You need to be honest with yourself. Okay? If you've been trading for a while, you're not getting results, you need to be honest with yourself and stop being in denial about this. You need to accept that this is harder than you thought it would be, and it is. There's a reason why 90% of people fail, right? Okay. If you're not ready to work on your mindset, this isn't for you. Point blank period. Okay. This is for you if you have a strong hunger to be a better trader, but you're stuck repeating the same emotional mistakes, the same ones over and over again. And we know what that is. That's called insanity. Thanks to Einstein. No strategy isn't your main problem, but psychology and execution is. You've come to this conclusion that you understand that psychology and execution is actually what your problem is. This is for you if you want to build unshakable confidence and discipline in yourself. Unshakable confidence and discipline. This is for you if you're tired of quitting during drawdowns. This is for you if you are ready to treat trading like a profession and not a gamble. You don't need more tactics. You need a psychological upgrade. With that being said, this is primarily a psychological course, but we will definitely talk about my strategies and how I approach the market. But know that I will talk about all of the most important things first. Okay? I need to emphasize that psychology is the basis for everything else. If we are building a house, the foundation is psychology, and then all the other things go on top of all those strategies and tactics and everything else, indicators, blah, 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 blah. All of that goes on top of what we're building here. But if you do not have a great psychology and great understanding for the financial markets and how they work and how they operate, you're just you're just going to get more of the same. You're just going to consume this and then, okay, well, that wasn't really helpful. On to the next thing. Okay, well, then at what point is something going to be helpful? Like, be serious with yourself. At what point is something going to be helpful? Because if everything online is kind of just saying the same regurgitated stuff and things all over again, and here I am bringing you something a little bit different, a little bit more in depth, a little bit more thorough, a little bit more open-minded, if you will. You have to understand that at some point it will never be enough, and you're just going to continue going in the same cycles over and over and over again, wasting your time. Like, seriously, if you're going to waste your time, just go get a job, because that's what you're going to be going. That's the direction that you're headed for if you don't take this trading stuff seriously. Like, it's not easy at all whatsoever, but it is possible to change your life with it. So you are building a skill set, not chasing a signal. Most people underestimate what it takes to become a consistently profitable trader. This isn't about memorizing patterns. It's about building market intuition through reps, backtesting, and mind mastery. This is a skill you can carry with you for your life, but it will take time and effort and commitment to master it. Just like everything in life, just like every single thing in life, it takes time, effort, and consistency, commitment and consistency to master it. A lot of times people come into the trading industry and they think that they're going to be the one to solve the market. Like, they're going to be the one to just come up to the market and just extract all of the money from the market. Okay, right. Be for real. Think long term, act daily. I've been trading for 5+ years. I've developed intuition, timing, and discipline, not from hacks or shortcuts. Believe me, I tried them. Believe me. Oh my God, have I taken all of the trading courses that you can think of. There are no shortcuts, my friend. The only shortcut in life is if you are born into a rich family. There's your shortcut. If you're not, well, you better get to work. So thousands of hours in the market. I've trained my psychology. I've learned the emotional game. I can't transfer any of this directly to you, but here's what I can promise. By the end of this course, you will fully understand what it takes to be a confident trader. Your discipline will be locked in. Your entries will be the most sniper they've ever been. You'll walk away from this course a completely different trader, one who has clarity, control, and most importantly, an edge. Most importantly, an edge in the markets. So you're going to shift from focused on the money, focus on the Lamborghini, focus on the girls and all the parties in Miami, blah, 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 blah. Yeah, all that stuff, all the stuff that the influencers lure you into so you can buy their course, to focus on the process. And if you focus on the process, the subsequent manifestation of focusing on the process will be money. Will be money. That's what I'm trying to get at here. Everyone is focused, chasing the money. The main reason that all of us get into trading is because of the money. I didn't know what type of journey was ahead of me as I embarked on this journey in the markets. I seriously did. I did it because everyone else, right? We just joined because we wanted to try to make money. We wanted to change our lives. What I didn't know ahead of me was going to be an extremely painful experience, and one where I had to really look at myself. I mean, really look at myself at the most deepest and fundamental level. Stuff that I had to process. Like, guys, trading is no joke. And if you really, really want to change your life, you have to change the type of person that you are. And changing the type of person that you are is going to be one of the hardest things that you could ever do in life. Why? Because we are creatures of habits. Human beings are creatures of habits. Changing who you are is like changing your identity. And your identity is something called an ego death, right? And an ego death is when you completely dissolve into something that is a higher experience. The crazy thing about an ego death is that you realize that you never actually die. You never actually die. And that's what becoming a profitable trader is that there's a part of you that is a completely unprofitable trader, and it wants to control all of these variables and experiences so bad that it completely self-sabotage any effort that you make to become a better trader. Why? Because it's afraid of dying. You have to get over that fear. You have to let go of that idea that this will be the end of you, because it won't. It will not. You will transform like a phoenix. This is a transformation. Okay, this is not a death. This is a transformation. And it might feel like death to the aspect of you that doesn't want to change. And in some ways it might be, right? Because you can no longer be that person. But I didn't die to become the person that I am now. I just transformed. Death is an illusion. Transformation is the ultimate truth. I know you probably weren't expecting to get a philosophy lesson here, but yeah, here we are. So back to it. Rushing leads to overtrading. Overtrading leads to blowing up accounts. Patience, discipline, and process are your edge more than any strategy. Trust the data, trust the system, and most importantly, trust your ability to grow. Please trust your ability to grow. I believe in you. I don't want you to try to get rich. I want you to try to get free. Free from fear, free from greed, free from emotions, free from doubt, free from strategy hopping, free from self-sabotage, free from overtrading, free from blown accounts, free from a losing mindset, free from all of that nonsense. Okay? Maybe you were born into a poor family, and maybe you were not dealt the greatest hand in life. Maybe you have a disability. Maybe you have so many of these different factors that prevent you from being as successful as other people. Okay, now that we've established that those are the cards that you were dealt in life, now what? It's time for you to take responsibility of your life, because you have the ability to change your life. If I can instill anything into you right here, right now, before we go super deep into this course, is that you have the ability to change your life. You do. It's within your hands. It's within your grasp. Okay? So that's what this course is about. Aligning the thought patterns in your subconscious mind with those of a consistently profitable trader. Are you ready? Are you ready? Yes, you are. Lock in. Let's go. This is the syllabus. These are all the topics that we'll be talking about. If you want to take a screenshot or something like that, there you go. But this is everything that we'll be talking about in great depth. With that being said, module 1. why most traders stay unprofitable and how we'll change that. Let's begin. So before we begin with module 1, I forgot to talk about why I'm even giving this course for free, because I surely could have charged for this course like most of the influencers do, right? Well, if you haven't already gained greater detail into the type of person that I am, I'm someone who deeply cares about humanity. And if you accumulate knowledge and you're not able to pass it on to other people in life, then you've essentially wasted your life. To me, one of the greatest gifts and aspect of life is your ability to pass on knowledge and pass the baton to more people so that they can become successful traders. Now, I don't act like I know what will happen from me creating this course, how this will impact people, how this will change people's lives, how it will influence them. I don't know that. I don't know how many people it will reach. I don't know how many people, how many lives it will change. But I do have an intuitive thought deep within inside of me that at least one person will see this course and it will completely change their life and completely change the trajectory of their trading in ways that I can't even fathom. And for me, that's worth it. There's just so much you can do when you charge for things that automatically puts up a barrier. I'm not against charging for things. Don't get me wrong. Like, you should certainly charge for the value that you give, right? But I don't want to be another course seller. I just don't. I've taken so many courses. I've consumed so much education that I can firmly say with my entire being that my free course is better than 99% of all these other influencers' paid course. I can say that wholeheartedly, that this trading course will be one of the best courses that you'll ever get, especially when it comes to psychology. This isn't going to be a course where let's set up our account, let's fund the account. Like, no, we're going to get into the deep shit. We're going to get into the stuff that people don't ever really talk about, the most important stuff. I promise you, very rarely do you see people talk about this type of stuff. This is high level stuff. Why do people not really talk about the stuff that I'm about to get into in this course? It's because it's not sexy. It's not sexy. And they just want to sell you the dream. That's why most people just come here. They see the little green icons. Look, buy. Look how much money I'm making. Blah, blah, blah. Right. That's the sexy stuff. That's what people get pulled to because people are in pain. People are in pain and they want to change their life and they think trading is the way to change their life. Well, guess what? It might be. Trading might be that way to change your life, but it sure as hell ain't going to be as easy as you thought it would be. And I'm telling you that right now, straight up, it's not going to be as easy as you thought it would be. But that's okay. Because there's a lot of things in life that you thought were going to be really hard, that you thought it was going to be really easy, and it turned out to be extremely difficult. But those things actually usually are the most powerful things in your life. There's a reason why people like to play Elden Ring. And if you don't know what Elden Ring is, it's a really hard game. Elden Ring is like one of the hardest games that you could ever play, and yet people love it. It's one of the best-selling games ever. Why? Because people love things that are challenging and difficult. And trading is that thing that is challenging and difficult. It yields such high expected value, but so many people fail. Why? It's because think about the path that the average retail trader goes through. Oh, I want to learn how to trade. Okay, what do? Let's hop on YouTube. Abundance of courses on YouTube, abundance of education on YouTube, abundance of influencers trying to get your money on YouTube. So if everyone's teaching the same thing and 90% of people are failing, then probably you should probably study something different. You should probably find someone who's saying something just a little bit different, and see how that works out for you. Okay. Rant is over. Let's get going. All right. So back to it. Module 1, why most traders stay unprofitable and how we'll change that. So what is our objective here? Objective: help you clearly see why your current approach to trading hasn't worked. And it's not because you lack intelligence or effort, but because you've never been taught how this trading game actually works. This module will show you why mindset is the foundation of everything that follows, and why without it, no strategy will stick. We'll expose the gap between where you are now and where this course will take you, and give you the clarity, confidence, and structure to finally close that gap for good. So let's be honest, most traders are losing. Firstly, the facts. The numbers are brutal. Over 90% of retail traders fail to stay profitable. And it's not because they're not smart enough. Okay, there's a lot of people who have a lot of money who, I assure you, are not as intelligent as you. Okay, so we know it's not because they're not smart enough, not because they don't have access to information, but because they don't know how to think and act and execute like a real trader. Most traders lose money, not just for a few months, for years. Some blow accounts, others just bleed out slowly over time, but almost all of them fall into the same trap. They believe the problem is out there. Maybe I just need to add this new indicator. Maybe I just need to watch more trading psychology YouTube videos. Maybe I just haven't found the right mentor yet. And in some cases, that might be actually what you need, a better mentor. But none of that fixes the real issue, because the real issue is how they think, how they interpret losses, and how they respond to uncertainty, how they define progress, and how they manage discomfort. If your mindset isn't built for trading, then every small loss will feel like a threat. Every period of drawdown will feel like failure, and every system you try will get abandoned the moment it makes you uncomfortable. All right, so let's get into the long list of why traders stay unprofitable. Number one, they have no edge, plain and simple. They think they have edge, they don't. They pull up to the market, they make a little money, they think they're freaking Hercules or something. They think they're a market wizard. Look, I made some money. Look guys. And it's gone. You know that South Park meme? And it's gone. So they have no edge. They don't even know what an edge is. They overtrade, they get emotional about the money they're trading with, they have no discipline, heavy on the discipline. They don't know how to adapt to different market conditions. They don't understand the phases of market moves. They chase price and miss clean setups. They quit after a few losses. They constantly second guess their plan, if they even have one to begin with, and most of them don't. They switch strategies too often. They rely on indicators too much. They look for certainty in an uncertain game. They don't manage risk properly. They let losers run and cut winners short. They trade emotionally and not systematically. They lack a repeatable process. They don't track or learn from their mistakes. They don't understand variance or drawdown. They focus on being right instead of being consistent. They overanalyze, and analyzing doesn't make money. My God. Oh, I'm going to drill that into your head so hard, because there are so many people who sit there all damn day looking at the charts as if more analyzing is what they need, as if more analyzing is going to be the secret. It's just suddenly gonna I remember thinking that myself, like, you're just gonna wake up one day and then the market is just gonna look completely different and it's just gonna click. Brother, no. It just doesn't work like that. What happens is, yes, you get your chart hours in, you spend a lot of time, understanding things, but you can get that in like a month. Like, I'm not even joking. Like, the amount of wasted time that I spent just looking at the charts as if suddenly I'm gonna see something that I didn't see before. Like, no, it just doesn't work like that. I'm sorry. If you think it's gonna work like that, let me just stop you right there. It's not. You're not just gonna wake up one day and it's just gonna look different. What's gonna happen is you're gonna have a psychological upgrade, and you're gonna see that the way that you were interpreting the market was actually wrong. So they think that trading a certain time frame will make them profitable. The amount of people that be in my DMs that be in my comments asking me what time frame do I trade in, and believe me, I'm not trying to belittle the retail traders, because everyone got to start somewhere. Okay, I used to think like that too. I used to think that a certain time frame will make you profitable. No, it will not. Okay, a certain time frame will not make you profitable. What happens is that each time frame is data, and the higher the time frame, the more powerful the signal, but the slower the signal. Okay, so if you take what I just said and think that you're gonna be trading the monthly charts, okay, good luck. Because the monthly is one of the strongest signals, because it is 30 days of data in one candle. Think about how much information is in that candle. Okay, now go trade it. Right, you can't, because it's too high of a time frame to take action on, unless you're a banker or something, I guess. Anyways, they don't understand that win rate, RR, and average return are all intrinsically connected. They can't develop the mindset of a winning trader. They don't have enough reps in, only forward testing, but never back testing. And I know there's certain influencers that are telling you, oh, don't back test. Why would you back test? Oh my God. Oh my God. I'm about to put my foot so far up your asses. Go back test. Go back test. Go, especially if you're not profitable. Back test, back test, back test. If NBA players train, why would you think that you can just not train? Like, it doesn't make sense. Like, I think that's one of the most awful things that I've heard an influencer say is, oh, don't back test, because why would you back? What? Huh? Okay, sorry, I just get emotional about this stuff, because I really was not as consistent and as profitable as I could be until I sat my ass down and I started back testing. And I mean, I really back tested. I mean, it took me months of back testing, of grinding, but I got so many reps in, and that was the beginning of when I started to be confident in my trading. That was the very beginning of when I started to like actually believe in myself, is when I started back testing. And I really don't even want to call it back testing. I just want to call it training. Like, go train. Like, we need to get rid of the word back testing, because it has a negative connotation in the trading society, in the mind. Like, go train. When I say go train, it sounds different, doesn't it? Like, if you're a boxer and I say, hey, go train so you can get better, you're like, of course, why wouldn't I go train? Duh. Yeah, trading is a sport and you need to go train. All right. Sorry, I get emotional. They don't know that a swing trader's mindset has to be different than a scalper's. And if you tread the line between both, you risk compromising the other's mindset. And this is something that you really need to consider. Like, I'm not saying that you can't do both, but I'm saying it's really hard to think like a scalper and like a swing trader at the same time. Because as a scalper, you need to be in and out, and as a swing trader, you need to be sitting through whatever swings of the market that happens, whether it goes up and it pulls back, and then it goes up and then it pulls back. Like, you need to have a completely different mindset than a scalper. All right, and they FOMO at the tops, they panic sell bottoms. That's, man, isn't that what most retail traders do? Like, FOMO straight into the top and then panic sell the bottom because it's dumping and they're losing money, when it's literally the opposite of what you need to be doing. And most importantly, they don't know how to think in probabilities. That is really the main thing, is being able to think in probabilities. And when I say that we're going to blow your mind with this upgrade, let's get into it, man. So let's make something very clear. It's not your fault. Nobody teaches this part. All the influencers just show you the cars, the lifestyle. Everyone skips over the hard work. But now that you're here, we're going to confront the elephant in the room. Okay, I've already said, hey, this is not your fault. You got enticed into this world. You followed the woman in the red dress and you got rugged. Okay, It happens. Take the L, but let's recalibrate. Stick with this course all the way through. Like I said, I will not waste your time. Let me say this clearly. Your mindset is either your biggest asset or your worst enemy. If you don't build the discipline, patience, and process focused thinking needed to trade consistently, it doesn't matter how good your strategy is. It doesn't matter. You'll find a way to sabotage yourself. I promise you. I promise you. Like, you can find some of the best traders in the world and they can teach you their strategy. But if you do not have their psychology, you will fail. Period. Trading isn't hard because the market is complex. It's hard because your brain isn't wired to handle uncertainty, risk, and randomness. The human brain is built to avoid pain, seek certainty, control outcomes, protect identity and ego. That's what your brain is there to do. That is exactly what your brain is built to do. It's there to avoid pain, seek certainty, control outcomes, protect your identity. I've already said in the very beginning, your identity is why you're failing. So your brain is why you're failing. Oh man, look, come on. Y'all don't feel me. But okay, drop the comments. Drop the comments in the YouTube section. We getting into it. So that means you cut winners short to avoid seeing them reverse. You let losers run to avoid admitting you're wrong. You overtrade to feel in control. And I had to put that in bold and underline because that is a massive thing that I see with the traders that I work with. They just want to feel in control. They revenge trade to feel in control. Listen, you are not in control of the markets, okay? And you need to accept that. You are in denial about what's happening here. You are not in control, okay? You need money from the markets. The markets don't need money from you. That's a bar. Write that down. You need money from the markets. The markets don't need money from you. You are not in control here. Okay? So stop revenge trading. Because every time you try to revenge trade, you're just trying to seek emotional equilibrium. That's all you're trying to do. You're just trying to get back to where you feel emotionally comfortable. That's not a logical decision. That's an emotional one. Let it go. You avoid taking trades because it might be the one that fails. And that's just an inability to think in probabilities. To become profitable, you don't just need a new strategy. You need to reprogram your relationship to uncertainty, loss, and self-worth. You have to. The consistency you seek is in your mind, not in the markets. Thank you to the legendary Mark Douglas, my GOAT, my mentor. Completely changed everything for me and for a lot of traders. And I'm hoping to follow in his path and do the same for everyone else. The consistency you seek is in your mind, not in the markets. Write that down. So this is why we don't start with entries, exits. We start by fixing the foundation, because if we don't, you won't follow the plan. You'll quit when variance kicks in. You'll stay stuck in analysis and hesitation. You'll continue looking for certainty that doesn't exist. There is no certainty in the markets. Let me get that into your brain and drive it deep into your subconscious mind. Okay, listen up. Certainty in these markets doesn't exist. You will never know what's going to happen next. It's literally impossible. Literally impossible. Stop looking for certainty in this uncertain game and start understanding that uncertainty is the edge, because nobody knows what's going to happen next. We'll talk about that more later. So let's walk through the symptoms most traders face. You're constantly analyzing and never pulling the trigger. And let me say, I've done this a lot in my life. Like I would see my setup plain as day. I'm like, oh, that looks like a good setup. I should take it. And then I don't. Then I don't. Why didn't I take the trade? Is because of fear. It's because of fear. That's the only reason why you would not take a trade that you see right in front of you that looks good. It looks good. That trade looking good, and you won't take it. You enter too late and exit too early. You size up emotionally and blow up gains. You flip between systems because you don't trust any of them. You feel guilt after losses, shame after wins. That should have been more. Oh man, the greed that we feel when we win. Like, damn, I should have made more there. Like, I wanted to make more there. Okay, you're greedy. You're greedy. Look, how greedy. I probably don't know that meme. How greedy. Listen, you're greedy, and it's okay. It's all right. Just reflect on it, okay? Have you hesitated on trades only to watch them hit your target without you? Have you taken a loss, then revenge traded and made it worse? Do you keep switching systems, hoping the next one will be the magic bullet? The magic bullet. Get a load of this guy. Are you afraid to size up because you don't trust yourself yet? Do I have your attention? Are we getting? Yeah. Okay. This is what most traders go through, but it's not where you have to stay. What you're experiencing isn't failure, it's feedback. It's showing you exactly what needs to change. And that's what this course is here to do. By the end of this course, you'll be thinking in probabilities, not outcomes. Managing trades based on logic, not emotion. Trusting your system because you've tested and proven it. Calm during drawdowns. Calm during drawdowns. Not panicking, calm. Clear during decision points and consistent across time. This transformation isn't hypothetical. It's what happens when you shift your mindset, follow a process, and commit to the work. If you don't believe you deserve to be successful, you will sabotage your results. Another quote by Mark Douglas, and that's facts. That is straight facts. If you don't believe you deserve to be successful, you will sabotage your results. That's self-worth right there. Go to therapy. This course is the bridge between who you are now and the version of you that trades like a professional. End. All right. That was the end of module 1. We're going to get into module 2 in the next one. All right. Now we're back. We're getting into module 2, foundations of profitable trading. Objective. This module will lay the groundwork for your trading success by showing you the key factors that make a trader consistently profitable. It's not about finding the holy grail of strategies. It's about maintaining the right mindset, following a clear process, and tracking performance to stay on course. Now, emphasis on no holy grail, because it's not a thing. That's not a thing. I'm sorry to say, like, if you think there's a holy grail in trading, the holy grail is your trading psychology and your edge and your ability to follow your plan. Here's what a truly profitable trader maintains: an edge with positive expectancy, a system that fits their psychology and lifestyle, confidence from data, not hope, risk controls that keep them in the game. Risk controls that keep them in the game. If you lose your money, if you blow up, you cannot play the game anymore. Well, you can play the game, but you have to reload your credits, right? You got to reload your currency. So don't blow up, guys. Just don't. Consistency. Same action, same rules every time. Expected value. Let's talk about this. Let's talk about how to think in expected value, EV. Expected value is the backbone of every consistently profitable trader's process. It tells you what the average outcome of your trading behavior will be, not just on one trade, but across a series. It should say a series of trades. And this is how casinos make money. They know that they have a systematic edge over a series of trades, not just one trade, a series of trade. The problem is retail traders always focus on just one trade, because they have this freaking idea that they're just going to hit this one trade that changes everything. Now, here's the thing. In anything that you do, whether it's basketball or whether you're a poker player or like whatever that you do, there's going to be people who get these once in a lifetime opportunities. The lottery tickets, they're just lottery tickets, and the lottery tickets always go viral because they instill hope in other people that you too will eventually get the lottery ticket. Okay, well, here's the thing about the lottery is it's called a lottery for a reason. That's because your odds of it happening are extremely low. That's why it's called the lottery, because surprise, you won something that is extremely low probability. So you're better off trying to find something that you can be consistent at instead of trying to get the winning lottery ticket. So here's the basic formula. EV equals reward times win rate. You can also substitute win rate as probability of success minus risk times loss rate. So you don't necessarily need to memorize this. We're going to go over the numbers down below, but just keep in mind expected value. Okay, so example, if your average win is 1.5 R and your win rate is 60%, then EV equals 1.5 times 0.6 minus 1 times 0.4 equals 0.9 minus 0.4 equals plus 0.5. Excuse me. Once again, you don't need to memorize the math, guys. Like, I know trading is a game of math, but you don't necessarily have to memorize that math. Okay, positive expectancy means that over a series of trades your system makes more than it loses. Here's the basic formula: win rate times average win minus loss rate times average loss equal positive number. You need that number to be positive in order to have a system with a positive expectancy. If you repeat that system consistently, you make money even if you lose often. A profitable system doesn't win all the time. It simply makes more when it wins than when it doesn't. And in the case of someone with a negative risk to reward, you don't actually have to make more than your losses. You just need to win more than you lose. Okay, so you can go the route of low probability or high probability. If you go high probability, you simply you simply need your wins to eat your losses, and sometimes your losses will be bigger than your wins. But if your win rate is high enough, it doesn't matter. So if you make $50, if your average win is $50 and your average loss is $100, as long as your probability of success is really high, keep shooting for that $50 and you'll eat the losses. Or contrary, you can go for the side where you're low probability, but your wins outweigh your losses. So you make $200 for every $100 that you risk, or you make $300 for every $100 that you risk, since retail traders love 3-to-1s. So that means over time you make half an R per trade on average. This is how you get profitable, by stacking small positive decisions. A good trade is one that aligns with your edge and maintains positive expected value regardless of the outcome. You don't control individual trades, but you can control the risk you take, the quality of your setup, and the consistency of your execution. This is basically what Mark Douglas was talking about, is that you don't control the individual trades. If you have an edge over a series of trades, you should have a positive expectancy. And the distribution of the wins and losses of your edge is random, but you won't see the positive expectancy of those trades if you take a sample size that's not large enough and then you just assume that it doesn't work. The law of large numbers needs to be on your side, meaning that you need to have enough data to support that edge that you have. So you need to hit your metrics. No system works unless you're executing it with discipline. Are you maintaining your expected win rate? Are your stop losses consistent? Are you placing trades that match your edge? You don't need to be perfect. Man, I love this because we spend so much time trying to be perfect and thinking that we're not supposed to lose. But that's just a part of the game. Like, you're gonna lose. That's the point. Like, you have to take risk, and then when you take a risk, you're gonna lose. But you don't need to be perfect, guys. You just need to be consistent with the inputs. Mindset and discipline. The foundation of profitable trading starts with a probabilistic mindset. Without a strong mental foundation, you will be unable to execute the strategy when the markets test your patience. We've already touched on the fact that most traders fail because they don't have the discipline to stick to their plan. They just don't. They don't. The thing is that if you're not disciplined with the way that you trade, is because you're not a disciplined person. And that's just straight facts, man. Like that, it is what it is. Like that's the hard pill to swallow. That's one I had to swallow myself. But like, it's true. If you have an issue with sticking to your plan, it's because you're not a disciplined person. So, process over outcome. Profitable traders focus on the process, not the individual wins or losses. Every trade is an isolated event. The goal is to follow your plan and trust that over time the system will work. This long-term view is the key to staying grounded. This is the key to staying grounded. Your trades are isolated, okay? You're not due for a winner if you keep losing, and you're not due for a loss if you keep winning. Each trade is an individual event and has nothing to do with the next trade. So keep shooting and stop self-sabotaging. A large part of profitable trading is ensuring that you're managing risk properly. That means not risking more than a small percentage of your account on any single trade. This will be crucial for your survival in the markets, especially during losing streaks. Like, I'm not here to tell you how much you should risk on your trade, but what I am here to tell you is that the more risk that you place on a trade, the more likely it is that you're going to blow up over time if that trade doesn't have a positive expected value. That's just facts. That's just facts. Like, you will blow up your account risking half of your account on a trade, thinking that that one trade is going to be the one. That's a lottery ticket. Win rate and risk to reward consistency. To remain consistently profitable, you need to measure and maintain your win rate and risk to reward ratio. You cannot have one without the other. This course will show you how to track these stats and ensure your trades are aligned with your edge. How to measure success. Win rate. While a high win rate isn't necessary for your profitability, it's important to track it to ensure your edge is intact. If your win rate consistently falls below your expected metrics, it's a sign that either your strategy needs refining or your mindset needs adjusting, because you cannot follow your plan or your edge, your strategy. So I know retail traders fall in love with this idea of a high probability, right? Because once again, if the probability is high, right, then you won't lose. It just still comes back down to you of trying to avoid taking a loss. That's the only reason why you want a high probability trading edge, is because you want to avoid losing. Now ask yourself why that is. Why do you want to avoid losing? Yeah. Risk to reward. A healthy RR ratio, whether it's 1-to-1 or 1-to-2, or even a negative R like 0.5-to-1, should be applied intentionally and align with your strategy's win rate. The key isn't forcing a high RR at the cost of consistency. It's understanding the math behind expectancy. We'll break down how both positive and negative RR setups can be profitable when paired with the right edge, and how to find the balance that works for your system. Balance is important. Drawdown management. Accept that drawdowns are part of the game. A profitable trader knows how to survive them. We'll look at strategies to help you stick to your plan and manage your risk during tough stretches. Now, I remember hearing I think it was Lance Brightstein talk about how there was one trader on the floor who was in a 6-month drawdown or something. Like, I don't even know, 6 months to a year. Like, it's crazy. Like, some people experience drawdowns for months and even years. Like, and you're ready to quit after you and drawdown for a month or a week or something. Like, there are profitable traders, consistently profitable traders, who are in drawdown for months. These are people who've had success. and yet you're ready to quit. Come on, guys. Drawdowns are part of the game. Like, you need to stay mentally tough and stick it out. According to Mark Douglas in Trading in the Zone, the largest group of consistent losers in trading is composed primarily of doctors, lawyers, engineers, scientists, CEOs, wealthy retirees, and entrepreneurs. And even some of the industry's best market analysts are among the worst traders. This proves that trading success is not about intelligence or analytical ability. It doesn't matter how smart you are. It doesn't matter what your intelligence is. It doesn't matter what your IQ is. It doesn't matter. The best traders think differently. They accept uncertainty. They follow processes, not opinions. They focus on execution, not prediction. Most traders believe that more analysis will eliminate the risk of losing, but Douglas explains that market analysis is not the path to consistent results. It will not solve trading problems created by a lack of confidence, lack of discipline, or improper focus. Remember, more analysis and information isn't the solution. You will never eliminate the risk of losing a trade. Never. You will never eliminate the risk of losing a trade. And that's what most retail traders think. They think that if I sit at the computer all day, I'll figure out how I'm gonna not lose any more trades. It's not gonna happen. Okay, trading is like flipping a coin. You're trying to control, like, imagine trying to control a coin flip. It's random. It's completely random. To be consistently profitable, you need to build a strategy with measurable edge, execute with discipline, track key metrics, your win rate, your RR, your drawdown, adapt based on data. Understand that consistency wins. It's not about the individual trades, but how the system works over time. Over time, guys. When all these elements align, your strategy, mindset, risk management, and performance tracking, you will naturally start seeing consistent profits over time. Naturally. It's easy to get distracted by the latest holy grail strategy or market fad. We all love to chase the trends, but true success in trading comes from patience and consistency. You don't need the perfect system. You need a system that works consistently over time. And more importantly, you need the patience to let it unfold. Stop trying to force these things to happen. Just let it unfold naturally. The market rewards consistency, not brilliance. The key takeaways here. Profitable trading is about long-term process, not short-term wins. Tracking and maintaining win rate and risk to reward metrics is critical to staying profitable. Risk management and mental discipline will keep you in the game long enough to see results. This is a journey, not a sprint. Stay consistent, stay patient, and your results will come. They will come. But only if you are disciplined and consistent. That is all for this module. I'll see you all in the next one. All right, let's get into it. Module 3, the psychology of money and trading. We're going to go real deep here, so I really need y'all's attention. Let's focus. Our objective here is to uncover and rewire your emotional relationship with money so you can detach from trade outcomes, stop sabotaging your results, and step into your role as a professional process-focused trader. Most traders think they have a strategy problem, but what they really have is a money psychology problem. And you know this is true because most traders spend all their time on YouTube strategy hopping, looking for the next best strategy, looking for a strategy that either has a very high R multiple or a high win rate, and ideally both, right? You fall for the trap of thinking, oh, I can have very high R multiple and very high win rate. I'm not saying that it's not possible. I'm just saying that it's unlikely. So let's get real. You're not just trading candlesticks. You're trading your beliefs about money. You bring your entire financial identity into every trade. Your entire financial identity into every trade. How you were raised around money, how much money you believe you're worth, your fears around losing money, your needs to protect profits, your attachment to numbers. The list can go on and on, but these are some of the main things that usually come up. That's why $100 can feel like a huge win to one trader and a rounding error to another trader. The amount isn't the problem. Your attachment to the amount is. And we all have some form of psychological attachment to money that is factual, but it doesn't have to be that way. Your subconscious mind has a set point, a mental clinging for what it feels safe or normal when it comes to money. If you've never made more than $3,000 a month, risking $1,000 on a trade might feel terrifying. If you grew up hearing money is hard to make, then every trade you make might feel like a threat. You associate success with pressure. You'll subconsciously avoid winning. Listen, I think that first statement is like really major. The retail traders love doing account flips. The crazy thing is that if you've never made 10 grand in a month and you flip your account from 1K to 10K and you're like, damn, I want more. I want to keep pushing it. Do you think that that's intelligent or smart? Because what you have just done is then associated the process of taking massive amounts of risk with small amounts of money and thinking that you can duplicate it again and again and again. We already talked about how you need to think in probabilities, and you can definitely put on a trade and it be a winning trade. You can risk $500 of that $1,000 account and continually compound it for sure if you get lucky, or if you have an edge with really good high probabilities, because that's what it's going to come down to, is probability. So I feel like the average trader gets stuck in this process of thinking that, okay, all I gotta do is just flip this account and flip it 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 and flip it. Are you gonna flip it for the rest of your life? Like, the way you're gonna move with $100,000 is not the same way you're gonna move with $1,000 account. And if you continue to think like a flipper when you have a massive amount of money, you're going to blow up. The game of trading is played in the 6 inches between your ears. The most common money blocks I see in traders are fear of size, fear of success, guilt after a win, sabotage before a big milestone, clinging to small profits out of scarcity. The infamous scarcity mindset that all of your gurus tell you that you have. And in some ways, they're right. We all do have some type of scarcity mindset when it comes to money, because you have to replicate how you got that money in the first place. And if the way that you got that money was through flipping your account, well, then good luck. Do any of these feel familiar? We're talking about money blocks now. You freeze up when increasing your lot size. You take profits too early when price gets close to your target. You stop trading once you're close to a payout because you're scared of losing it. So this is talking about prop firm accounts. You revenge trade after a loss to win it back. You feel undeserving after a win and give it all back the next day. You track dollar gains more than R multiples or setup quality. These are not just bad habits. They are deeply emotional patterns rooted in your identity around money. You cannot outperform your internal blueprint. I promise you, you cannot. That is your framework for life. If you don't believe you're someone who deserves to make 10K a month or trade a 6-figure account, you'll find ways to mess it up. This isn't just about discipline, it's about identity. And your identity is, once again, one of the hardest things to change about yourself. But once you remain free and that you have a identity that's able to transform, it's malleable, it's able to change its mind about things, it's able to think in probabilities, that's a strong identity, guys. So your fears will act against you in such a way that you will cause the very thing that you're afraid of to actually happen. And Mark Douglas talks about this a lot in his seminars and Trading in the Zone. The very thing that you're trying to avoid happening is what you're going to manifest into your life. Man, I'm telling you, I've been there, I've done that. You know, you are afraid of you're afraid of giving your money back to the market, so then you close the trade and you miss out on a major move. Or better yet, once the trade finally moves into your favor, you fear that it's going to pull back and take away all your money, so you close the trade. You're in drawdown and the market's about to hit your stop loss, and you're like, no, I know this trade is going to work, let me move my stop loss. And it goes down and it goes deeper, let me move my stop loss again, and it goes deeper and deeper and deeper, and then you blow up. If you're afraid of being wrong, your fear will act upon your perception of market information in a way that causes you to act in a way that makes you wrong. When you are fearful, no other possibilities exist. Fear is immobilizing. Physically, it causes us to freeze or run. Mentally, it causes us to narrow our focus to the object of our fear. Fear is immobilizing. It shuts your brain down. You are in fight or flight. You're in survival mode, and any other information that comes into your awareness is just going to be pushed to the wayside, just shoved to the side. So what I really want for you is to trade without fear, because once again, trading is like a coin flip. And once you integrate that and understand it in your mind, then it becomes less of a severe thing, less of a thing that's daunting, less of a thing that's debilitating, less of a thing that's immobilizing, where you freeze up. Like, you only freeze up because of fear, guys. And you should have zero fear when you're trading in the markets, no emotions at all, because it's not up to you what the market does. All you can control is where you enter, where you exit, where you take profit. The rest is up to the market. You have to surrender your control. And my God, is that hard for us to do? This narrow focus means that alternative perspectives and valuable data from the market are ignored. Fear makes you blind to the broader context and reactive to the immediate emotion. You don't have to know everything about yourself or the markets to put on a winning trade, but you do need to be aware of how fear alters your behavior in real time. All the things that I just said. So let's talk about our addiction to random rewards. This is major. I really need you guys to pay attention to this. This is one of the biggest psychological traps traders fall into. Studies show that when monkeys are rewarded consistently for a task, they learn quickly. Okay, let me repeat that. Studies show that when monkeys are rewarded consistently for a task, they learn quickly. But when the rewards are random, their behavior becomes erratic and addicted to the hope of a reward. Tell me that is not us when we're trading, guys. Tell me that is not humans. Tell me it's not. Humans are the same. We get addicted to the euphoria of an unexpected win. So we keep clicking buttons hoping for that hit of dopamine again. This overrides logic and risk management and strategy completely, because all you're focusing on is the hope of winning again, and you're not even paying attention to how you're trading and how you're about to blow up your account. This addiction is what businesses are built off of getting you addicted to things, of making you want to get that dopamine hit. It's not just trading. All of the major tech companies have algorithms built on this very principle of getting you addicted to social media, getting you addicted to pornography, getting you addicted to food. Man, it's so sad, honestly, when you reflect on it, like how all these corporations just exist to exploit your mind and to get you addicted to whatever product that they've created so that you can keep giving them money. It's fucked up. But that's how we live here. And I don't want that for you. When you expect a reward and don't get it, you feel disappointed. But when you get a reward randomly, your brain links trading with surprise, pleasure, and a cycle of addiction begins. That's why revenge trading happens. You mainly want to feel control. You know, that's what happened with revenge trading. Like, you're like, no, I want my money back. You risk more than your plan allows. You re-enter after a loss impulsively without reanalyzing the situation to understand if your trading idea is still valid. The result, a mental state of choicelessness. You are no longer trading with intention, but reacting in hope. And that's not trading. This addiction is the enemy of consistency. And I want consistency more than anything for you all. I want it more than anything for you all. It's consistency. And you can have consistency. I want you to be a consistent person. And when I say consistently, I want you to divorce in your mind the idea of consistent profits. That's not what I'm talking about. I'm talking about consistent behavior. Because you cannot control what happens after you click that button. So why would I want you to be consistent in the way that in your interpretation of you trying to extract money from the markets? That's not what I want. I want you to be consistent in your approach, consistent in your behavior, consistent in your methodology, consistent in your strategy. No more strategy hopping. I want you to be consistent with your emotions. No more emotional swings. No more getting frustrated and blowing up. No more over leveraging your account. No more reloading your account after you blow it up. No more being fearful when you're making money, when you're literally floating in profits. No, I don't want that for you. I want consistency for you. Let's think about addiction in itself. Wikipedia's definition of addiction is a neuropsychological disorder characterized by a persistent and intense urge to use a drug or engage in a behavior that produces natural reward despite substantial harm and other negative consequences. This is a neuropsychological disorder, guys. Like, this is a disease. Like, you have a disease of the mind, and it's unchecked, and it's reinforced by corporations and greed. And it makes me fucking sick. It makes me fucking sick. Okay? You can trade these markets with the edge. You can 100% make money in these markets. But what I don't want is for you to become addicted to this process, because that's when you lose the battle. That's when you lose the battle and they win, and they constantly extract money from you, constantly. That's what trading has been lately. It's been an auction. It's been max extraction. That's what's happening in the meme coin world. 99% of them fail. Occasionally some of them run, but most of them fail. Most of them go to fucking zero. It's max extraction all day long. They have farms farming people. Why? Because you're addicted to the idea of hitting it big, of changing your life. It's depressing, but I don't want that depression. I don't want that for you. I want you to snap out of it and step into reality. This is not a game where the outcome is fixed, you know, like you just beat the game. And then I get so emotional about this because I care so deeply about humanity and you guys, and it just makes me so frustrated when I think about how the average person is manipulated into chasing and FOMO into tops and panic selling bottoms over and over and over and over and over and over again. Addiction is the greatest threat to consistency because it forces you to stay loyal to your actions you don't even want to take. That's why it's the enemy of consistency. It forces you to take actions you don't want to take. Think about how powerful consistency is. Now realize addiction uses that same power against you. You are being consistent, but with behaviors that sabotage your success. I'm gonna read that last part again. Think about how powerful consistency is. Doing the same thing over and over again. If you do 10 push-ups every day, in 30 days you've done 300 push-ups. Now realize addiction uses that same power against you. You smoke 10 cigarettes a day. By the end of the month, you smoke 300 cigarettes. Think about how terrible that is for your health. You are being consistent, but with behaviors that sabotage your success. I need you to wake up. Okay, I had to take a little break there because I was getting really emotional about this. This type of stuff is near and dear to my heart. You know, I've dealt with addiction myself. I've dealt with addiction in my family, and I've fallen addicted to trading myself. I've spent so many years staring at the charts, just trying to change my life, trying to change my family's life, trying to change everything for myself. And ultimately it did pay off, but sometimes you have to sit there and reflect and think about, like, at what cost. Like, I've missed out on many years of my son growing up because of me trying to trade the markets, because of me studying all damn day long, trying to understand how to beat the markets. I've missed out on so many things in my life and fallen addicted to this process. And I just don't want that for y'all. If I can speed up your transformation by all the years that it took me, then mission accomplished. Okay, let's keep it going. You can't out-discipline addiction. You have to out-awaken it. The moment you realize you're running a destructive loop, you reclaim the power to choose. Consistency starts with conscious interruption. You have to become aware of that addiction inside of you. You have to. So we become addicted to wrong habits, overtrading, FOMO entries, revenge trades. These aren't mistakes, they're patterns. And if you don't change your identity as a trader, you'll keep repeating them. Let's build a system that replaces addiction with structure. You've studied the charts, you've tested the indicators, you've even bought a few courses, but the results still swing. That's because the missing piece isn't a better strategy, it's how you think about the market. Until you shift from needing to be right to thinking in probabilities, you'll keep sabotaging good trades and overreacting to losses. This isn't about more information, it's about transforming how you interpret risk, loss, and uncertainty. It's not a lack of knowledge, it's the mental war between expectations and reality. You expect the trade to work, but the market doesn't care about your certainty. It only respects your edge over time. Most traders get blindsided by one loss that makes them question their system, a small streak that makes them overconfident, a drawdown that makes them abandon everything. But here's the truth. You don't rise to the level of your strategy. You fall to the level of your mindset. The shift begins when you stop needing to be right and start training yourself to think in probabilities. So let's talk about probabilities. Let's develop the Let's develop the probabilistic mindset right now. Sorry, guys. To think like a consistently profitable trader, you must adopt a probabilistic mindset. This mindset is built on the following 5 truths. Anything can happen. Anything can happen. Anything can happen. Say that to yourself every day before you take a trade. I have had it on sticky notes in front of me on my monitor before I like integrated it into my mind, because now I fully know this. Anything can happen. The market is inherently uncertain. No matter how confident you are in a setup, it can lose. It can still lose. No matter how confident you are, it still can lose. You don't need to know what's going to happen next to make money. Profits come from following your edge, not from predicting outcomes. There is a random distribution between wins and losses. Even if your edge has a 70% win rate, you can still lose 5 times in a row, guys. So the people who are probability people who, I got to get a 90% probability of success. Okay, you can still lose. And you can still lose consistently because, one, you probably can't keep that edge. You probably can't maintain 90% win rate. Maybe you can, but forever, I doubt it. An edge only implies a higher probability. It's not a guarantee. It means you have better odds over many trades. It means you have better odds over many trades, okay? An edge only applies a higher probability. It's not a guarantee. And I think many people get tripped up about this, and that's why they end up leaning on high probability, because they think it's a guarantee. No, it's not. Every moment in the market is unique. No two trades are ever exactly the same, even if the charts look similar. I promise you. Oh, I promise you, because you're going to develop that playbook, and you're going, oh, this look exactly like this. Oh, and I lost. Why did I lose? Because every moment in the market is unique. Every moment of life is unique. And although the patterns are similar, it's never the same. Never. When you accept these principles, you remove the pressure to be right and shift your focus to executing well over time. So, rewiring your money identity. You will never rise above your self-image. Here's how you begin the rewire. Stop thinking in dollars, start thinking in R multiples. Detach from trade outcomes. Did you follow your plan? That's a win. Visualize yourself trading larger size calmly and consistently. And I need to put incrementally there. Like, if your position size is $100, don't be like, yeah, okay, let's make it 500 now. Huh? Like, how does that make sense? Like, if anything, doubling it, okay, fine. You double it. Now your position size is 100, now it's 200. But don't be making like 5x changes in your position size. Like that variance is going to put its foot up your ass, and you're going to be like, damn, the market got hands. Okay. All right. Practice gratitude and neutrality, whether a trade wins or loses. This is what creates the emotional bandwidth required to scale. Practical exercises for rewiring. Journaling prompt. What dollar amount do I start to feel uncomfortable trading or risking? Unpack the emotion behind that number. Visualization drill. Close your eyes and imagine executing that exact same setup. Now imagine it with $100 risk, then $1,000, then $10,000. Where does your nervous system tense up? That's your constraint, and that's what you need to work on. Okay. All of these numbers are just numbers. They should have no type of psychological bearing inside of your mind. If you are over leveraged, then it will. So if you only have a $10,000 account and you are risking $10,000 on a trade and you are panicked out of your mind, well, it's probably because you're over leveraged. Detach from dollar gains. Stop looking at the P&L in dollar terms for 30 days. Log everything in terms of R, not dollars. And I would even say percentages. This requires your focus towards quality and process. Prop trading frame shift. Remind yourself daily, this is not my money. My only job is to follow the rules that make it grow. I think prop trading is an interesting thing because there's a lot of predatory people out there, a lot of predatory businesses. Most infamously, I think it was MFF, my forex fund. I think it was the one who said slip them to hell. Honestly, that statement was really funny to me because you sound like an evil villain saying slip them to hell. What the hell is wrong with you? It's crazy, but that's exactly how they think. Like that's how these people think. They are not your friends. They're not here to be, oh, I'm a happy, nice prop firm. I'm here to help you make money. No, they're here to make money off of you and you continuously. They're here to take your check that you work hard for every month. I don't want you trading with a prop firm until you have an edge. Every trader has subconscious money beliefs that affect their behavior. You must separate your identity from your profits. Focus on executing setups, not on cash outcome. Reframing your relationship to money is critical for long-term consistency and scale. Your emotional connection to money defines your risk tolerance. Fear clouds your ability to see opportunity. It narrows your focus and distorts truth. Random rewards trigger addiction patterns that destroy discipline. Anything can happen. You do not need to know what's going to happen next in order to make money. There's a random distribution between wins and losses for any given set of variables that define an edge. An edge is nothing more than an indication of a higher probability of one thing happening over the other. Every moment in the market is unique. That is the end. And I really sincerely hope that this has leveled you up deeply. I hope my passion for this subject has been integrated into you, and you become passionate about this as well, and understanding that the addiction to trading is very real. It's very, very real, and it's the reason why most people blow up. I don't want you to blow up. I want you to develop a probabilistic mindset. Instead of thinking about this one trade, I want you to think about the next 10 trades, the next 20 trades, the next 30 trades. Keep shooting, keep shooting, keep shooting, keep shooting, keep shooting. If you have an edge, just keep shooting. That's your job. You pull up, you shoot. You pull up, you shoot. You pull up, you shoot. You notate, what did I do wrong? Could I have done something differently here? And I don't mean wrong because you lost the trade. It doesn't matter whether you win or lose. I'm talking about how you handle the trade, your psychology, whether you follow your edge properly or not. That's what I want you to focus on. I believe that's all that I have for this module. I'll see you all in the next one. All right. Welcome back. We are now in module 4, the power of backtesting, building confidence through data and AI. And this is a really, really, really important module because this is where it all began for me. This is where I started to become confident, is through backtesting. It's because you don't know how good you are at trading until you get in a certain amount of reps. And although I was trading for years, and I had success and I had made money and I had profitable trades and blah, 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 I wasn't confident. I was not. And that's because I still needed to get more reps in. So let's talk about it. So our objective in this chapter is to learn why backtesting is the foundation of trading success and how it helps you build confidence, eliminate doubt, stop strategy hopping, and develop elite level trading intuition, as well as AI powered methods to stress test your systems before risking capital. We are pretty much entering a new age of technology, and using AI to expedite processes is paramount. You don't have to, but why not? The tool is there. So yeah. So this is a back test that I did, and this is probably where a lot of people even found me from, was through this back test, because I was talking about my negative risk to reward strategy and how I became consistently profitable through understanding how to use a negative risk to reward. And you know, I don't even know if I really even like the word negative risk to reward, because when you think about the word negative, you think bad, right? Like negative risk to reward ratio. But it's really just taking profits at a distance that's closer than your stop loss is. And therefore, you just consistently win. You win a lot. And it showed, you know, like I back tested for many months by hand, and that's when I really became really confident in my trading. So why most traders fail without back testing. So we got to get really honest here and talk about what most traders do. They watch a few YouTube videos and start trading live. They take a couple of wins or losses and immediately judge the strategy. They don't understand their edge, their stats, or even their plan. And when it does work, after 3 trades, they hop to something else. This is a definition of gambling, and I'm just speaking from experience. Like, I'm just speaking from, you know, my own journey as a trader. It's not to talk about the average retail trader in a negative way. This is just what I was doing, and this is what was keeping me from being profitable as a trader. I just would not stick to one thing, and it's it's hard to when you're learning, because you're trying to figure out what's the best thing, like what's the best strategy, what's the best way to approach the market, what's the best, is it day trading or swing trading, scalping, like what's the time frame, like you're just learning all this stuff. So it's hard to know and trust what you're doing. And that's the purpose of, one, getting a mentor, and two, backtesting. So this is why backtesting is non-negotiable for me. Most traders lose not because they don't have a system, but because they've never tested it properly. Backtesting gives you certainty in uncertain conditions, the confidence to keep trading through drawdowns, proof that your system works over time. You cannot trust what you haven't tested. And Stephen Ducks even talk about this a lot. Stephen Ducks is a multi-millionaire penny stock trader, and he talks about how people just take strategies and don't even test them, and they don't even know if they work. They take a strategy on YouTube and go live test it, and then go gamble and lose all their money. And it's just not smart to do and go and do that. Any strategy that you come across, whether it's on YouTube or a book or whatever, you need to get at least 100 reps in through backtesting to understand if it works or not. So the benefits of backtesting: builds emotional detachment from any single trade, helps you understand long-term expectations, give you clear metrics, win rate, average R, drawdown, equity curve shape, profit factor. Backtesting transforms your trading from hope to certainty. And I really feel that is just facts. Like it's just been true. Like for me and all the other people that I know who just go and back test their strategy and see if it's actually profitable, it really takes you from like hoping it works to like, okay, yeah, I know I have an edge in the market, so I'm gonna just keep going. How to back test properly. So you can manual backtest using backtesting platforms that allows for limit order execution, such as TradeZilla or FX Replay. That's if you use limit orders. If not, then you can just use TradingView. TradingView has a bar replay tool. Only take trades that fit your exact criteria, and you need to have a criteria. That's where the playbook comes into handy. After 50 to 100 trades, look for patterns in your data. Like you have to track like the market conditions, right? Whether it's trading or ranging, which levels were used. For me, I use quarter levels, and often I use all these things. That's why they're there: quarter levels, supply and demand, support and resistance, candle behavior, and trigger entry. So you can figure out perhaps what candle that you entered in, and whether that's a good like entry trigger when you're trying to figure out when to get in and when to get out. I have a way of doing two things where I set a limit order and I wait for candle confirmation entry. Some people say only wait for candle confirmation entry, but I don't agree with that, because you give up R multiples if you're waiting for confirmation. So it's way riskier not getting confirmation, but you get more R multiples for that. So if you know that the probability is lower, simply lower your size. That's all you really need to do. So this is why most traders skip it, and why they also fail. Backtesting is slow, it's boring, it doesn't give you instant dopamine, and they want results right now. Most traders are looking for action, not precision. Backtesting is what separates gamblers from professionals, and that's just retail traders 101. Like, they don't want to do the hard work. They want to get in there and gamble, and just gamble on the chance of making money because they're addicted. And that's just the unfortunate truth. They don't want to do the hard work of figuring out whether they actually have an edge or not. They just want to find the easiest way to get rich quick, and that's just not trading. So yeah, backtesting is how pros train, like athletes. Professional traders treat trading like a sport. And like any athlete, the only way to improve execution is through deliberate, repetitive practice. Backtesting is your version of the gym or the field. It's where you sharpen your edge. You're building muscle memory and decision making under pressure. No serious athlete competes without first putting in thousands of reps. Traders are no different. If you want to be elite, you have to train like you're elite. Backtesting is training. And the more you understand the nature of the market and the more you understand your edge, the less you have to backtest. So it's not like you have to backtest every week all the time. You know what I mean? Like, you just need to backtest to know if your edge works or not. Get the reps in, get the data, because that's all you're doing is just getting the data, and the data gives you confidence. If you don't have the data, then how are you confident in what you're doing? You're just gambling. And you can gamble all you want. You can get lucky gambling. Some people get really lucky gambling. But if you want to be confident in what you do, then backtesting is the way. There are a lot of influencers and gurus who tell you backtesting is a waste of time. Don't backtest. And they wonder why their students don't get any results. Well, it's because their students are not confident in what they do. And that's just human nature. Like, how could you be confident in something that you haven't done excessively? You know what I mean? Like, if you get past a basketball, if you never played basketball in your life, how you gonna be confident to pull up and shoot that 3-pointer? But if you get those reps in and you shooting all damn day like Michael Jordan, well, then you already know what's gonna happen. There's gonna be nothing but net, baby. All right, so this is how I use AI tools to simulate results. One of the fastest ways I pressure test a model is by using ChatGPT to simulate 1,000 trades based on win rate, risk to reward ratio, risk per trade. The AI can quickly give me net profit, win rate over time, average win loss, drawdown range, profit factor, consistency of returns. This helps me know before I even backtest manually whether a model has a mathematical viability. And that's pretty much all it comes down to when it comes to equity curve that's trending up and to the right. It's just math. And you can do that in AI. You can stress test a certain model in AI. You need to obviously be able to hit those metrics, because that's all you're testing in AI is the metrics. So you can do that in ChatGPT or Cloud or whatever else you're trying to use. You can stress test a model and say, okay, this model is statistically, it has a positive expected value. So I just need to work on making my metrics match those exact parameters in the live market. Now, it's easier said than done, but it at least gives you some type of framework to shoot for. All right, so this is step-by-step how to do it in ChatGPT. So you're going to open ChatGPT, start a new conversation, type in the prompt like simulate 1,000 trades with the cyclical win rate. Cyclical is important. That fluctuates between 35% and 55%, risking 1% per trade and a risk to reward ratio of 2R. This rate changes every 100 trades to reflect realistic market cycles. Okay, so this is important because a lot of times people do back testing with static metrics, and I can guarantee you that your win rate will never be static. You know, like, you can't stress test a certain metric with a 50% win rate, because your win rate will not always just be 50%. It's going to go up and then it's going to go down. It might be 35% one month. It might be 70% another month, but it's going to fluctuate. That's why cyclical win rate is important. I'm telling you this because I've done this already. So that last one, let me see. I got a few of them in here. Okay. So that last one is just an example. This one is for a high win rate, low R strategy. So same thing, open ChatGPT, simulate 1,000 trades with a 68% win rate, taking profits at a 0.6 R and losing 1 R per losing 1 R per loss. Include a realistic variance in win streaks and drawdowns, and display the final equity curve, win-loss distribution, and max drawdown. So this is for people who want to trade a high win rate, high probability strategy with a low R multiple, but you're betting on winning so much that your wins eat your losses. So this is ideal for testing high win rate systems where small gains compound over time, great for building confidence and emotional resilience. This is for people who don't want to use a high probability model. Instead, they are okay with like maybe something in the middle with like in the middle win rate. So simulate 500 trades with 55% win rate, risking 1% of current account balance per trade, with a risk to reward ratio of 2-to-1 or 1-to-2. I know people say it either or sometimes. I usually say it 1-to-2. Include compounding effects after each trade, and display ending balance, max drawdown, and equity curve over time. This simulation shows how small edges grow accounts exponentially when compounded, perfect for reinforcing patience and long-term thinking. So this is like a compounding model. This helps me to know before I even backtest manually whether a model has mathematic viability. It's not a substitute for real chart work, but it's a huge shortcut for testing risk to reward models fast. Ask it to calculate the following over 1,000 trades: total profit loss, total profit/loss, number of winners versus losers, largest drawdown, average win and loss, profit factor, which is your total gains divided by your total losses. Ask for a breakdown by trade batches every 100 or 250 trades to check consistency. You can also add rules like if you win 2 trades in a day, stop trading, to simulate your prop firm logic. So this is good for people who trade with prop firms. You're not just getting numbers, you're stress testing ideas and seeing how they perform in a large sample size before risking a single dollar. This is what an example of it would look like, because I know people are over there probably thinking, show us an example. Okay, I don't need to open up ChatGPT and show you how to use it, because you should probably already know how to use it. And if you don't, I would highly recommend going to get a subscription so you can learn how to use it. But this is an example of something that it would, a graph that it would print out. I got this directly from ChatGPT. So this is a cyclical win rate equity curve, 2R risking 1%. So this is something that it printed out. Now it's missing some data here, so let me see if I have it. Yeah, okay, so here's another one. So this is another cyclical one, and this is including I put all of these different ones together so you can see what each one of these are. So I have one for a full take profit at 0.7 R with a cyclical win rate of 70% to 43%, full TP at 1.2 R, 70% to 43%, full TP at 2 R, 43% to 65%, full TP at 0.55 R, 75% to 75%, just 75%, 90% at 2 R. So this is a split take profit model, which you're taking 90% at 2 R and 10% to run to 3 R with a 43% to 65% cyclical, and you can see the rest. The one that did the worst is the high probability one, because you need to maintain a very high win rate in order to be profitable. So as you can see, it started to make money, and then once the win rate started to dip, it started to lose money. So this is really good to know, because if you are someone who like, okay, well, I just want to trade high probability models, well, that's good and great, but can you maintain that win rate that you need to maintain in order to be profitable? Because if not, then this is exactly what's going to happen to your equity curve. So I hope you guys are like understanding now what I'm talking about. Like, you can sidestep a whole lot of back testing simply by getting certain metrics into ChatGPT and asking it to take 1,000 trades, and you can see how those 1,000 trades pan out over time. What did the best? The 90% at 2R and a 10% runner at 3R with a 43% to 65% win rate. Now that win rate is really good. If you can consistently make that win rate, then you'll compound like crazy. But you need to have a really good win rate for that to even work. So it's like, these are just models. It doesn't mean that you can get in there and start doing this. Like, if you have a good edge and you manage your trades properly, then maybe you can. But to be able to do this for 1,000 trades is going to be really difficult. But it shows you what is possible, and that's all you need to know is what is possible. So what might be more realistic is maybe this orange line, or maybe this teal line right here. One of these might be more realistic. So let me see which one this is. This is I feel like it's missing some data here, unless maybe it's just hard for me to read. So this full TP 1R1, that's what this one is right here. So full TP at 1R with a 75% to 55% win rate. That's pretty good. That's a full take profit at 1R. And as long as you stay above 55% win rate, you're good. You're golden. Tell me that's not amazing. Look at that. Over 1,000 trades. Let's look at the orange one. Full TP at 1.2R with a 70% to 43% win rate. So this one doesn't perform as well, but that's because the let me see, I think it's because the win rate is lower. Yeah, so it's lower than this one. So 55, it's crazy because that little adjustment of having at least a 55% win rate changes everything so much. When your win rate drops to 43%, it really impacts your performance. So staying above 50% is really, really good. And ideally, if you can manage that, that's great. That's a great system, so long as you are trading in the way that aligns with your personality. Some people prefer like a really low win rate of like 30% or something, and going for higher R multiples because they are okay with losing as much as they do. It's ultimately up to you and your personality. I just preferred to find a strategy where I'm not losing so much all the time, because it does negatively affect your psyche. You know, it's kind of like a blow to your psyche every time you lose, because you don't know when you can properly size up. So this is the drawbacks of AI-based simulations. This isn't a foolproof plan. Like, there are drawbacks to it. It doesn't account for spread, slippage, missed time entries, missed trades due to emotions or distractions. It assumes perfect execution every time, doesn't reflect market flow or the psychological battle of placing a real trade. Think of AI simulations as a research lab, not a live battlefield. They help test assumptions, but don't replace experience. That's probably the most important line there, is that they help test assumptions, but they will never replace your live market experience, because when you're live, it's a whole different battle. So key takeaways: backtesting gives you statistical confidence. If you take nothing else from this course, backtest until you know that you can perform in the markets, and then forward test. But don't just walk around backtesting like it's not important. It's literally the key to your success as a confident trader. Like, you will not get through that door without being confident in your ability to perform. So please think of this as a sport. If you want to be like Michael Jordan, you need to train like him. It shows you how your system performs over hundreds of trades, and I guess about 1,000 trades if you use what I just told you to. AI tools can help you simulate and forecast performance rapidly. Don't rely on simulations alone. They're great for validation, but not execution. Your trading success will come from combining clear rules, proven data, and live execution under pressure. That should be the end of that chapter, this module. And I really sincerely hope that you will take it seriously, because if you do not backtest, and if you are not confident and you do not backtest, you will not get the results that you're looking for. Plain and simple. Don't avoid trying to do the hard work. Like, by avoiding doing the hard work, you delay so many years of your progress. And I wish I had a mentor or someone to tell me this in the beginning, but it's just important. So please do it. Please backtest, and I will see y'all in the next one. All right, welcome back. This is module 5, understanding variance, how to survive the randomness of trading. And variance is something that's really easy to understand, but it's also something very hard to survive. Let's get more into it. So in this module, our objective is to help you understand what variance is, why it's a natural part of profitable trading, and how to survive losing streaks without abandoning your edge. So this is a chart of what variance looks like from a statistical standpoint with a graph. So variance is basically the randomness of outcomes. So you can have a, let's say, 80% win rate, but the outcome, the variance, the randomness of how you win is not predetermined. So most people think, oh, I have an 80% win rate, a 90% win rate, I should be winning almost every trade. While that might look to be true from a percentage standpoint, the distribution of outcomes is random. So you might have multiple losers in a row, and you might think there's something wrong with your edge, but that's just variance. So a statistical method that evaluates the spread or dispersion of a data set relative to its mean. Mathematically, it is the average squared deviation of each data point from the mean. You get me? So the swings up and down from the mean is the variance. So high win rate strategies are low variance strategies, meaning that there is low variability and deviation from the mean, whereas there's low win rate strategies, 30% win rate strategies that are looking for high R multiples are going to have really large variance because their win rates are so low. The randomness of how much they win is the distribution is going to be very much high variability. So there comes their benefits, right? So low variability. So a win rate strategy that wins a lot with low variance is usually going to have a lower reward because of the balance that has to happen there. Whereas a high variability, high variance trading strategy with a low win rate, you will lose a lot. You will have a lot of losses, but when you finally win, your wins will eat your losses, and you still also actually have the ability to go on winning streak. Although the probability is low, all it takes is perhaps 3 wins in a row, and now you've really compounded your account. If you are looking for maybe a 3R multiple and above, this is the route that most traders on YouTube and retail traders go. And I'm not saying that it's the wrong way. I'm just saying that they don't have the psychology to survive the variance in that strategy, and that's why the markets are the way that they are, and that's why people's emotions are the way that they are. Is because they cannot survive their system. They cannot survive the psychology, the high variance of their system. So variance is the natural fluctuation of outcomes over time, even with a proven edge. You can do everything right and still lose multiple trades in a row. Losing streaks do not mean your strategy is broken. Trading is a game of probabilities, not certainties. The market is random in the short term. Your edge only shows up over many trades. Okay? So just because you go on a losing streak doesn't mean your strategy is broken, doesn't mean, anything's broken in your system. It just means that it's variance. And it's really hard, quite honestly, to get those really high win rates consistently, because you could still do the same thing over and over, but the market is so random and volatile and everything's constantly changing that it can be, you can face difficulties. You can face losing months and years even with variance. And that's why it's so hard to survive in trading, because people don't fully understand variance. So like I said earlier, even with a 70% win rate, variance means you might win 8 in a row and then lose 6 in a row and then win 5 and lose 1. That is what variance is. That is literally what variance is, my friends. So what causes variance? Market volatility, liquidity shifts, randomness in order flow, unexpected news or macro events, clustering of losses. All system has them. Listen, there's a infinite number of things that can cause variance in the markets and in your data, and that's why Mark Douglas does the things that he do and teaches the way that he does and says the things that he does, because it's literally impossible to know what's going to happen next. It's impossible to know when the trade that you're going to put on is going to be a winning trade, even if you have the edge and even if all the data and variables are in your favor. You're still going to have variance. The problem with most traders, they panic after 2 to 4 losses. They start changing strategies mid-cycle. They skip trades, overtrade, and size up emotionally. Most traders don't blow up from bad systems. They blow up from mismanaging variance, and they don't even know what variance is to begin with. So variance is one of the biggest psychological challenges traders face. Why? Because losing 5 trades in a row, even if it's statistically normal, feels like a failure. What traders think during variance? This system stopped working. I should tweak my entries. Maybe I need a new indicator. I knew I should have taken profit earlier, when it's all just variance. And the crazy part is that even after you put on the trade and you're managing the trade, you're still going to have variance. So you're going to have those trades that run to a 1R and then reverse. You're gonna have the ones that run for a 2R then reverse. You're gonna run to a 3R then reverse. You're going to have the ones that run to your take profit and miss it by 2 pips and then reverse and hit your stop loss. You're going to have the ones that you take profit on at maybe a 1-to-1 or 2-to-1 and they run for a 5-to-1 or a 10. That's variance, and that's really nothing that you can control. An equity curve will always show peaks and valleys. You might have 5 straight wins and 6 straight losses, and it doesn't mean anything is broken. Losses cluster, wins cluster. That's variance. This is why we look at batches of 100 trades and not day-to-day outcomes. We'll add a visual in the course showing how equity fluctuates with a positive edge. And I think we did that already. So stick to your plan through drawdowns. Use fixed position sizing to stay grounded. Focus on data across batches every 50 to 100 trades. Journal your emotions, not just your trades, especially if you're emotional. Remember, one trade doesn't make or break your edge. Professionals understand that variance is baked into the game. The most painful truth in trading: most traders quit right before their edge kicks in. They take 3 to 4 losses in a row, get emotionally thrown off, abandon a system, start a new strategy with no data, no back testing, just vibes. My boy out there with just vibes, just testing the waters, like won a couple trades and now he think he Hercules. All right, and repeat the cycle over and over again, especially the strategy hopping. So stop doing that. The trader who wins, they understand the game. They accept the short-term randomness. They let the math play out. That is what the casinos do. Be like the casinos. Be the casino. So that's variance. Key takeaways: variance is normal, not a sign of failure. Losing streaks will happen even with a 70% win rate. You need emotional endurance to let your edge play out. Avoid strategy hopping or tweaking based on short-term outcomes. Data beats feelings. Backtesting and journaling will show you what to expect. That was variance. I'll see you in the next module. All right, welcome back. This is module 6, drawdowns, DRC, which is the daily report card, and the playbook. So our objective in this module is to teach you how to handle the emotional, strategic, and practical sides of drawdown so you don't panic, overreact, or abandon your edge during temporary setbacks. educate you on what a daily report card is and the very powerful playbook. So what is a drawdown? A drawdown is the decline from a peak in your equity. It can be measured by percentages or a number of consecutive losses. Every system, even the best ones, go through drawdowns. Even the best ones go through drawdowns. It's not a matter of if you hit a drawdown. It's a matter of when and how you respond. And this is another thing that I feel like retail traders are just get completely jammed up on, is not understanding that professional traders know that they're going to hit drawdowns, and they have risk management in place to manage those drawdowns so they can remain consistently profitable and not have to worry about how they're going to recover the losses from the drawdown when it eventually hits. So this is an equity curve, and a drawdown is the pullback essentially. So you have a peak here and then pullback. You have a peak here and then a massive drawdown and then a massive recovery and then a pullback. Drawdown is simply a fall in your total equity caused by trading losses or position moving against you. All trading systems and strategies have drawdowns. The depth and duration vary. What causes drawdowns? Variance, normal statistic loss streaks, shifts in market conditions, temporary loss of edge or overfitting, execution errors, emotions, slippage. Most drawdowns are part of a healthy system if your backtesting includes them. So pro tip, go back to your data. Does your backtesting show drawdowns of 5 to 7 trades? If so, it's not unexpected. It's statistically baked in. How to handle drawdowns mentally. Zoom out and analyze trades in batches of 100+ trades. Remember, we talked about this, guys. 100+ trades. Don't jump to conclusions after 3 to 4 losing trades. Okay, this is the hardest thing for the average person to do. I swear to God, it's just to be good at losing. Use your journal to track what you're thinking and feeling. Revisit your data to rebuild trust in the process. Get accountability. Sometimes just talking it out helps. Create a drawdown protocol for yourself. This is a pre-written checklist you follow before making changes. So this is extremely important, once again, for the retail trader that struggles with emotions. You need a drawdown protocol, because if you go on tilt and start revenge trading, you're going to blow up. Review the last trades. Check for any deviation from your edge. Confirm its variance, not bad behavior. Take a walk or break to reset your psychology. Know when to step away. If you are striking out on the day, step away from the screen. Just step away. Hey, live to fight another day. Just don't go into tilt mode and revenge trading. Follow your rules. You can always lose more money. You can always lose more money. You can always lose more money. Go outside, get some air, take a walk, protect your mindset. One revenge trade can wipe out weeks of progress. Weeks of progress. Weeks of progress. Don't trade to feel better. Trade when you're thinking clearly. So this is when to reduce size. After 3 consecutive losses, consider reducing risk for 1% to 0.75% to 0.5%. Obviously, these are minuscule amounts, but I'm trying to shift the framework of an account that's larger than $100,000 to illustrate proper risk management on very large accounts. If you have a small account and you're trying to grow it, this will be significantly larger, from 10 to 20%, but you get the picture. You want to protect your psychological capital, not just your balance. Don't go back to full size until you stabilized with wins. Avoid the trap of increasing risk out of desperation. Reducing size is not weakness, it's professional discipline. They chase losses with bigger trades. Okay, so this is why most traders don't survive drawdowns. They chase losses with bigger trades. They jump to a new system after a few losses. They stop trading their plan when it matters the most. They let one trade control their entire emotional state. Most failure in trading comes from inconsistency during drawdowns. This is where emotional mastery is tested. So we're moving on to daily report card now. The DRC is a structured end-of-the-day journaling practice created by S&B Capital. It helps traders track performance, behavior, mindset, and execution across key metrics. The goal is not just accountability, but deliberate practice, improving one focus area every single day. It's modeled after elite athletes and coaches who track daily performance improvements to build mastery over time. Why the DRC matters, especially in drawdowns. Drawdowns are inevitable. They expose your weakest link. The daily report card creates emotional detachment by turning the day into data, not identity. It allows you to objectively identify what went right versus what needs work. Build a feedback loop. What's the one thing I can do tomorrow to get better? In high pressure moments, the daily report card acts like a mirror, revealing mindset gaps, helping you to recalibrate. Each DRC entry should answer these 5 prompts. What did I do well today? Okay, so let's get into visualizing the DRC. Okay, so there are many different platforms you can use. You can use Notion, you can use Google Sheets, you can use your notes on your phone. Okay, so some people are really visual, but I really need you to just think of this as simple as possible. What did I do well today? Focus on execution, discipline, and processes to win. Where did I fall short? No fluff, own your misses. What was my mindset like? Anxious, patient, overconfident, distracted? What is the one thing I will improve tomorrow? This becomes your daily focus. Grade yourself 1 to 10 on your performance, not outcome. Excuse the typo. So these are pro tips to maximize the DRC. Be honest, not emotional. The goal is clarity, not self-judgment. This is extremely important. I need you to be absolutely honest about where you are and what you're doing. Track themes over time. If the same issue pops up 3+ times, it's a system level flaw. A system level flaw. Consider sharing your DRC with a mentor or accountability partner. Use voice notes. If you hate writing, just make sure it's intentional. It's intentional reflection. Excuse me. Intentional reflection. Don't just fill it out. Use it to design your next day. So here is what my DRC looks like inside of Notion. And I should also have a link to this in the description box below. So this is there are different tabs here, and this gives me further clarification on how I did that day, what type of trade I took, emotions involved. I'm not sure if this will be fully legible or not, but so we have the date, we have whether I bought or I sold, with what's the playbook trade. So this says HTF S&D, which is higher time frame supply and demand. The money lost, I pressed the wrong button, sorry about that. The commissions, swap fees if you're trading forex, whether you win or lost, the emotions. So I'll put patient here, review trade yes, reasons for win or loss. Even though you can't really know this, but it's just kind of like a guess, really. So Confluence, which is important, order flow and direction, rejection wicks. How did I manage the trade, trade quality, execution type, whether it was a market order or a limit order, the trade type. So it was a day trade, a scalp, a swing trade, the risk to reward hit. So if it hit a 1-to-1, this would be green. This was an X because this is a losing trade, so it didn't hit a 1-to-1. The win rate is a 0. So if you won the trade, you'll put a 100 here. If you lost the trade, you'll put a 0 here. the entry time frame. So what excuse me, what time frame did you enter the trade? The entry candle type. This should have been filled out so I could illustrate to you guys, but I must have run out of time. And over here, this is where you would post screenshots of the trade, or entry notes. So this is the entry notes, so any notes that you need to take about the trade, you could put your trade entry screenshot here, exit notes, and trade exit screenshot here. And then once it's all done, you put your reflection on the trade. Once again, that should be in the description box below. Here's a demonstration of what the notion could possibly look like. Once again, this is just for demonstration purposes. And so I filled out all those different things for those different trades, and you see win rate is 100 here, so you'll put 100 if you won the trade, and all the different fees, and the playbook trade here, the symbol or ticker that you were trading. So I have to illustrate like forex and crypto, and maybe a stock in here, or indices, and some more information over here. So there you go. Okay, so final takeaways for the daily report card and drawdown. Trading edge equal information plus execution plus psychology. Okay, trading edge equals information and execution and psychology. The DRC strengthens all three with the focus on intentional growth. It's not about being perfect, it's about getting 1% better every day. Drawdowns are expected, not avoidable. Your future consistency will be built on the foundation of these daily reflections. Amateurs wing it, pros measure it. So start tracking and start transferring. So now we're going to talk about the playbook. This is Mike Bellafiore from SMB Capital. So your playbook is a personal archive of your best trades. It's not theoretical. It's a tool to document, study, and replicate setups that consistently work for you. When used right, it becomes a record of your edge, a decision-making guide, a tool for scaling size with confidence, a pattern recognition enhancer. This is what separates amateurs from elite ones. The market rewards focus. A playbook gives you that. Without it, every trade feels random. With it, you know what setups to wait for, which ones to pass. It trains your brain to recognize high probability conditions. It gives you a statistical advantage when sizing up. It turns chaos into clarity. This is how pros stay consistent through structure. So, how to build a playbook. Every trade in your playbook should include setup name, what type of trade was it, breakout, VWAP, reclaim. The setup, what did you see before entering, what were the catalysts, the plan, your thesis, entry, stop, target. The execution, how did you actually trade it? Were you patient? Did you size up, size down? I remember Mike, I was always asking the SMB traders is was there an opportunity to get more size on? Like, could you have sized up? And that's something that they really drive home, is when you get a good trade and has positive expectancy, can you get more size on there? What worked, what didn't? Would you take it again? This is how you systemize success. Charts are everything. Each playbook entry should include a screenshot of the setup forming, annotations of key levels, context, and Confluence, a replay of how the trade evolved. You're training your eyes to spot the same setup again without hesitation. That's what we're doing here with the playbook. The difference between a journal and a playbook. A journal is emotional, not all the time, but it can be about your emotions. A playbook is strategic. Journal, I hesitated again. I need to work on pulling the trigger. Playbook, strong trend, VWAP reclaimed, volume spiked at inflection level, took partial profit into resistance. So it's like you could still have some of the detail of the journal, but it's a bit more strategic and technical. They serve different purposes, but both are critical. Every setup looks good in hindsight. The playbook forces you to define what A plus looks like, so you stop trading noise. You start trading only when your edge is present. You reduce impulsive and boredom trades, which, you know, people, they feel like they have to take a trade, so they take a boredom trade and end up losing usually. You conserve mental and emotional capital. Your job isn't to trade often, it's to trade well. The playbook tells you when to act. At S&B Capital, traders review the day's trades and select ones that showed edge, break it down using a structured template, get feedback from senior traders on how to improve, add it to their personal playbook for future references. This process is what builds elite pattern recognition. You're not just trading, you're training. So, building confidence through repetition. Confidence doesn't come from theory, it comes from repetition. If you documented 15 plus examples of your best setup, you're more likely to hold it, you're more likely to size up, you're less likely to cut early. Why? Because you know how this story tends to play out. Past performance is not indicative of future results. The history doesn't always repeat itself, but it sure does rhyme. The playbook turns uncertainty into conviction, and conviction is what you need, especially if you're trying to hold your trade and size up. Athletes study game tape. You study your trades. The playbook is your training reel. It shows you when you perform under pressure, where your weaknesses show up, which plays to run again next time. You're building a playbook like a quarterback. You know the conditions and you call the right play. So avoid these common mistakes: logging random trades with no edge, using the playbook like a journal, skipping screenshots or trade planning, only playbooking winners and ignoring losers, which is just not helpful. A playbook isn't a highlight reel, it's a tool for growth. That means documenting both the best and the costly, because both teach you something. They both do. Your wins and your losses, and it's usually your losses that really teach you what you need to know. So keep it evolving. Markets change. Your playbook should be updated with how the market is changing, because the let's say 1980s trading back then versus now, significantly different, significantly different. So archive setups that no longer work is what I mean. Add new variations with edge. Track how your setup evolve over time. Reflect monthly. What's still working, what's not. This isn't a static document. It's your living edge growing as you grow. So this is a S&D play and my playbook, and I've been documenting these for quite some time, quite honestly, and I'm really hoping that you can see this because it's about as big as I can make it. But this is a cryptocurrency called Popcat. I'm using my indicator that I built, and these words are what I wrote out right here. The table is the indicator, and the zones, the red zone is the indicator, and the moving averages and the quarter levels are the indicator. But I wrote these out for people to see why this popped up as a potential trade to take. So we have a demand zone that broke structure. We have the demand zone here. We have price above the moving averages, indicating that price is currently strong. We have high EV candles being printed inside of the demand zone. Remember, a demand zone that broke structure is indication that the last time price here, it was a very strong reaction, and that there's an imbalance of buy orders over in this direction, which preventing the sell orders from going any lower. So high EV candle means that there is a high probability of reversal. A bullish engulfing candle that you see right here is a high probability candle, and price did eventually reverse all the way back up to that 0.375 level. and it was very close to a key quarter level, which is this 35-cent level. And price was so bullish that every time it attempted to retest this 35-cent level, it popped back up and went up about about 1/4 level up. So 35 cent up to 37.5, and then next is 40 cent. So as you can see, there was a trade recommendation to buy at the demand zone over here. And we're going to talk more about my indicator later. This was a trade that I actually took. I believe I have the document there. So this was price was downtrending. So we have this supply zone that broke structure and pushed all the way down. So we know that last time price was here, it was unable to push any higher. Price got really volatile. Mind you, this is a cryptocurrency, so these things get really crazy. So there's a lot of exuberance. Price was going parabolic into this zone right here. We started to see exhaustion from the buyers right here in this location. And then once the price finally turned around, this is on a 4-hour time frame, so this is a rather significant time frame for an intraday basis. We had this massive rejection candle, a high EV candle printed, which was this bearish reversal bar right here, and it was at a key level, which was this sometimes their numbers in crypto are so small that it's just absolutely ridiculous. I don't even think this is 2 pennies, but anyways, this is a key level right here, key psychological level right here. You see that it reversed after it tried to reclaim the level, but completely failed, got stuffed, and reversed all the way back down. Although my indicator was saying that it was bullish, so it was indicating buys, which is absolutely true, because if you look at it from a market structure perspective, and I believe it actually did hit this this support level that I have mapped up right here, and it reversed all the way back up. So my indicator ended up did being right if you would have took buys down here. But I like to sometimes fade things that are going parabolic. So I entered once we got this, I believe there's a 2-hour bar right here. So once we got this higher EV candle, I entered, and then I sized in here once we started to break this level, and then I took a little bit of profit right there, called a 70% move with leverage, with 7 times leverage. So this is alt. I believe this is another trade that I took. Yeah, so there's another trade that I took. This time my indicator was telling me to take sales at the current moment because the market was really weak. So supply zone, exhaustion, and I believe I went short somewhere over here. And it's pretty much kind of the same idea, right? Price has these really unsustainable pops, and then I short them after they start to show a little bit of weakness. I didn't see this over here, otherwise I would have shorted over here in this area, but I wasn't at the computer at this moment. So you got to be careful, because sometimes these fail and you can really damage your account. So literally same trade. Market went parabolic. It started to show a little bit of weakness. I hit the sales, I sold into their weakness, sold into the weakness again, covered a little bit here, hit it again, and I covered here. It's really interesting, because this is what you would usually see in penny stock world and small caps, where the market gaps up, and then the short sellers hit it and sell it all the way back down and fade the pop. So I call a nice 97% move here, and yeah, that was probably one of my better trades, because it just completely fell apart after I hit it. So did I take this trade? Yep, there's another trade that I took. So once again, this is the level of support of the 4-hour. So we got price, showing a lot of weakness, trending down below the moving averages. So we popped up into this zone here, and I think this is where I sold. I believe this is where I sold, and the indicator showing us that all the technicals are really bearish right now. So ideally you'll be looking for sales. And yeah, this is just kind of looking for the same. This one is more like a daily break and retest. So and I put it right here. So daily break and retest. So it's not a parabolic short. Like this was a parabolic short. I think the other one was a parabolic short. So things going parabolic and they can't sustain themselves. So this was the daily. I hit it, I covered, covered, and hit a nice 100% move over there. So this is Sandbox. This is another trade, daily break and retest, exact same thing. The Confluence is telling you to buy because price is strong, but once again, sometimes you have to form your own ideas about the trade when it comes from a market structure perspective, and I decided to sell it, and that gave me a nice 127% move. So I sold into that strength. You got to be really careful when you're selling into strength, because you're technically selling into something that's lower probability, because the candles haven't turned around yet. The direction that price is moving hasn't turned around yet, but I sold into that strength, and then I waited and I started to cover. So same thing. So that's an example of what will be inside of your playbook, is like trades that you took, so you can like review those trades, look at them over and over and over again. So discipline is hard without structure. The playbook is the structure. You don't need willpower if you have it planned. You don't need to overthink when you've already done the thinking. The playbook gives you the clarity, confidence, and process that separates you from the herd. The key takeaways. Drawdowns are part of the game. Your job is to manage risk and survive them without emotional damage. The DRC builds self-awareness, tracks goals, grade performance, and grow like a pro. The playbook locks in your edge. Document your best setup so you can repeat and scale them. Confidence comes from repetition. Remember that. This is the Confident Trader course. Confidence comes from repetition. When you've seen it 20 times, you'll know exactly what to do. Structure beats emotion. The combo of DRC plus playbook gives you clarity when the markets don't. So anytime you pull up to the markets and you're like, I don't know what's going on here, you better pull out that playbook. You better pull out that DRC, and you better get to work. All right. Okay, hope you guys enjoyed that module. I'll see y'all in the next one. Okay, welcome to module 7, cause and effect in the market. So we're getting down to the real meat and potatoes of why the market even moves in the first place. So our objective in this module is to help you understand why the market moves from consolidation to trend and back again, using simplified, time-tested principles of accumulation and distribution. This will help you identify the early stages of big moves and avoid getting chopped up when nothing's happening. So, who was Richard Wyckoff, and why should you care? So, let's briefly talk about where these ideas come from and why they've stood the test of time. Richard D. Wyckoff was a legendary trader, chartist, and market theorist from the early 1900s. He spent his career studying the real behavior of markets and, more importantly, the behavior of large operators and institutions who actually move price. He wasn't just a chart guy. He was a student of how supply and demand drives price, and he focused on how smart money enters and exits the market quietly before the public even notices. Wyckoff believed the market moves through predictable phases: accumulation, buying, markup, prices rising, distribution, selling, markdown, prices fall. So this is an accumulation schematic. And I'm not going to get into the individual specific things like preliminary support, I believe, automatic reaction, secondary test, all those things, because quite honestly, they're really not all that important. And I'm not an expert on Wyckoff. All you need to know is that this is a range. And at the bottom of the range, the operators or institutions are testing the bottom of the range for supply. And when there's no more supply in the range, all of the orders are absorbed and the market retests the top of the range yet again, which is basically another test, and it sends it. So it's a spring at the top of the range and sends it into the next phase. So I don't want to get overly technical here, because I've learned Wyckoff before, and quite honestly, it really wasn't helpful. Like all the specific different things and naming the technical, like you don't know what's happening. You don't, and you probably will never know. All you need to know is that it's in a range, and once all the orders are accumulated in this range, it goes into a markup phase. That's all you need to know. Here's the distribution. So this is the markup phase. Market is trending. So this is when most people get a join the market. It goes into distribution. There's more tests at the top of the range. There's basically no more demand and people are offloading their positions, the market then tests the bottom of the range as resistance, and then it goes into another trend. So this is basically how the market moves when it's trending. So there's impulse correction, impulse correction, impulse correction. That's an uptrend. And then there's a larger correction, which is a downtrend. So impulse correction, which is the pullback, impulse, and then it shifts again. And so we're going from uptrend, downtrend, uptrend, downtrend. And in those major uptrends and downtrends, there's subsequent smaller uptrends and downtrends. Pretty basic retail trader stuff. So this happens over and over again across all time frames and asset classes. What makes Wyckoff's work powerful and why we use it in this course is that it's based on logic and behavior, not indicators and patterns. Now, there's nothing wrong with indicators and patterns, but we want to get down to the grassroots of why something is moving, right? He taught traders to observe volume and prices together, think like professionals, stop chasing breakouts, and start reading intention. So if you come to a chart and you look at it and it's in a range, you should ask yourself, what phase is this in? Is it going through accumulation or distribution? The market is simply an expression of the collective decisions of buyers and sellers. Your job is to figure out who's in control. This is a paraphrase quote from Richard Wyckoff. You won't need to memorize every Wyckoff label or schematic in this course, but you will learn to think in the same way. So that's what I was just saying. Like, don't try to memorize these things. Understand why something is the way that it is. Don't try to memorize certain things. It gets convoluted. So where are buyers absorbing supply? Where are sellers quietly unloading into strength? What phase is the market in, and what's likely to come next? That's how you move from reacting emotionally to trading with purpose. So in the accumulation phase, the buying phase, smart money is quietly building long positions. Price moves sideways in a range. Volume often increases subtly on dips. Retail traders are uncertain, thinking the market is dead. This phase creates the cause for an upcoming uptrend. Markup, prices rise. The range breaks out, momentum picks up, late buyers jump in, institutions begin to profit from their positions. This is the effect, the trend that results from accumulation. This is the markup phase, okay? And then there's distribution, which is the selling phase. So smart money begins offloading their long positions. Prices move sideways again, often with false breakouts. Volume increases on rallies. Retail traders are still bullish. This is the cause of the next markdown. And next is the markdown, which is prices falling. The range breaks down. The trend turns bearish. Late buyers are trapped. Smart money re-enters as sell orders are prepared to accumulate again. Understanding these phases will help you anticipate what's next, not by guessing, but by observing how price and volume interacts inside a range. And most importantly, the market is in the range about 70% of the time. The trend or markup or markdown only happens about 30% of the time. It's obviously market dependent. So this is kind of generally like stock market, and perhaps forex. Crypto is a bit different, but generally this is the case. So like right now, Bitcoin's in a range. If you go, well, depending on when you're looking at this is in July of 25. It's in a range. Most of the time the market is trending. It's moving. Most of the time, the market is not trending. It's moving sideways in a range. The range serves as a purpose. It's where large buyers accumulate inventory without spiking price, or where large sellers distribute inventory without crashing it. Think of it like loading a rocket. Once it's full, it's ready to launch. This is the cause, the invisible buildup of energy. Once supply or demand is absorbed in the range, the market must break out and move to the next area of liquidity, the effect. So this is just kind of general example that I have. This is I believe Solana. So let's say that there's, and there's not, 1,000 shares is nothing, but let's just say there's 1,000 shares in this range. Once all 1,000 shares are absorbed in this range, the market will then move up. That's basically the concept of accumulation. So it's like, and it's also why I prefer to use quarter levels, because every level is going to be an accumulation or distribution. So you can even see here, there was distribution here, and that's the reason why price fell below this level, and there was a massive amount of supply here, and it dropped. Once again, when price got back up into this range, there was still enough supply to push the price back down to retest this area, but there was enough demand to be met at this around psychological level. And once there was buyers to double bottom off this price, especially on to the second time, there's even more demand. It pushed the price up. So what starts the trend? The trend begins when all of the available supply or demand within a range has been absorbed. An accumulation, once all sellers are gone and buyers control the market, and buyers control the range, market breaks up. In distribution, once all buyers are exhausted and sellers dominate, market breaks down. It's not about patterns in this circumstance. It's about the order flow and dynamic behind the candles. When you see a strong breakout from a long range, that's the result of weeks or months of slow accumulation or distribution. When you think about it, some of these institutions have like billions of dollars to accumulate positions, and it takes them months to do so. So they have to do so while trying to get the best price and without impacting the price too much. And that could take them months, if not years, to accumulate positions sometimes. Retail traders get caught chasing breakouts. Professional traders are watching the range before the breakout even happens. They're asking, is this range showing signs of strength or weakness? Is volume increasing or support, or is volume increasing as support or resistance? Is price making higher lows, accumulation, or lower highs, distribution? The breakout isn't where the smart money enters. It's where they've already positioned and they're letting the breakout finish the job. All right, so real world example, and I kind of already touched on this in the example with the image, but let's say Solar's ranging between 120 and 125 for a week. Each time price dips to 120, it gets bought out quickly. Volume increases at 121. Price begins forming higher lows. No more new lows equal no more available supply. That's a sign of accumulation. Once 125 breaks with conviction, the market has no choice but to move to the next zone, maybe 137.5, maybe 150. Because there's no more cheap supply available in that old range. That's the cause is the range. The effect is the trend. The cause is the range. The effect is the trend. The bigger the range, the bigger the potential move. If you understand this relationship, you stop getting chopped up inside of ranges. You start waiting for signs of strength or weakness, and you understand that nothing moves without a reason. Someone is building a position. So, key takeaways. The market spends most of its time in a range. Range exists so smart money can accumulate or distribute. Once all supply or demand is absorbed, the market must move. Accumulation equals cause for bullish trend. Distribution equals cause for a bearish trend. You don't need to name every candle. You just learn to recognize when the range is about to give way. All right, so that was a short one, but a very powerful one, because it is pretty much why the market moves the way that it does. So hopefully that was beneficial to you guys. I'll see you in the next module. All right, welcome back to Module 8, COT Data and Fundamentals. So our objective is to show you how to use institutional positioning and macroeconomic fundamentals as confluence in your trading, helping you align with the smart money instead of guessing alongside retail, which it's very easy to fall into that trap. So let's talk about why this module matters. Most retail traders trade in a vacuum without understanding broader market flows. COT data and and macro fundamentals show you how big money is positioned. Combining technicals with positioning creates a real edge. Knowing where the institutions are learning or leaning helps you make smarter, higher conviction trades. Now, this is mostly in the stock market, forex, and a little bit of crypto. You can mostly see what they're doing in Bitcoin, and metals, and so gold, silver, copper, stuff like that. So this is definitely for people who trade most indices, forex, and Bitcoin, specifically Bitcoin and Ethereum, and gold and silver and metals. So what is the COT report? So the COT is the Commitment of Traders, a weekly report released by the CFTC, Commodity Futures Trading Commission. Shows how different participants are positioned: commercials, hedgers, producers, non-commercials, institutions, speculators, retail, public, the smaller side of the flow, which is the retail. You don't trade based on it directly. You use it to confirm your directional bias. So how to read it? This is kind of a very much simplified way of viewing it. But yeah, focus on non-commercial speculators. This group includes funds and big players. If positioning is increasing long over time, equal accumulation. If they are reducing exposure, equals distribution. When positioning is extreme, equals potential reversal area. Don't make decisions off of 1 week's data. Look at trends and positioning. Where to access the COT data, you can access it completely for free at the cftc.gov, completely free once again, or you can use visual dashboards. You can use the Edge Finder, what I personally use, COT Base, Trading Stir, and MyFX Book COT tool. So yeah, once again, I use the Edge Finder, which is what this is. This is made by A1 trading company, founded by Trader Nick. So show some support to Trader Nick. He is definitely someone who has educated a lot of people on fundamentals and importance of understanding this data. And hopefully I have a link in the description box below to get you guys some type of discount on the A1 the Edge Finder, excuse me. I was about to say the A1 Trader, the Edge Finder. But this is definitely some really good information here. So the Edge Finder shows you the asset class. So here you can see it's a currency, Euro CAD. This is a index, the NASDAQ. This is the DAX. So I believe that's the German index. This is another currency. We have silver, gold, and Bitcoin down here. And it gives you a reading. The bias, is it bullish, is it bearish? There's a score, there's a COT positioning, the retail positioning. So sometimes it's nice to fade retail positioning. Seasonality, the trend, GDP, economics, it goes on and on and on. And it calculates all these data to give you a score and the reading. And I've just found it very useful. So I would not feel right to not mention any type of tools that I use to give me an edge in the marketplace. And once again, I've been using this, I think, for about 2 or 3 years now. And I found it very useful. So yeah. Where to access COT data, Edge Finder allows you to see the trend score, bullish or bearish, COT heat map, institution. And I think they even added more since then. Last time I checked, they've added even more. So this might even be outdated. But yeah, institutional versus retail sentiment, historical positioning, and trends. So this is how I use it in my trading. I never take a trade because of COT. I use it to confirm my directional bias. Fundamentals move the markets, but technicals help you time and getting at a good location and manage your risk. So technicals are very good for risk management. So stay on the right side of macro sentiment. Spot when positioning is maxed out and a reversal is due. It's not a trigger, it's a macro context for bias only. The role of fundamentals. Fundamentals equal the economic backbone of price action. Interest rates, inflation, which is CPI, employment, non-farm payroll, NFP, jobless claims, central bank tone, the Fed, ECB, which is the European Bank, Bank of Japan, fear and greed. It's pretty much why these institutions are doing the things that they do, is because of the economics. So why fundamentals matter, they explain why price is moving, especially critical in forex, SPX, and even major crypto shifts. Fundamentals can invalidate technicals when major releases hit. Even if you're a technical trader, ignoring fundamentals is a blind spot. Honestly, it really is. Even if you don't use it to trade like Solana or, you know, some offshoot cryptocurrency, like the crypto market doesn't exist in its own vacuum, like where it's unaffected by macroeconomic events. Like it definitely is influenced by interest rates and stuff. So just having this data, I think is useful. Bitcoin's fundamentals are what make it different. Fixed supply of 21 million coins, no central authority can dilute it. It's increasingly being viewed as digital gold. Institutions like BlackRock are buying it daily. Bitcoin benefits from inflation, debt prices, and distrust in governments. Price action follows narrative, and Bitcoin's narrative is strengthening. Long term, the fundamentals support a continued uptrend. So that's me talking about crypto fundamentals, but specifically Bitcoin, because a lot of cryptos are just useless and have no actual utility. They're just max extraction farms. The majority of altcoins are driven by hype, not substance. Teams use buzzwords and empty promises to pump price and dump bags. Most have no real users, revenue, or long-term utility. Liquidity extraction is the name of the game. That's what I just said. Good traders know this and look to short it. Look to short the worst projects. When in doubt, ask, would anyone use this if the price stopped going up? Bad fundamentals equal opportunity to profit on the downside. The smarter move isn't buying every breakout, it's shorting the garbage. That's real info right there. So let's talk about penny stocks. Penny stocks are cheap for a reason. They lack real value or sustainability or stability. Most are thinly traded, easily manipulated, and fueled by hype. Promoters pump them to attract retail and dump once volume hits. No institutional backing, no revenue, no edge, just emotion and illusion. 90% of traders lose money chasing the next big thing. These stocks are not undervalued. They're usually just garbage, just like crypto. And in fact, crypto spawned from the same people who are doing these promotions in penny stock land. Smart money avoids or shorts them when the hype peaks. Now, they're very good traders like Tim Grittani, Steven Ducks. This goes on. There's really good penny stock traders who've made, you know, a large fortune off of shorting these things that have no intrinsic value. Don't confuse a low price with a good deal. Trash is still trash at a discount. So let's talk about spotting these pump and dumps before it's too late. Sudden massive volume out of nowhere, aggressive green candles with no pullback, so something going completely parabolic. Twitter, Discord, Telegram hype with no real news. Promoters and influencers all saying this is the next big thing. This time it's different. No institutional volume, it's retail chasing momentum. The company has no revenue, product, or future plans. Price spikes 100% in hours or days, then stalls and fades fast. Chat rooms go silent and start blaming short sellers right after the dump. It feels too good to be true. It's probably someone else's exit. If it feels too good to be true, you are exit liquidity. All right, key takeaways. COT data helps align with institutional positioning. Fundamentals explain why prices is moving, not just how. The Edge Finder is my go-to for visualizing macro and COT bias. Use macro fundamentals as confluence, not entry signals. Bitcoin is rising because of strong fundamentals, low supply, institutional demand, and trust in its scarcity. Most crypto and penny stocks fail due to weak fundamentals and manipulation. Combining technicals, COT, and fundamentals creates true high probability trades. That's all I have for you guys in this module. I'll see you all in the next one. All right, like I said, I presented the most important concepts first. All the things that you need to know that are centered around fundamentals in psychology are first and foremost. When we're constructing our house, we want our foundation to be very strong. I started off with psychology, then fundamentals, and arguably fundamentals could come first, but it's really dependent upon the market that you're trading. So I started with psychology, then we moved into fundamentals, and now we're going to get into some more technicals. So the mechanics of price action and foundations of quarter levels. Some people call them sec levels, but it's just quarter levels. So in our objective in this module is to teach you what actually moves price, not myths, not indicators, not made up theories, but real supply demand mechanics and order flow. Then we'll anchor that logic into the use of quarter levels, giving you a repeatable system to find high probability entries based on where price is likely to react. All right, so what really moves the price? And this is separate from like fundamentals. This is more like on a technical, what moves the price. So prices move when there's an imbalance between buyers and sellers. That's it. That's the whole thing. That's in the course. No, I'm joking, but it really is that simple. It's an imbalance. All price movement is caused by an imbalance in the market's order flow. Mark Douglas. When aggressive buying overwhelms passive selling, price moves up. When aggressive selling overwhelms passive buying, price moves down. There is no magical reason, no secret signal behind the scenes. Price moves because orders move. This is why indicators often lag. This is why patterns sometimes work. This is why trading based on logic, not prediction, is essential. An order imbalance is when one side of the market, buy or sell, overpowers the other with urgency. So here's what that looked like in real time. Market participants submit limit orders, resting liquidity. Other participants submit market orders they want in now. If enough market orders hit the book and wipe out the opposite side's liquidity, price jumps to the next level where liquidity exists. So this is how it would look inside of probably the stock market. I think this is the stock market. It's something that's $3,000. So anyways, so this is a order book, and this is the bid and this is the ask. When all of these orders, so let's just say there's 36 here, right? If all 36 of these orders are absorbed by market orders hitting the bid, then it's going to jump to 30.25. Notice how these move up in increments of 25, 50, 75, 00, which are quarters. So that's what moves the price. These are passive limit orders, and once they are absorbed, they move up and move up and move up. That's what absorption is called. So, some quotes from Mr. Mark Douglas. Anything can happen. You don't need to know what's going to happen next to make money. There is a random distribution between wins and losses for any given set of variables that define an edge. An edge is nothing more than an indication of higher probability of one thing happening over another. Every moment in the market is unique. I need you guys to screenshot this, put this on your wall, put this in your journal, put this in front of you, because these 5 principles are absolutely key to being a consistently profitable trader. All right. So here's what most traders are told. The market reversed because of a Fibonacci confluence with RSI divergence. Banks hunted your stop losses. The market just faked out retail traders. Now, I'm not saying liquidity runs and liquidity grabs don't happen, but they're usually because that's just where everyone's orders are, and the market is seeking to go to that level because that's where everyone's orders are. That's where the most liquidity is, and price is attracted to liquidity. So most retail traders are taught fantasy. These explanations feel smart, but they're just narratives created after the fact. Unless you can see the actual order book and know the intent of every market participant, you're just guessing. And even if you could, you still be reacting to what's already happened. What matters is not why price move. What matters is where price is likely to react again. That's what quarter levels help us to identify. And Mark Douglas talk about this a lot. And this is just facts, man. There are so many cults built off of people saying that they know why the market did this move and what moves the market, and there's a secret algorithm, and bruh, listen, nobody knows. It's impossible, because you would need to know what every market participant in the world, what their intentions were and why they put that trade on. And you cannot know that. That's just, think about how ridiculous that idea is. So, introduction to quarter levels. Quarter levels are key psychological zones that price reacts to over and over again across all markets and time frames. They're based on round number psychology, which affects everyone from institutional traders to algorithms to emotional retail traders. Major quarter levels. Okay, so we're getting into numbers now. So we have 0.00, 25, 50, 75, 100. These act like magnet zones. Price often stalls, bounces, or reverses here. Minor quarter levels: 12.5, 37.5, 62.5, 87.5. These serve as secondary reaction zones, often used in trending markets. And we have micro levels, so every 5 or 10 units, so 105, 110, 115, etc. Helpful on intraday charts or scalping models. Also can be read as whole numbers, half levels, quarter levels. So I'll let you read that yourself. And sometimes people say quarter point level. There's just so many different names for them. These levels give us structure in what appears to be chaos. They're not magic line, they're psychological battlegrounds. Institutions use large orders. They need clean levels to enter without slippage, manage risks with size, trick retail traders into giving them liquidity, which I talked about in the past. Like sometimes that's the case, sometimes it's not. Quarter levels help them to do that. They're often the levels where liquidity is stacked, stop losses are placed, breakouts or fake outs occur. When you understand how these levels work, you stop guessing and start predicting behavior. So how we use quarter levels in the system. We use quarter levels for precision limit entries. Precision. When you talk about sniper entries, it's really interesting to me when people say they have a sniper entry, but they hit the market order. Very rarely will you have a sniper entry that's a market order. The most sniper entries are limit orders. Think about it. If you wanted to get in at exactly $100, you're not going to get on exactly $100 with a market order. It's not going to happen. Slippage and all that other stuff. But if you put your limit order there, you should get filled at that price depending on what you're trading. All right, so limit order entry, setting TP targets, defining structure, trend, context, framing zones of reaction, not prediction. You're trying to catch the exact bottom. How we use quarter levels in the system. You're not trying to catch the exact bottom. Sorry. I get jammed up sometimes myself. So you're not trying to catch the exact bottom. You're trying to enter where the risk is lowest and the reaction is most probable. Quarter levels are the structure you've been missing. Most traders rely on patterns or lagging indicators, trade based on feel or confirmation, can't explain why they enter or why they lose. When you trade with quarter levels, you know exactly where price is and what it means, can anticipate reactions instead of reacting emotionally, have a clean system for entries, exits, and bias. So Now we're going to get into my Solana quarter levels indicator. Built out of necessity, this custom tool automates the process of marking quarter levels and gives you real actionable context. Probability price reaching the level, so it gives you the probability of reversals or price reaching that level. The number of historical reactions, so bounces or rejections, the estimated time it may take to reach the level, strength score based on confluence and reactions. This isn't just a visual, it's a decision making tool. So here it is in real time. And I like this tool because it's one of the tools that's just pure objectivity. And objectivity is what you really need in a market where you are left to subjectivity to decide on what you are going to do when you're taking a trade. Now, once again, I don't want people to overly rely on indicators, and I'm not also going to demonize indicators because they're very useful and helpful, and a lot of people use them. But I don't want your screen to be cluttered and filled with them, and you'll see an image of that in the future. But so let's take a look at this real quick. So let's read this from left to right. Price was consolidating at 152.50. It fell below it and it stopped exactly at 150. Had a bit of a bounce there, but then there was still too much supply and it pushed all the way down, and it didn't even try to attempt to stop at 147.50. Reclaimed 147.50, double bottom, lost the level again, reclaimed the level again, double bottom at the level again, and pushed all the way back up to 152.50 where there was previous supply here. Had a nice battle over here, fell all the way back down. Mind you, there was accumulation going on over here, so it fell right back down into the accumulation zone. It was too strong to retest 147.50, pushed all the way back up, stopped exactly at 152.5, pulled back to 150, double bottom at 150, pushed up again, absorbed all the supply, and then ran. Once all the supply was absorbed, it just ran. But this is a good expression of how the market is. Like, sometimes stuff like this is going to happen where it's not going to stop exactly at the level, and then sometimes it will stop exactly at the level, like it did here at 150. It stopped exactly at 150 and then reverse. It stopped it exactly at 152 twice and then reverse. So it's just like, don't expect the market to do something the same way every single time, because it does not do that. This is gold. So if you take a look over here, it overshot 33.65, rejected, came all the way down exactly to 33.50, reversed, and pushed all the way back up. So now there's a 64% chance that the market is going to retest this level, and the probability increases as the price gets closer to it. So this is just kind of like imprinting the levels on your chart, giving you valuable information, like the level that it's at, how many reversals have been there, the probability of it getting there, how many reversals it's been is right here, and the amount of time that it might take to reach that level. So it's saying about 30 minutes it might take to reach this level, with a 64% chance of reaching that level. And the further it gets away from a level, the less of a probability of it reaching, going back to that level. But it's estimations. It's estimations and probability factoring. All right. So this is EJ. So we first took a look at crypto, gold, which is a commodity, and now we're looking at currencies. So same thing. And if anything, this has been really clean. If you look at EJ, I've been trading EJ a lot lately, actually. So 169.5, we've had supply here. So rejection, and then reversal all the way back down to 169, lost 169, came all the way down. You probably can't see it now, but came all the way down to 168.50 down here, pushed all the way back up, and then it started to chop. So there was really no confluence with any of these zones. It was overshooting levels left and right. And once again, that will happen, and you can handle that by having a wider stop. Came exactly to 168.50 with exact precision, and then pushed all the way up, stopped at 169.5, chopped around there, broke, retested 170, clean retest, and basically a double bottom or a triple bottom, 1, 2, 3, then pushed all the way up and then pushed almost to 172.50. Look at this key level rejection here, 171, double bottom here. You might want to take a long here after you see this rejection and exhaustion, meaning that sellers can no longer push the price down. That's an entry signal. And it pushed all the way back up. So notice how 169.5 is a key level against that fire emoji, because look how many times the price reversed at this level. And the look back period probably is accounted for more. It says 21 reversals off this level. So this is clearly not 21 times, but there's a lot of reversals off this level. So I find this indicator very useful and I use it every day. And if you also want to use it, the link will be in the description box below for you to use it as well. So most traders guess. So let's talk about why this indicator changes the game. Most traders guess. You'll know. No more drawing levels by hand, instant clarity on which quarter level matters, avoid fake setups with weak context, stack the odds with real historical data, simplifies decision making in volatile markets, clarity equals confidence. And I've said that before, but clarity equals confidence, clarity equals confidence, clarity equals confidence. We got to say it 3 times, okay? This tool was built to remove hesitation and to help you act with precision. So let's talk about liquidity and stop hunts at quarter levels. So why does price often fake out around quarter levels before moving? Institutions and market makers manipulate price to create liquidity before large moves. How stop hunts work at quarter levels. Traders place stops just above or below quarter levels, and you saw that in the chart where market is just chopping around between those levels. Market makers push price beyond the levels to trigger stop losses. Once stops are cleared, price moves into the intended direction. And a lot of people who worked in banks who are now retail traders have said this sometimes, where they will push the market below a key level, absorb all the orders, and then push it in its intended direction. It's tough like that sometimes. So quarter levels often act as liquidity traps where price sweeps before reversing. Market makers engineer stop hunts just beyond quarter levels to trap retail traders before moving price in the intended direction. Understanding this behavior helps traders avoid false breakouts and improves entry precision. I love that word, precision. So this is a beautiful example on NASDAQ. So I didn't put an orange line down there at 1950, but you can clearly see that price stopped at 1950 in that blue box down there. Then it went up to 1975 and it didn't even stop like it did the first time. It just closed there, pushed, gapped up, and then ran, broke 20,000, retested, bullish engulfing candle. Guess what? It's up next. Guess what? Broke 20,250, broke retest, inside bar reversal. Guess what? 20,005 is next. Just like that. Very clean price action on NASDAQ. So here it is on a stock called Carvana. So the most recent thing that happened in this specific image is that Carvana tested 222. I want to say, is that right? 222, even though it's it says 2297 here. That's where the market was post. So the market had support at 200. You can see that it tried to push up and reverse and then gapped down and then sold off. It consolidated at 175, completely overshooting the level about 3 times here. It overshot the level, but every time it overshot the level, buyers stepped in to buy the dip at 175 because they saw that it was a value area, and it reversed off this level and went straight back up. So one would assume that if it breaks this level, it's going to 250 next. So I get it. I understand now. So this is 225. Sorry, I didn't work that out myself. So this is this should be 225, and this is 250, and this is 275, and this is 300. So yeah, it's moving in quarter levels here. So this is 125 on Solana. We found support here at 125. I think I even took this trade at 12750. So we broke this level, retested it, pushed all the way up to 130, couldn't sustain it, retested as resistance, pushed back down, was too bullish to retest 12750, reversed, broke, retested the level, inside bar, reversal candle off of 130, pushed all the way up to 132.50. Once again, now have demand, pull back, too bullish to retest 130, reversal, holding the moving averages, entry signal over here, stop loss below here or below 130, and then it pushed all the way up basically into the sky. All right, so here's an example of a trade. This is Bitcoin. So this was Bitcoin when it was at 82,500, so 82,500. You can see I took entries exactly at 82,500. I was in very minimal drawdown. It reversed. I took TP1 here, TP2 here. It even retested 8250 before moving up to trying to attempt to retest 8,500. Now, mind you, when you take these trades, you don't have to hold for it to get to the top of the range. I view each one of these levels as a range, and you don't have to hold for it to get to all the way to the top of a range. You just need a high probability setup, and it's been trending up, higher high, higher low, higher high. This is a higher high, a pullback. It's gonna probably make a higher low and a higher high, but I didn't want to hold for that, so I just entered here to a little bit here, a little bit here. I could have held for 85,000, but who knows? Maybe it was a Friday and I didn't want to hold over the weekend. Like, there's so many different reasons why I close trades early, but you could have taken these. Well, obviously this is counter trend trade, right? But once this double bottom here, and if you saw this exhaustion wick on this bear bar, ideally you could have got in at 7,705, 77,500, excuse me, and then maybe put a limit order on the retest once we had this impulse move up at 80,000, pushed all the way up to 82,500. You possibly would have got chopped up over here, placing a limit order here because it was just too much supply. Mind you, it's below the 200 moving average, which is this blue line here. So had a nice pullback to 80,000 again, and then went straight through this level like a knife through butter to 85. So price action is very random sometimes, but the quarter levels give us structure and an idea of where we should be taking our trades and where we should be taking profit, so that we're not guessing and monkeying in the middle of a range, you know, getting chopped up left and right. So I think this is Solana again. I probably added this here because it's really good, really good price action here at these levels. So look at this 190 level, support, went straight up, resistance. It went through the level, look, fell through the level, resistance again, support. Like, look at these lines. These are whole numbers. These are quarter levels. Like this matters. You know, this is 190.5 here. Look, support went up to what? 191.5. Like, these are not random numbers, guys. Like these I'm telling you, like, these levels are important. It's just human nature to round up. Like, do you want to type in 190 or do you want to type in 192.876? Like, no one wants to do that. You're going to round up. And that's what algorithms do. That's what human nature is. And that's why these key levels are so important. So I want to help you not have your charts look like this, because believe it or not, my charts used to look like this when I first started out. You know, I had trend lines everywhere because I'm just like, okay, it can react here, it can react here, it can react. Listen, just use the quarter levels, guys. Please. Trading psychology, why quarter levels improve discipline. Quarter levels provide structured trade locations, removing uncertainty from entries. They prevent emotional trading by enforcing a rule-based system. Traders who use quarter levels avoid chasing price, leading to more precise and consistent trades by waiting for price to come to them. Traders develop patience and discipline, key traits of professional trading success. Key takeaways: Price moves because of an order, flow, and balance, not magic. Most retail education is storytelling, not mechanics. Quarter levels gives you structure, targets, and confidence. This system uses quarter levels for sniper entries and high probability targets. You're not here to predict, you're here to trade reactions that repeat. If you would like to get access to my quarter levels indicator, the link will be in the description box below. It will level up your trading so you don't have to guess. You can use it to have a strategic map towards entering the markets. I'll see you in the next module. All right, welcome back. This is module 10, win rate, risk to reward, and entry models and negative risk to reward, which is in RR. Our objective in this module is to build true confidence. You need to know exactly why your strategy is profitable. This module will teach you how win rate and risk to reward interact, how to build your personal edge around these numbers, and how to structure your trades in a way that makes math your ally, not your enemy. So what win rate actually means. Let's get this out of the way now. A win rate does not automatically make you profitable. A high win rate does not automatically make you profitable. It just means you win often. But if your win rate drops and stays below your break-even rate, you're losing money and fast. On the flip side, a low win rate doesn't mean failure either. A trader can be right 30% of the time and still be crushing it if they're consistently pulling 3R, 4R winners. Win rate is just one variable in the equation, not the full picture. You can be wrong more than you're right and still make money if your winners are bigger than your losses, your losers. This is from legendary trader Paul Tudor Jones. What risk to reward actually measures. Your risk to reward ratio, RR, tells you how much you're aiming to gain relative to what you're willing to lose. But here's what most traders get wrong. They aim for big R with no realistic probability of hitting it, or they go for small wins with no discipline to actually take profits before a reversal. You can't build consistency on fantasy targets. You need to know your numbers and work within your edge. So this is a very important and powerful chart. Please take a screenshot if you need to. Risk to reward and distance to take profit comparison. So let's start with a 1-to-1. So your break even rate for 1-to-1 is 50%. TP distance if SL is 10 equal to SL, so it's equidistant to your SL. Let's go to negative now. So 0.8, you need a 55.6% win rate to break even, and your TP distance is moderately away from your stop loss. 0.7, you need a 58.8% win rate, and your TP distance is even more closer to your entry. Sorry, yeah, so I was saying that wrong. So this is how far your take profit is versus your entry and your stop loss. So this means that it's moderately away from your entry, slightly close, and very close. So if you're going for 0.3 risk to reward, your take profit is extremely close to your entry, therefore your winning percentage will be very high, but you need a 76.9% win rate to break even, meaning you have to make above this number to be profitable. Now that could be either very difficult or completely easy depending on your edge. Now let's go to the positive risk to reward now. So 1.5, you need a 40% to break even. It is 1.5 times further from your entry. A 2R is 2.2 times further than your entry. You need a 33% win rate to break even. 2.5 is 2.5 further. I think you get the point. And a 5R is 5 times as far as your entry, and you need a 16.7% win rate. So why don't we all just go for a 5R? Well, this doesn't take into consideration the probability of winning the trade. This just tells you how far it is from your entry. So what's the probability of your take profit being hit if your take profit is 5 times further than your entry versus perhaps let's go for the 0.5? Well, the probability is significantly higher that if you have a 0.5 risk to reward ratio, basically a negative risk to reward ratio. So you're risking 1 to make 0.5. So you're risking 100 to make $50. You're more likely to hit TP on this one versus risking 100 to make 500. Now that doesn't mean don't go for those type of trades of risking 1 to make 500. If you have an edge that's, comparable and it works for you, that's fine. But the reason why the average retail trader fails is because they're always going for these extremely ridiculous multiples on every single trade when they don't have an edge that would indicate that you can even get a return like that on your trade. Whereas if you go for even just a 1-to-1, it's more likely to hit your take profit rather than anything above a 2.5 to 5R. So just wanted to put that in perspective, that the closer that your take profit is from your entry price, the more likely you are to win that trade. But the trade-off is, in order to consistently remain profitable, you need to maintain very high win rates. All right, so what risk reward actually measures, what this teaches. So for a negative R, if your TP is closer and more likely to be, it's more likely to be hit and frequently, but it requires a higher win rate, which I just explained. In a positive R, TP is further, which means fewer wins, but larger profits per win. A neutral 101 is a balanced approach. TP and SL are equidistant. And mind you, none of these are better than the other. It just matters more on with your edges and expected value of your system. So the key takeaway for students is this isn't about which ratio is better. It's about understanding the trade-offs. Closer TPs equal higher hit rate but smaller reward. Further TPs equal lower hit rate but bigger reward. Figure out what type of person that you are. Figure out what type of edge that you should use, and then follow suit. The simple math that tells you if you're profitable is, we talked about this, is the profitability equation. Win rate times average win minus loss rate times average loss equal expectancy. Let's look at two examples. A low RR strategy with a 75% win rate, average win of 0.7R, loss rate of 25%, average loss 1R. Expectancy equals 0.75 times 0.7 minus 0.25 times 1 equals 0.525 minus 0.25 equals plus 0.275R. So I said all of that math and jargon just to say that this system has a positive expectancy so long as your win rate is maintained. So for a high RR strategy, your win rate is 35%. I'm not going to read all this again, but at the end you walk away with 0.40R, which is another system with a positive expectancy. Notice how the profits on this system is greater than a negative R system. But once again, you need a system in which you can consistently maintain a certain win rate. So if your win rate drops below 35%, this system will no longer work for you. Both are profitable, but they feel very different. Strategy A wins often, but the gains are small and require high precision. Strategy B wins rarely, but pays out big, emotionally harder to follow. Neither is better unless it fits your personality and psychology. After extensive forward testing, here's a solid model for stacking wins. 90% of the trade is closed at 1 or 1.5R. 10% is left to hit 2 or 3R to get trailed using a 10 EMA, or you can use market structure or whatever you want. This is just a 90-10 model for satisfying the desire to win often, and also trail your stop in case you get a runner. So this is the 90-10 model. So it locks in consistent profits. 1R is realistic and repeatable. It leaves room for extension plays without needing to force a home run. The 10 EMA trail gives structure for runners without emotional bias. This model blends the best of both worlds, consistent core profits and the opportunity for more. I should definitely suggest this for people who are not yet profitable to experiment with the 90-10 model. Remember, I want you to think with principles and not memorize patterns. Taking partials lets you secure gains while holding for the potential of a trade that runs, and it does not have to be 90-10. It can be 80-20 or any other split where the first half of the trade is taking off most of your position. That's very key. So the first take profit needs to take off most of your position. This is a model for consistent profits. And mind you, if you are taking 90% off at a 1R, that is a negative risk to reward, because if you're risking 100 and you take off most of your trade, and let's say your profit is $80, well, you effectively risked $80. You risked $100 to make $80 with the potential of making more. So please do not let these influencers misguide you into understanding how risk to reward actually work. I certainly remember in my early days when I was studying under very, very prominent figures in the trading space, where someone said that doesn't your risk to reward change if you take partial profits off? So if you take most of your profits off at a 1.5 R, doesn't that change the risk to reward model? And the influencer said nobody thinks like that. And I'm just like, okay, that's ridiculous, because it doesn't matter if no one thinks like that. It's just the math. The person was right in asking the question. Like, yeah, that's correct. You are correct. It doesn't matter if no one's thinking of it like that. Like, huh? What are you talking about? Anyways, you don't need to hit home runs. You just need to stop striking out. So here's an example of a trade that I took. This is, I think, possibly a higher time frame trade, daily break and retest or something. I'm not really sure, but I know this box right here is resistance. I entered, I sold into strength. I didn't actually wait for it to turn. It was basically, it looks like it was most likely a 1-to-1. It might have been, it looks like it's a little bit over 1-to-1. I'm not sure, but anyways, I took most of the profit off right there. So there you go. So this is a double SNR model. This is another model that I use. For this model, your stop loss will be 2 levels away. This is why it's called the double SNR. You are using that second level of SNR as an insurance policy, hoping for a reversal. This is helpful when trying to mitigate a loss from a failed trade. All right, so this is an example of what it would look like. I didn't take any trades like this. I'm just showing you like how far your stop loss would be if you were using quarter levels. So let's say you went short right here, and oh no, I'm in drawdown. Well, if the market moved all the way back up here, another trade would be open, and then you would have either closed this for break even or let that trade run for take profit. But this is what I mean, where it's just double SNR. Like, if you have the idea that these key levels are psychological resistance levels and you're anticipating a reversal at these levels, then you can place your stop loss 2 levels away and stomach the drawdown. Don't be emotional about it. That's what your stop loss is there for. But it gives your trade the opportunity to recover and not take a max loss on it. And then if you have this trade that was basically, if this went all the way up here, it would have been in 0 drawdown. So you would have had 2 trades open, and this would have won, and this would have lost if your stop loss would have been super tight, but it didn't, and you would have won the trade. So here's another one on another yen pair. So let's say you're looking for a break and retest of this key level. As you can see, it definitely hit, but it didn't go all the way up there initially. It popped, and then it went to drawdown, and then perhaps maybe it would have came over here, but it didn't. It went all the way back up. So that's what I mean about having your stop loss 2 levels away. So this is a profit that I had on using this model on Radium. So caught a nice move on radium. I think that screenshot is in here somewhere. So the high R model, for this model, we are focused on catching high R with runners in order to catch a big trade. Oh, okay. So this was the big trade. Sorry, I should have read this up top. So this was the high R model. So I caught a big trade on radium. So you will look for 2R minimum, but ideally you're looking for 3R. Your stop loss will be tighter than normal, so be prepared to lose. Remember, high R means more losses, so bet smaller than usual and expect to lose the trade. It will be a good way to practice patience. So this is a trade that I took on radium, and I was using a harmonic framework with divergence on the momentum indicators, and it was at a key level. I think it was at $2 here, and it was at a daily support and resistance level. So entered the buys, and my God, did it pop. I mean, these are the type of reactions that you can get sometimes in the market, and this is why, and when you're going for the high R model, you don't set hard targets, you set alerts so you can see what happens at those key levels, because it could continue to run. In this circumstance, I think I actually did have a hard take profit, but it slipped so far that it closed my trade at the very tippy top, like the very tippy top. So that was just serendipity, like it worked out. So sometimes you can get these reactions with the harmonic frameworks, but yeah, I caught a nice trade on this one. So this looks like a yen pair, and this one ended up running. I think I took partials here, and this is clearly ran for a 2R. Yep, so this is a trade that my indicator gave me. So you can see the entry right here, the stop loss, and a TP. This one ran for 2.5R, and it basically was a break and retest. Like, we lost this key level. I placed a limit order right here. I wonder if this was Jupiter. It looks like it's Jupiter, looking at the price, 40 cents. Yeah, this is most likely Jupiter. So it retested this level. I sold, and it ran for 2.5R. It's important to look for these type of trades because they will balance out your equity curve should you lose your high win rate trades. It feels bad as to catch a big move like that. You know, we don't necessarily trade for emotions and stuff like that, right? But I mean, if you catch a crazy move, like, it feels pretty badass. And that's kind of a part of trading, is to, you know, catch those moves, but you'll never catch those moves if you don't plan to, if you don't have a strategy where you can capture that upside, which is why I'm a fan of scaling out. There really isn't any difference in the strategy when it comes to these models. It's just where your exit and your take profit is. Even if you're aiming for, so this is why win rate still matters even with a solid RR. Even if you're aiming for a 2R or a 3R, you still need a win rate that makes your strategy work. If your win rate drops to 20%, 2R doesn't save you. That's why I track everything, and why I encourage you to separate experimental accounts like high win rate scalping from your main strategy so you don't muddy your data. Tracking these stats lets you know when your edge is still alive, when the market may have shifted, when you're just in variance versus truly underperforming. Data equals clarity. Without it, you're just guessing. And man, that's so true. The balance you must find. This course will not tell you only trade 2-to-1, or, you know, only look for 3Rs, or only trade negative risk to reward. You know, like, that's not what I'm here for. I'm just giving you the data, the information, and I'm leaving it up to you to decide what works for you, because ultimately there are people out there who are gonna want to trade 2R, 3R, and there are people who are going to want to trade negative risk to reward, so 0.5, 0.7. What I will show you is how to find the balance that works for your psychology, your time frame, and your risk tolerance. The moment you stop chasing the perfect number, instead focus on what's consistent, is the moment you become dangerous, in a good way, of course. All right, so let's clear some common myths that blow up traders. You need it should be a 1 to 3, because I always say a 1 to 3. But anyways, you need a 3 to 1 risk to reward ratio to succeed. Not if you're winning 70% of your trades. More wins equal better trader. Only if the wins are meaningful. High R strategies are best. Not if you can't emotionally handle 6 losses in a row. I was just talking to somebody in my Discord server about this, how he couldn't handle 5 to 6 losses in a row. And you guys need to be able to handle that, because that's exactly how variance work, especially on a high R system. Set and forget works best. Not always. You need trade management that adapts to the context. There's no one size fits all RR. There's only what works for you and what works in the current market environment. What about negative risk to reward trades? Okay, let's talk about something that 90% of traders avoid or misunderstand completely. Can you be profitable taking trades with a negative RR? The short answer is yes, if the win rate and trade context support it. Okay, so what is a negative RR trade? A negative RR trade is one where your reward is smaller than your risk. So you risk 20 pips, you aim to make 10 to 14 pips. That's a 0.5 to 0.7 R trade. Most traders would tell you that's a bad RR, avoid it, but those traders don't understand probability. You can enter at the heart of the reaction zone. Your take profit gets quickly hit. You get multiple quality setups per day. You can build daily gains instead of relying on rare runners. That's what consistency is. Negative RR works if your win rate is high enough to support it. So let's break it down. RR is 0.7, win rate 70%, and let's skip to the expectancy, 0.19 R per trade. So that's a positive expectancy, so it works out. Now do that across 100 trades. That's 19 R of edge. 19 R of edge. Consistent emotionally easier to follow, high feedback, more frequent wins. It's really good for getting data. It really is really good for getting data. So negative R trades work but require mastery. For most traders, these setups are advanced and harder to manage because you need a very high win rate, 70 plus, to stay profitable. It's easy to slip into revenge trading or emotional scaling if you don't have strict rules. After a losing streak, it becomes harder to maintain the edge required to trade these setups effectively. Professional institutions that use negative R, guess what? The institutions use them, guys. Your favorite people. Of the biggest misconceptions in retail trading is that all professional traders use a 2 to 1 or a high RR. In reality, many of the largest, most consistent firms in the world use negative RR frameworks because they understand how probability and order flow work at scale. All right, so market makers provide liquidity by constantly buying and selling both sides of the market. Their individual trades often have extremely tight take profits and wider stops because their edge is based on high frequency, high probability execution, not large individual gains. The entire business model is built on small repeatable wins with low RR and a very high win rate. They profit from flow, not big moves. Get that into your head. They profit from flow, not big moves. High frequency trading firms. HFT firms like Citadel, Jane Street, Virtual Financial execute millions of micro trades per day. Their average trade might aim to capture just a fraction of a cent while remaining slightly more, right? Risking slightly more. Their win rate is often over 80 to 90%, and their edge comes from efficiency, reaction speed, and scale, not RR ratios. These firms prioritize consistency and mathematical edge over textbook reward multiples. All right, Citadel Securities, one of the largest market makers and high frequency trading firms in the world. They operate with ultra tight spreads and aim for fractions of a cent per trade, often risking more than they make on each position. Their model are built on liquidity provisions, internal hedging, and a win rate that exceeds 90% in some systems. Their entire business runs on a negative RR with extreme precision and scale. Okay, Jane Street is another one. They operate with a probability-based mindset, so their focus is edge per trade, not RR per trade. Virtual Financial, another one. Their average trade might risk $100 to make 50, but at scale, consistency, they rake in billions with a B. Tower Research Capital, another one. Their models are built on math, not textbook trading psychology. So these are multi-billion-dollar firms. They have access to better data, better technology, and deeper liquidity than any retail trader ever will. Yet they choose strategies that use negative RR when the math and market conditions make sense. You're not doing something risky by using a negative RR. You're doing something that's smart, that you're using something smart and backed by industry leaders. So the key takeaway is that if firms like Citadel, Jane Street, and Virtual can thrive using a negative R strategies, so can you when it's backed by clear edge and disciplined execution. So this is a negative RR trade that I took. I entered here. This is the ticker ALU. I took most of my profit here. My stop loss, I don't think I have it shown on the screen, but it was far away. I took profit here and I scaled out. And what do you know? I sold at, I believe this is like a double SNR. So I sold at 445 and 475. Those are quarter levels. So boom, boom. And then I was in drawdown on a first position, scaled in, and it rolled over. So this is the power of using a negative risk to reward. This is another one on the SPY, actually. So I was going for a double. Well, on this one, I don't think it was double. It was just a stop loss that was far away, because double would have had my stop loss a bit too far. But anyways, I entered, I took profit, and I think I was still holding for this one to get hit. So where it works best is scalping, intraday setups at strong levels, high win rate models built on precision and reaction zones, trades with fast enough target hits and short holding times, early entries during reversals with tight invalidation. In fact, many institutional firms and market making models operate on negative RR logic. They can just scale with massive consistency and size. So here's what to watch out for, because this is not a holy grail. Negative RR trades are not an excuse to be reckless. They must be back tested, data supported, emotionally sustainable, contextually high probability. You cannot afford to let your losers run. Your edge disappears fast without discipline. All right, so here are the key takeaways for this module. Negative RR trades can be profitable with the right win rate and context. Don't ignore these setups just because they don't look good on paper. The edge is in the math, not the ratio. This is a bar, write that down. The edge is in the math, not the ratio. If you're using a high precision system, this approach might give you more consistency, more confidence, and more control. Continuing on, so let's continue to understand these risk to reward ratios. So a 1-to-1 risk to reward ratio is the balance trade. That means you're risking 1R to make 1R. If you risk $100, you're trying to make $100. It's pretty straightforward. Psychologically, it's easier to reach. You can hit a pretty decent high win rate for consistent equity curve gains. Often aligns well with reaction-based trades at strong levels, works great in choppy or range-bound markets. So it's a pretty versatile RR. So the cons are, it requires a win rate of 50%, greater than 50% to be profitable. It's a slower equity curve growth, and that's true based on your position size. If your position size is always the same, then yes, that'll be slower. So you can make mistakes like holding losers, slippage, spread can wipe out your edge quickly and erode it. So here's a 1 to 2. So you're risking 100 to make 200. The pros are you only need a win rate above 33% to be profitable. Easier to maintain emotionally versus higher R trades. Still offers enough upside to make real account growth. Claim balance between frequency and reward. The cons are it can lead to more break-even days or losing streaks, and that's usually difficult for most traders to deal with. You can get stopped out before the market hits your target, and it requires discipline to hold and not grab the bag too early. So it's best used when you're trading with a strong level, clear directional bias, a trending market. You're willing to hold through small retracements and you trust your back testing and forward data. And then lastly, a 3 to 1. So you're risking 100 to make 300. So you only need to be right 25% of the time to be profitable. You get huge gains when it hits, and it builds your account equity very quickly when executed. So it's great for swing trading and trending markets. The cons are requires complete emotional detachment because you are going to lose a lot. Many traders take profits way too early. Easier to enter losing streaks that shake your confidence. In many markets, it's less frequently achieved and can lead to frustration and system hopping if not managed properly. So it's best if you caught the trend early. There's momentum, structure to support a longer move. You've built a position with partials already banked in. So at 2R, you have already taken a little bit of TP. So these are like the key psychological differences between them. So your mindset might be for a 1-to-1, let me just grab this win, which is what scalpers do. For a 1-to-2 is, can I hold through the noise? And a 1-to-3, what if it comes all the way back? Man, let me tell you, you will experience this one on even these trades if you're not psychologically adept. The higher RR, the greater the emotional challenge, even when it's the right setup. Most traders don't fail because of bad systems. They fail because they can't hold long enough to let good trades play out. So the final thoughts for picking the right RR for you: there is no perfect RR, only the one you can follow with discipline. 1-to-1 is great for confidence and consistency. Most scalpers use this ratio. 1-to-2 is ideal for most prop firm traders and swing setups. 1-to-3 is for trending markets, clean structure, and runners. So the key takeaways, once again, profitability equals win rate times reward minus loss rate times risk. You do not need a high win rate or a huge RR. You need the right balance. And if you are not profitable, focus on the 90-10 profit split model. So you take 90% at 1 or 1.5 R, 10% at 2 R, or 3R trailed. Track your data separately if you're testing different models. Your edge lives in your numbers. Know them and own them. That is all I have for this module. That was much longer than the usual ones, but I really wanted to go into detail and be thorough with this information and hope that it provided you a lot of immense values. And yes, be prepared for the next module. I'll see y'all in the next one. Okay, this is module 11. The different styles of trading. Pretty straightforward. This objective is to help you identify which styles of trading best fits your mindset, lifestyle, and goals, and to understand the trade-off of each. Most traders fail because they try to follow someone else's style that doesn't suit them. This module gives you clarity and ownership over how you want to show up in the market. There is no one right way to trade. There is only methods that fit your emotional bandwidth, availability, and personality. Some people need fast feedback. Some people thrive with patience. Some want one great setup a week. Others want to be in and out of the market before their coffee gets cold. The style you choose must match you or your self-sabotage, no matter how good the strategy is. And speaking from experience, that is 100% facts, man. The three primary styles of trading, let's break it down. Scalping. So scalpers usually work within the 1 to 5 minute charts. Their hold time is seconds to minutes. The pros is fast feedback, lots of setups, high win rates are possible. The cons is emotionally intense, very low RR unless precision is perfect. Best for traders who can focus deeply for short periods, don't mind taking many small wins, and are extremely disciplined. The 3 primary styles of trading, let's break it down. Intraday / day trading. Time frame 5 minute to 1 hour charts. Hold time is minutes to a few hours. The clean structure. So the pros are sometimes you'll have some really good clean structure, and you can trade based off of levels and context, and balances the speed and clarity. So it's kind of like in between. The cons, it requires availability during market hours, and you must act fast on entries depending on what type of time frame you're on. It's less so on the 1 hour, it's more so on the 5 minute. Traders who like a mix of logic and speed and have a few hours a day to focus. Then there's swing trading, so that's the 4-hour daily charts. The whole time is days to weeks. The pros are it's big RR potential, less screen time, more strategic. The cons are requires patience, longer drawdowns, and slower feedback. So it's best for traders with limited time who wants to set it and monitor. So it's this is good for people who don't really have a lot of time. So maybe you're at school, you're a business owner, you just don't have time to be at the computer all day and babysit trades. So this is just one of the things that I use, and we talked about it in the last module. So the 90-10 split. So I have a swing model and I have an intraday model. It just depends on what I'm doing, but my entries are always at quarter levels or around quarter levels. Usually use limit orders, and it depends on the market conditions, but I could be doing 90% at TP1, which could be a 2R or 1R, and I'm leaving 10% to run. I'm usually scaling out. So all of this could just say I'm scaling in and I'm scaling out. So this gives me the freedom to let trades work while keeping my risk structured and my execution clean. I also occasionally experiment with high win rate setups. Usually they're negative RR, but once again, it's contextually dependent upon what's happening inside of the market. So this is why people fail when they pick the wrong style. They try to scalp with a full-time job and can't focus. They try to swing trade, but check the charts every 5 minutes. They use strategy that requires 3R wins, but close at every trade at a 0.5 R because, you know, they don't know how to hold their trades. They chase whatever seems hot, not what fits them. A winning system in the wrong hands is like it's like a losing system. So how to pick the right style for you? Ask yourself, how much time can I realistically spend in front of the charts? Do I like fast decisions, or do I prefer to plan and think? Can I handle drawdowns, or do I need more consistent feedback? Do I want fewer trades with bigger wins or more trades with small wins? Your answers tell you who you are as a trader, and that tells you which path to follow. There is no best trading style, only what's best for you. Scalping, day trading, swing trading all work when done properly. Match your style to your psychology and your schedule, or you'll burn out. I found my edge in swing trading quarter levels with precision and structure, but once again, I still intraday trade. Know your strengths, then build your system around them. So that was a very quick module on the different styles of trading. I hope that was powerful and informative. I'll see y'all in the next one. All right, welcome back. Module 12. Not all markets are the same. So our objective is to help you understand the unique structure, behavior, and influencing factors across different markets so you can apply your strategy in the right context and avoid mismatched expectations. Each market has its own mechanics, psychology, and participants. What works in one market may not work in another. Applying a strategy blindly across market leads to inconsistency and frustration. Success depends on strategy, market alignment, not just having good setups. All right, so these are the efficient versus inefficient markets. Efficient markets are the S&P 500, Euro USD, and major indices. Algo dominated high liquidity, fast reactions. And efficient markets are penny stock, meme coins, and some altcoins. Emotionally driven, volatile, easy to manipulate. Inefficient markets offer bigger opportunity, but also big traps. Efficient markets offer structure, but fierce competition. So market specific behavior and influencing factors. Forex, influenced by macroeconomic central banks and global news, has consistent liquidity and structured movements. S&P indices, zero spreads, great for scalping, mostly algorithmic with clean reactions to levels. Market specific behavior, influencing factors. Crypto is highly volatile and emotionally reactive. Many assets lack fundamental value and can lose 90% or go to zero. Penny stocks, most are failing businesses or pure speculation, often gap up and then sell off, susceptible to pump and dumps and short squeezes. Meme coins, driven entirely by social sentiment, zero fundamentals, total inefficiency, often rug prone. Your system must account for what actually moves the market if you're trading. I'm not telling you don't trade meme coins, because there are people who have made, thousands, millions of dollars there for sure. But please understand that there are way more people who've lost all of their money than people who've actually made money in meme coins. Liquidity and volatility considerations. The S&P is deeply liquid, and stable. GJ might dry out after London sessions. Crypto is 24/7, but the volume and volatility vary. Liquidity impacts field quality, slippage, and how clean levels hold. All right, so regulations and stocks. You are subject to the PDT rule if your account is below 25K. So you are limited to, is it 3-day trades, I believe? So if you buy and sell 3 times in 1 week, is it 1 week? I think it's 1 week. Then you have to wait until the next week or something like that. It's something absolutely freaking ridiculous. Totally intended to gatekeep, but whatever. Which is why I definitely love crypto. And I also like forex as well. But crypto is open 24/7 globally. It's often unregulated, but there are plenty of brokerages that you can use depending on the country that you're in. Forex is accessible, but also depends on your broker and region. In the United States, we have the first in, first out rule, which totally just is a pain in the ass to trade with. So take that in consideration. If you are using a regulated broker, do your own due diligence if you're using an unregulated broker. The rules of the market shape what's possible. Don't ignore them. Okay, so strategy, fit, and psychological match. So are you structured and calm? Then the trading indices might be for you. If you thrive on chaos and speed, crypto or penny stocks could be a good fit for you, especially if you like the short pump and dumps. You might have an edge in the FX, but it disappears in low float stocks. Pick a market that fits both your strategy and your personality. The dangers of trading too many markets are the following. More markets equal more macro to follow. More assets equal more decision fatigue. Each market has its own timing, volatility, structure, and specialization gives you depth. Generalization gives you distraction. So I would say limit your markets. If you're completely new, just try to limit your trading to 2 assets. For the love of God, like, you are going to just have a watch list full of 20 pairs and wonder why you can't make any money or catch any moves, or if you make money you lose money. It's because you're too distracted. You're trying to look at too many things. You need to focus. Okay, focus. Please just focus. So this is a chart. Once again, take a picture if you need it. So we're going to look at forex. Liquidity is very high, efficiency is very high. Common participants are bank, hedge funds, retail. Volatility is moderate. Influencing factors are interest rates, central banks. The risk is news spikes, new data, and stuff like that. And it's ideal for macro focused swing traders. So people who don't have a lot of time, because currencies don't usually move that fast unless you're trading the yen pairs. S&P and indices. So liquidity is extremely high, efficiency is very high. Algos and institutions are most of the market participants. Volatility is I'm not, this probably is incorrect. It says low to moderate, but it should probably say moderate to high, quite honestly, because it really depends on what's happening in the economy and what's happening with the overall scheme of things. But let's go to crypto. So the liquidity is medium. Once again, depending on the asset that you're trading. Efficiency is usually low, depending on what you're trading. Sometimes it's not so low. The common market participants are retail, bots, and whales, and now it's institutions because of BlackRock stepping into the market, buying up all the Bitcoin, and MicroStrategy doing all their things. So I like crypto. Once again, that's why I spend most of my time. Penny stocks is very same. It's very similar to crypto, just more regulations, and it's the stock market. So you're limited to PDT if your account is below 25K. Meme coins, it's mostly retail inside of meme coins. There are some bigger players inside of it, but it's not like major institutions inside of meme coins. So the key takeaways are: markets behave differently, treat them accordingly. Your edge must match the environment you're trading. Pick markets that align with how you think and react. Efficient markets offer structure, inefficient ones offer chaos. Focus on mastery, not juggling every chart. That's all I have for this module. I will see you all in the next one. All right, welcome back. We are in module 13, Confluence versus Divergence. Now, this is going to be a really major module for some people. This was major for me, and I think if you're at a point where you're not sure why you're losing, like you've got good psychology down, and you've been trading for a while, but you're just like struggling, I think this could be potentially helpful for you. So Confluence versus Divergence is to teach you how to identify confluence in your trading setups and how to avoid trades with too much divergence. This will improve your win rate, build confidence, and reduce frustration from losing trades that never had a high probability of success to begin with. All right, so what is confluence? Confluence means multiple factors are pointing in the same direction. It's the market's way of saying, yes, you're on the right side. In trading, confluence increases the probability of your setup working out. It doesn't guarantee success. Nothing does, but it stacks the deck in your favor. Okay, so here are examples of a confluence bullish setup. Price is above the 200 EMA. Structure is forming higher highs and higher lows. You're entering on a key quarter level. Price has been rejecting that key level repeatedly. Macro data supports your bias, like COT data, showing institutions long USD and retail short. When you stack these together, you're making a probability-based decision rooted in logic and structure. All right, so what's divergence? Divergence is when your trade has conflicting information. You may still take it, but the odds are lower, and you should manage it accordingly. Examples of divergence in a bullish setup is that price is below the 200 EMA on a daily, but structure on the 1 hour is still forming lower highs and higher lows. You have a long-term bullish bias, but short-term structure is still bearish, and this is mixed context. You're buying at a higher low at a key support level, but price is below the 200 EMA on the H1. Market structure is technically bullish, but higher time frame order flow is showing weakness as we trend below the 200 EMA. So why confluence matters? Confluence doesn't guarantee that trades will work, but it guarantees that you're trading with the flow, not against it. Confluence gives you more confidence to execute, a stronger mental framework for holding through drawdown, a reason to stay consistent even after a few losses. Without it, you're just hoping. So practical exercise is to ask yourself before every trade: is price aligned with structure? Are the EMAs supporting or contradicting my bias? Am I trading into a fresh or overused level? Is price reacting to this level or just touching it? Do macro fundamentals support this move? Am I forcing this setup, or is it flowing? If you're answering yes to most of these, you've got confluence. If not, either reduce risk or skip the trade. So confluence equals confidence, and this is the confident trader course. So I'm trying to find all the different things to instill confidence inside of you, and Confluence will give you confidence. So more Confluence equal more trust in your setup. Less Confluence equals hesitation, more second guessing. Over time, your job is to build a system where Confluence becomes automatic, not something you have to force. So I built a tool that helps me find Confluence as soon as possible, because I realized that I was spending way too much time at the charts analyzing. And the thing about analyzing is that a lot of it is just subjective. A lot of it is really just subjective, and I try to find the most subjective things in the market to give me an idea about what I should be doing in the market, depending on the time frame that I'm trading and the overall idea that I'm having. So I built the Solara Confluence Panel Indicator. It's a dashboard style tool that scans high probability setups based on multiple aligned signals. It simplifies your chart by showing only what matters. So we have the EMA alignment, RSI conditions, MACD status, VWAP positioning, quarter level proximity, the ATR, and market structure. And that's just as of now. I plan on adding more things to it. So it generates live Confluence score based on market alignment, offers smart trade suggestion when score conditions are met, automatically plots entry, stop loss, and take profits on your chart, highlights order blocks for added high volume or institutional context, built to simplify this decision making and reduce emotional noise. Know when to act and when to stay out. Instead of checking 6 indicators manually, you just glance at the panel, and if most of the lights are green, you're in alignment for buys. If they conflict, then you might want to stay out. So this is what the panel looks like. This is a zoomed in version. I'll show you the full screen version. So we have the range, the quarter level range. So prices between 150 and 200. Is between 162.5 and 165, so that gives even more detail. This is the step sequence, so it's using 2.5, which is quarter level increments. The ATR is 1.79, 1.79. Yep. So the higher time frame is the EMA 3 and EMA 4. Lower time frame is EMA 1 and 2. Both of those are bullish. The MACD histogram tells you whether the MACD is bullish or bearish, so it's bearish weakening. The RSI tells you how strong the relative strength index is, so the relative strength is basically how strong the asset that you're trading is. The VWAP is usually used for intraday basis, so you don't necessarily have to have that on if you trade higher time frames, but for people who are trading on an intraday basis, that could be a very powerful tool for you. EMA 4 is the 200 period moving average, and this is just the most general and consensus moving average that people use for the highest time frame. So it's 200. And then market structure is the market making higher highs and higher lows, or lower lows and lower highs. So in this circumstance, the 1 hour is bearish. And then it gives you a Confluence score, and then it'll tell you, hey, consider taking a buy at 162.5. This is a quarter level. I believe this might be Solana. And Solana is very reactive to these levels. So it have a stop loss based off the average true range. So this is basically going for a 1-to-1. And that's just what the panel looks like initially, and this is what it looks like on trading view on the right hand side of your screen. And this is that same information just zoomed in. So we have the EMA supporting the price, and right now the indicator is suggesting, like, hey, take buys at this key level, not randomly anywhere, at this key level. So it's telling you to take buys at 160. So it's not actually this last one. So this is a different screenshot. So it's saying, hey, take buys at 160, stop loss there, take profit there. And as you can see, the market came back, it tags you in, literally zero drawdown, and went straight to your take profit. And this thing is constantly scanning for trades, by the way. So it's constantly looking for trades. So it's not going to paint that same, this information right here is not going to stay. It's always looking for trades based off of where the price is and where the price is likely to react from. So it's always scanning for trades. So this was the trade that was forming over here. It enter TP. That's just kind of showing you that the general idea of it works. So this is the EJ, Japanese yen, same thing. Just look at the panel. All these are green, so you most likely should be thinking about buys right now. So it's saying to buy, take buys at 172. 172 is right here, and ATR on this one is 1.2, and it tagged you in and hit TP. So this is there to like keep you out of trades that are likely to blow your account. You know, like even if you don't use the trade recommendation, this is still a powerful tool. Like it's still very helpful for visualizing technicals. The thing about technicals are that they're not subjective, they're objective. Like these readings are objectively true. So if you're taking something that's objectively true into the market, it's giving you a higher confluence, a higher probability of something happening over the other. And in this circumstance, that was absolutely true. Placing a limit order buy at 172, you entered with 0 drawdown and hit your take profit very quickly. And you know, there's been times where I've kind of went against this. I'm like, you know what, I want to take sales right now, and I usually lose those trades. Why? It's because this gives you a reading of what's happening right now. And if I'm thinking sales when all of this is green, I'm probably going to lose my trade, because all this is indicating that the price is strong right now. Like the confluence score right now is 10. So that means everything is lit up, telling you like, hey, the market is super bullish right now, so you should be looking for buys. So like, yeah, that's been like a hard thing for me to accept sometimes. It's like I'm looking at the indicator that I built, you know, I built to help me, and I still have these self-sabotaging ideas and thoughts sometimes. It's because when you are contrarian at heart, is sometimes you just want to, you're just like, I think it's I think it's overvalued, or it's gone too far, it's overbought or whatever. I think I'm gonna sell it, and the market just keeps going. So, you know, the tool you'll wish you had sooner, honestly. Most traders fail because they lack clarity and consistency. This tool removes the guesswork. You trade the edge, not emotions. Confluence equals confidence. You'll know when the odds are in your favor. No more jumping between indicators or second guessing your setups. It's designed to help you trade smarter, faster, and more objectively. If you want high probability trades without the mental clutter, this is your edge. All right, key takeaways for this. Confluence is when structure, levels, and EMAs and react. Confluence is when structure, levels, EMAs, and reaction all point in the same direction. Divergence is when your trade idea clashes with market evidence. Most losses come from trading against obvious divergence. Before entering, check structure, levels, reaction, and macro alignment. Confluence doesn't guarantee wins, but it stacks the odds in your favor. So check out my indicators if you want to start trading with a sharpened edge. The link for this will be in the description box below. Yet again, I built these tools because they help me, and I just want them to help you out as well, and help people stop blowing up their accounts. I find this tool extremely valuable and helpful, and the other people that I've sent this to, they also found value in it as well. So hopefully you find value in it too. That's all I have for this module. Please take care. I'll see you in the next one. All right, this is module 14. The trend is your friend until it's not. It's a playoff of the trend is your friend to the end. So the objective is to teach you how to identify, align with, and trade in the direction of the trend while avoiding the most common pitfalls that come with blindly trusting moving averages or oversimplified trend rules. You'll learn how to assess true market context using structure, quarter levels, and dynamic tools like the 200 EMA without becoming dependent on any single input. So follow the trend, but know which one you're following. You've heard it before. The trend is your friend, but the real question is which trend? The market is always operating in multiple trends at the same time. The higher time frame trend, the daily, weekly, the midterm trend, H1, H4, the short term trend, 15 minute, 5 minute. These trends often contradict each other. Example, the daily chart is in a clear downtrend. The H1 is in the bullish retracement. The M5 chart is trending upward sharply. So which one do you trade? The answer is context. So we talked about this in a previous chapter, but you know, there are many different trends taking place in the overall cycle of what's happening here. I use a combination of tools, not just one, to understand where we are in the trend cycle. So daily closes at quarter levels. If we get a daily close above a major quarter level like 100, I tend to expect price to push upward to the next level. Example 125. If we lose a level, I expect a move to the level below. Quarter levels give me clear directional checkpoints, and that's really what they are. It's checkpoints. So is this a Solana chart? The price closed below 125, so like a magnet, I would anticipate it being drawn towards 112.5, I believe. That's not always the case. So here we had a close above 125, and we expected it to go to 135, and it almost got there, but then it had to pull all the way back to retest 125 before making its move back up there, because it didn't have enough demand and there was still too much supply. So that's usually what happens. In this case right here, Solana closed below 137.5 right here, and it went straight down to 125. It closed below here, then it went to this level, came back up. So you get the point. So same, I think this is EJ. So here's a good example of price closing below a key level. So it closed below 192.5, and it closed above here the next day, and next day it tried to push off, but then it failed, and it even closed super low, and obviously it's going to 190 at this point. There's a high probability it's going to 190. So these are times where you expect it to immediately go down here, but it doesn't. And okay, so let's slow down. Technically it did. It closed below 192.5, and it went pretty much to 190, but then in the same day it went from 190 all the way back up to 192.5. Extremely bullish. So naturally the next day people are taking bids and then liquidated, and the moving average just kind of give you a hint, an idea that, hey, this is still bearish right now. Lo and behold, here, let's look at this one. We got a bullish close above 190. What happened next? Straight up. We had a bullish close above 192. Guess what happened? Uno reverse. You know, so this is not like a foolproof plan where something is guaranteed to happen. I hope I've at least taught you all to think in probabilities by this point in the modules, to understand that there is nothing guaranteed. There is just a higher probability of something happening over the other. So 187.5, bullish close above it. Where did it go next? 190. Then it went straight to 192. Rejection at 192. Where'd it go? Straight back down to 190. So you get the idea. It's a roadmap. It helps you get clear identity, clear understanding, and where it could possibly go. Not where it will go, but where it could go. There are so many examples in this chart. Look at the close below this probably GJ. $1.275 bearish close below the level, went straight down. It freaking double bottom here like multiple times, and you would think that would go up, but guess what? It failed, retested the level, closed below 1.25, then went straight down. Then we broke above it, retested it as confirmation of support, went straight up, retested again, straight up. You get the idea. So these levels are not a joke. These are serious, man. I have so many examples here. Like, just look at this chart and look at it yourself. Look at the closes, and then look at the direction that they go in next. This is a crazy chop right here. I think this was probably GJ, because I remember this disgusting chop on a daily time frame. Like, what? Like, look how it's testing this level. No, but then at the bottom, buyers keep pushing the price up, and then there's still a bunch of supply. Eventually absorbed that supply, retested twice, and then pushed up. It was a bit of a mess to trade that one. Finding the trend using quarter levels to read market direction. Key insight: losing or reclaiming a quarter level gives you a directional context. That's how you stay ahead of where price is likely headed. It's not where it will head, it's where it's likely to head. So The 200 EMA on the H1, it's not a rule, it's a reference. If the price is above the 200 EMA on the H1, it supports a bullish structure on that time frame. And below it, it implies downside pressure and a bit of weakness in the price. This is not a trade filter. It's just a way to stay aligned with the market flow, market structure. So are we making higher highs and higher lows in the uptrend, or lower highs or lower lows in the downtrend? Where are the inflection points? Are key support and resistance being broken or respected? That's how I stay grounded in the logic of price and not just the visuals of an indicator. You have to also understand the context of the market, what the market is doing at the moment. So this is just usually for newbies, like if you need to know what an uptrend is: higher high, higher low, higher high, higher low, higher high, higher low. Bear trend is lower low, lower high, lower low, lower high, lower low. And range is equal highs, equal lows, going sideways chop, which is what the market is doing usually. So these are why moving averages can be helpful and hurtful. The upside is that they give you an objective reference point. They help remove emotional guessing. They show you general bias over time. The downside is that they lag behind price. They can blind you to higher time frame setups. If you use them as strict filters, you may miss key trades at strong levels, because remember, they're a lagging indicator, lagging. So if price is at a major daily quarter level but still below the daily 200 EMA, some traders will skip the setup entirely because the EMA doesn't support it. That's a missed opportunity, because the reaction at the level matters more than a moving average. Because remember, indicators tell you what happened, not what will happen. So the market is dynamic. Trends shift all the time. You can be right about the trend and still lose the trade. You can be wrong about the trend and still hit your target. Why? Because the market is constantly reacting to new information, news, volume, position, liquidity. It's all in motion. The trend is your friend until it's not. It's your job to know when it's changing, not just when it exists. So how to stay aligned without getting rigid. Here's how I recommend you approach trend identification. Use daily quarter level closes to define directional bias on the higher time frame. It should say the higher time frame here. Use the H1 200 EMA for flow reference, not trade validation. Use structure, inflection point, breaks, and reclaims to time entries. Always ask, what is price reacting to and where is it likely headed next? This gives you flexible framework, one that adapts to shifting market behavior without falling apart when things do not look perfect. Keys, takeaways: there's no single trade, just context across multiple time frames. Moving averages can guide you, but they can't replace decision making. Trend following is powerful, but only if you know when the trend is changing. Use quarter level, structure, and EMAs together, not in isolation. Be dynamic, not dogmatic. That's what separates real traders. Please don't be dogmatic about this. I know human beings have the tendency to be just completely dogmatic about so many different things, but just keep an open mind about the way that you interpret the information and the way that you're trying to structure your trades, and just be flexible with the market. That's all I have for you in this module. I will see y'all in the next one. Okay, welcome back. This is module 15, support, resistance, supply, demand, and harmonic secrets. So our objective is to teach you how to properly understand and use support, resistance, supply, and demand, not as a magical reversal zones, but as context tools that help you judge where price reacted in the past and how that might influence behavior today. So what are support and resistance levels? Support is a level where price has historically bounced due to buyers stepping in. Resistance is a level where price has historically rejected due to sellers overpowering buyers. These are horizontal zones, not precise price tags. They are based on psychological reactions. Just because a level was respected before doesn't mean it will be respected again. It only tells you where a past imbalance happened. Think of S and R as price memory, not as price prophecy. Okay, so these are support and resistance zones, pretty straightforward. Horizontal lines. So resistance, became support. All right, so supply is a zone where price sold off aggressively. We were talking about supply and demand. Sorry about that. Supply is a zone where price sold off aggressively, suggesting a surge of sell orders from institutions or large orders. Demand is a zone where price launched higher, indicating buyers were in control. These zones are typically drawn as blocks or ranges, and they are based on imbalances, not just how many times price touched the area. Supply and demand zones help you find where smart money is likely acted, not where retail gotten late. All right, so this is supply and demand zone, and this is using the different models. So there's rally base drop, rally base rally, drop base rally, drop base drop. So we have a rally, which is a strong push, a base, which is a consolidation, and the consolidation is price acceptance. If price is accepted at this level, that means that there's an equilibrium. And then price, what do we know about ranges? We know that after every range comes a trend. So price rallies, so it's a strong trend, range, trend back down, strong trend, range, strong trend. So trend, range, trend, trend, range, trend. You get it? So rally base drop, rally base rally. It could also say trend, range, trend, trend, range, trend. Core principles you must understand. Support does not equal demand. The resistance does not equal supply. They're similar, but the logic behind them is different. Support and resistance are based on historical touches. Supply or demand zones are based off of how aggressively price moved away from a certain zone. Level being touched multiple times doesn't always make it stronger. Sometimes it's being weakened. Core principles you must understand. The chart tells you what happened, not what's going to happen. Just because price bounced at 125 3 times doesn't mean it will bounce there again. Support, resistance, supply, and demand play a huge role in how I decide whether or not to take a trade. Here's my logic. If price has shown strong reactions at a level like 125, big wicks, strong candles away from that area, I know that there was once a real imbalance there, but I don't assume it still exists. I let the market prove it. I look at, are we forming an inflection point at the level? Are we reacting to it with real energy or just hovering near it? Does the current market structure support a reversal here? Is this level fresh or has it been hit 3 to 4 times already? I use these levels as context, not as a signal by themselves. I never take a trade just because we touched a support level. I'm always asking, what's the story here? Or you could also say, what's the narrative here? So secret most traders miss. Secret 1, if price approaches a level slowly or hesitantly, that's not strength, that's often absorption, where big players are prepping to push it the other way. Secret 2, a level that worked once doesn't always work again. The imbalance might have been filled. So keep that in mind. Secret 3, the best supply and demand zones often form after manipulation news or stop runs. Another key. Secret 4, levels that are too obvious to retail traders often become liquidity pools where smart money enters against them. You can counteract this by still entering at the level but having a wider stop loss. Wicks mean nothing without follow through. A reaction is only valid if it leads to structural change or continuation. So these are different liquidity models. So this is trend line liquidity. So the market is trending downwards and short sellers are entering positions at each one of these swing highs, putting their stop loss above the level. So this is another model where we're trending down and then we grab the liquidity from this high and then go lower. This is double bottom liquidity. So market makes a double bottom, 1, 2. There's a drive below this double bottom here to absorb these orders, the liquidity here before it moves higher. Double top liquidity, 1, 2, and then it takes out the equal highs and grab the liquidity. This is usually what smart money concept traders like to use. It's something that does work. Does it always work? No, but nothing works all the time. The best zones aren't always the cleanest on the chart. They're the ones that created real displacement. If price exploded from a messy area with aggression, that's more meaningful than a perfect looking box. Zones that line up with quarter levels or key psychological prices like 100, 125, 150 are far more likely to act as magnets or turning points, not because of magic, but because everyone's watching them. That's why it's a big deal when Bitcoin hit $100,000. Like, why is it such a big deal? Well, 100K is a big number. And if people are still buying at that level, then that shows price acceptance. So, secret 8. A support or demand zone that held in a range may completely fail when price breaks into a trending environment. The nature of the market phase matters more than the level itself. A failed level isn't useless. It becomes new information. If support breaks and turns into resistance, that's a shift in market intention. Pay attention to how price treats that flip. Never assume the first touch of a level is the best trade. Often, the second or third test after a proper reaction and structure forms gives you clearer setups with less risk. Now, this is not always the case, because I think Lance would probably say that the first test is the best test, and the second and third test might have a weaker EV, but I would always prefer a double bottom over a single bottom. That doesn't mean I'm not going to take the single bottom trade. It's just that a double bottom is a powerful form of confirmation. Levels power depend on what's happening around it. Where is price coming from? How is price approaching a level? Fast and clean or grinding sideways? What's the bigger trend telling you? Is it a fresh level or has it been played out? Is volume or momentum confirming a level's reaction? A level means nothing out of context. The zone doesn't create the trade. The story does. So the key takeaways for this, for the first half of this module for support and resistance, supply and demand is SNR and S&D are tools of context, not automatic entry signals. They tell you where imbalances existed, not where price will definitely react. And I feel like a lot of people make that misconception. A lot of traders make that misconception of identifying a reaction zone and thinking that it's guaranteed to reverse from there, when there's no guarantees in trading at all whatsoever, ever. So let price confirm that level is still meaningful before committing. So it's kind of essentially the red light, green light analogy. You would wait for the light to turn green in order to go. And if the light's red, then perhaps stop. Now, there are caveats to this, because this is trading that we're talking about. So it's always going to be buy low, sell high, buy low. But there are also ways to go about that. There's tactics to go about managing your risk if you are buying something that is selling off. Combine these zones with structure, trend, quarter levels, and confluence to build strong setups. Always read the intention behind the price, not just the shape of the candle. So now we're going to talk about harmonics. Not a lot of people know about harmonics. Not a lot of people talk about harmonics. So let's dig into that, because I do actually use harmonics from time to time when it comes to structuring my trades, because after staring at these charts for the last 5 years, pretty much every day, I can tell you that harmonics certainly exist in the market. They're a naturally reoccurring pattern in the psychological market participant behavior, and a lot of times they lead to crazy reactions and upsides. So harmonic patterns are geometric price formations based on Fibonacci ratios. They reflect the natural rhythm and fractal structure of markets based on the idea that price moves in predictable waves, just like we see in nature. The Fibonacci sequence, golden ratio, etc. They allow you to predict reversals with high precision if and only if they complete at key levels with Confluence. So this is the harmonic patterns cheat sheet by Mitch Ray. I would highly recommend following Mitch Ray if you are interested in learning more about harmonic patterns and how to use them to enter high probability trades at key levels with he also uses the RSI and MACD histogram looking for divergence. So this is the person that I actually first learned how to understand charts and read charts and trade from. So I would be, I wouldn't feel right not giving credit to the person who I learned how to trade from, which is TA with Mitch Ray. So highly recommend going to check out his channel. So on this sheet, I'm just going to focus on the bottom half. So we have the bullish bat, bullish butterfly, bullish crab, bullish cipher, bullish garly, bullish shark, bearish bat, bearish butterfly, bearish crab, bearish cipher, bearish garly, bearish shark pattern. And it's basically a M shape and a W shape. So I know the ratios and the specific measurements can be a little hard and daunting for people, but it's essentially M's and W's. So the interesting thing is that usually a W shape leads into a M shape. So it's like they're constantly creating each other through the way that they move in the market. So yeah. All right, so this is another one. So this is essentially the same thing, but just using another cheat sheet to show you what it looked like. So this is the harmonic framework made by, I believe, Scott Carney. Scott Carney is the OG of the harmonics. I'm completely blanking on which specific ones that he created. So my apologies, Scott. I should have had that in this module, but I was in a bit of a rush to try to finish this up quickly. So head on over to harmonictrader.com to get more information on harmonic trading and harmonic frameworks. But this is the exact framework for specifically a bullish pattern. So you get the type 1 reaction at the D point with a type 2 return. Sometimes the type 2 makes a lower low than the D wave, but it usually resolves an upside, and there are take profits here. So I believe I have some picture examples. So this is literally this. Like I could not find a better example, and I love the fact that it's a trade that I actually took. You know what I mean? So like you can see the arrow, boom. So we have the bullish formation. So just think M pattern. So we have the M pattern, completes at the D zone, type 1 reaction, type 2 return. The second wave literally took out the lows of the D, but it was still at a key level. I have this key level mapped out. It's also a key psychological level. It led to major upside. These are the type of plays that I like to look for when I'm looking for high probability, high upside plays. I didn't even add in the divergence that was on the indicators, but they were there as well. Now this is actually on a meme coin, if you can believe it or not. I think this was HIM, so $HIM. And I saw this M formation, type 1 reaction, type 2 return. The type 2 didn't take out the lower low, but it was still at the key level. Engulfing candle went straight up 400% and then proceeded to trend. So like these formations, you can find them everywhere. It's not usual that you see them in meme coins because most of them just literally rug and go to zero. But if you see one, I was ready to like dump everything into it, but it was like up here, and I was like, I wanted to wait for a pullback. So I never got full size in, but I did buy some. So the core harmonic patterns you should know. These are the most commonly used and easily recognizable. So there's the AB equals CD pattern, and it's simple and symmetrical. The length of AB equals CD. Mark Douglas used to trade these patterns himself. Used to identify reversals or continuations. Garley pattern starts with a retracement followed by impulse leg. Point B is 61.8% retracement of XA. Point D is typically 78.6 of XA. Then we have the bat pattern, and then we have those specific measurements as well. So butterfly, crab, deep crab. I don't want to get too technical right here because it's just going to sound like numbers and jargon to you, but it's basically everything that we put on that first cheat sheet. So every harmonic pattern depends on precise fib ratios: 38.2, 50%, 61.8%, 78.6, 88.6, extension 127, and I believe it's 1272, 1414, 1618, 224, 2618. So I don't take every harmonic I see. I use them only when they line up with core levels, liquidity zones, key support, key supply and demand, or support and resistance zones. They're just one form of confluence for me. But when I do take them, especially AB equals CD and bat patterns, I get sniper entries with very small stops and very high R setups. These patterns work not because they're magical, but because they represent areas where large orders tend to accumulate. This gives structure to the chaos. They help you define risk clearly. They offer objectivity in a subjective market. So my final tip for that is to combine harmonics with supply and demand zones, quarter levels. Support and resistance should be on here. EMA direction, trend direction. Whoops. If you can, like, usually these won't line up, but maybe like a 200 period moving average might be great. And candlestick confirmation, so like bullish engulfing candle. So this is Scott Carney right here. This is Mitch Ray. I believe this is Scott Carney's family. You can visit Scott Carney's website at harmonictrader.com. You can visit Mitch's YouTube channel at Mitch Ray TA. And once again, these are phenomenal harmonic traders, so all props to them. And they're just passing on knowledge that it was imparted to them, and I'm passing on knowledge that was imparted to me, and hopefully it enriches your life. That was the end of this module. I will see y'all in the next one. Thank you so much. Alrighty, welcome back. Module 16, sniper entries with limit orders. Our objective of this module is to teach you how to enter trades with precision and confidence using limit orders at quarter levels. This is how we build consistency, not with perfect predictions, but with repeatable precision. So this is why precision matters. Most traders lose money not because their bias is wrong, but because their entries are just sloppy, just terrible. They chase price, they hesitate, they misclaim the entries, they wait for confirmation and enter late, they panic, enter on breakouts without a plan. The solution is sniper level limit orders placed where you know the market is likely to react. We don't wait for permission, we set our trap in advance. Now, this is going to be a tricky module to understand completely because while I will be talking about limit orders, confirmation is also important for scaling in. So limit orders are better. They ensure you enter only at predetermined price, preventing emotional trading, so it teaches you patience. They help you avoid slippage, improving your execution accuracy, not every time, but most of the time. They allow you to position yourself ahead of the market movements rather than reacting to them. The key takeaway here is professional traders use limit orders because they guarantee precision, reduce slippage, and allow for planned execution. Slippage is when a trade executes at a worse price than expected, usually due to high volatility, liquidity gaps. This happens frequently with market orders. So mostly a lot of times this is happening around news catalysts. So yeah. So limit orders reduces slippage. They execute at your preferred price, getting in exactly where you want to get in, preventing unexpected losses. They allow you to pre-planned trades, removing emotions from execution. They are essential for trading fast-moving assets like NASDAQ, gold, and Bitcoin. Quarter levels act as psychological magnets for price. Institutions love them. Liquidity stacks around them. They're visible and powerful on all time frames. So I place limit orders right at those key zones with full acceptance that I might take some heat, but I've got my risks managed and my setup is valid. You don't have to enter full size on the first entry. I should have put this in bold and underlined it. You don't have to go full size with your first entry, guys. You can add the rest of your position when the expected value of the trade changes. This removes decision fatigue, keeps me from chasing, and forces me to trust my plan. Discipline is choosing between what you want now and what you want most. So this is the expected value picture created by Lance Bernstein. Lance Bernstein is a I think former S&B Capital trader. I'm pretty sure he doesn't work there now, but an actual prop firm trader who's brought in just, I think 9, or was it 8? 7, 8? I think it's 8 figures. It might be, I don't know. Is it 8 or 9 figures? He's a really good trader, and he talks about the expected value. And this is the EV, so the right side of the V. So the same price at different times can yield different EV. And first off, let me say congrats if you made it this far, because this is a really important thing. And I've purposely placed it towards the end because, once again, I wanted to focus on psychology first. But this could possibly really elevate your trading. So The same price at different times can yield different EV. So on the left side, he's arguing that you're fighting the trend, trying to catch a falling knife. And if you simply wait for the same turn, the expected value of the trade is now different because you can place a stop below prior bar lows. You're now going with the trend and your trade has a positive expected value, rather than if you're on the left side, you don't necessarily have a positive expected value because you're fighting the trend. The market is selling off, and you don't necessarily have a hard stop location. Now, here's how I counteract that, because I do love limit orders, and by definition, you are pretty much catching a falling knife when you place a limit order because you are fighting the trend. So to counteract this, let's say you want to put on a position of, I don't know, 5 shares of something. You can put 2.5 here, and if the expected value changes, if it turns around, you can add the rest of your position here and then ride the wave up. Now, this helps you because if you're adding 2.5 here and it just continues to fall and hit your stop loss, you only lose 2.5. But if you enter here and the expected value changes, okay, now you can add the rest of your position because the market is now going in your favor in a direction. Now, keep in mind, the market is going to keep changing directions, but it's way better to add and scale into the position because you account for the probability that the level that you're trading at doesn't hold at all, and it just goes straight through like a knife through butter, never turning around. So that's why I do my best to size into trades and never go full scale into a trade. It has its pros and cons. The cons is that sometimes the market will it'll stop literally right here and then go straight up, and you'll never have that opportunity to scale in properly. But I do believe in scaling in. So this is an example of the expected value changing right at a quarter level. So this is $150. This is Solana. So if you place a limit order exactly right here, you are definitely fighting the trend, right? Lower, 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 high, lower, 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 high. Obviously, I don't have the complete context looking to the left of the screen, but this is just talking about what we see right here. So the expected value starts to change basically at this bar here, and you could have added right here. Now, the expected value changes and it pulls back again. But guess what? Bullish engulfing candle. Now, you could have even added more here if you wanted to, because now this is a double bottom, 1 bottom, 2. Now it's really looking like there's an high expected value of us making a move next to 152.5. And as you can see, we exploded off of that level. But this is the example of proper scaling in. So this is the exact same. This is this exact same thing. Like I painted it right here so you can visualize it clearly. It's just the expected value, the right side of the V, right? So once it starts to turn here, you add. So limit order here. Okay, it's looking good. Let's add here. And then, yeah. So this is from a video on the S&P Capital YouTube. I think the title of that video is actually called The Right Side of the V, but I could be wrong. But this is a very excellent way that Lance broke it down. I'm not as good as him at explaining this, but I just wanted to show you how the probability changes once the turn is put in, and so does the expected value. So the two key changes that occur at point B is that now we have a stop. The win rate actually improves because now we're going with the trend. And what's at the bottom? Is there something at the bottom? Can see. Okay, and that's it. So those are the two key changes. And there's actually 2 slides here, but I only have the first slide here, which shows what happens at B, because he talks about the A and B. Once again, I feel like if you really want to know this in depth, head on over to the S&P Capital YouTube channel, and they have plenty of education. So these are more examples of the V. So this is how it might manifest in front of you. There's many variations of this pattern, but it's basically a morning star candlestick reversal candle. pattern. So trending down, positive bar here, you would probably get in on a break of the prior bar's high right here. Now, mind you, it's going to be really hard to get in with the limit order at the break of a bar here, which is why I like to scale into my trade. So maybe I would have been buying here and then scaling in here, but you get the idea. So more examples. So here's an example of all of these are like so realistic because it's never clean and easy. Like you're never going to see it show up the exact same way every time. So it's like, I want to be realistic with this stuff, because sometimes you'll buy, let's say you had a limit order right here, and then you scaled in here, and maybe your stop loss was down here, and then it was like, okay, it's going good. Maybe you even added some here and it pushed back down, and then it starts to go up again. So now you're like, okay, do I enter? Do I re-enter? This is why you need contingency plans on how many opportunities you're going to give a trade to work. So, and then Lance actually also has a video that talks about these capitulation plays where he would take this trade again. So let's say he took this trade and it failed, he would hit this again and try it again. And after incorporating that mindset, I do my best to try to do that as well. It's like, okay, just because it didn't work the first time doesn't mean it's not going to work the second time. But you have to, the most important thing is the expected value. And if the expected value is changing, then why not shoot it again? Why not add again? Why not try it again? Okay. All right. So the common mistakes with entries are entering too early as a just in case. And I've done this many times before, and I still sometimes do it mistakenly. I'm not a perfect trader by any means, but I still work on it. Waiting for a candle to close and just missing the move. Adjusting a level once price gets close. Moving stops emotionally. Not placing your limit order at all due to fear. Like, especially when something's selling off hard, you're like, man, this is really dumping hard, a lot of momentum. And man, I've seen it all. I've seen things have so much momentum, look like they're about to just completely capitulate, and then they just hit the level in reverse. And managing your trades once the trade is live. Dragging stop losses to break even too soon. I see this all the time. People just drag the stop loss to break even, not even realizing that the market is probably going to retest that price and take you out of trade, and you only moved it there because you don't want to lose, and you're trying to quote unquote protect the equity of the account, even though your stop loss is supposed to be where it is to invalidate your trade idea. Anyways, taking all profits at TP1 out of fear, changing TP levels mid-trade based on your emotions, skipping your TP3 entirely because you don't believe that the trade will trend. Now, this can be a valid thing, actually, if the market is starting to show weakness. This is a very valid thing. But if you're doing it in a self-sabotaging way because you have fear that the market's going to take your profits away, then that's a psychological thing that you need to work on. These are processes. These are process problems, not strategy problems. Professionals don't guess once the trade is on. They execute the plan they designed before the chaos started. The psychological benefit behind limit orders is when you place your limit order in advance, you are making a decision based on logic. You are moving, you remove the chaos of live price action. You are affirming trust in your system. Confidence comes from doing the same thing the same way and letting the math play out. This is how we trade like professionals. All right, so what if price hits TP1 or TP2 then reverses? This question every disciplined trader needs to answer before it happens. So there's rules for managing reversals. If TP1 is hit, I move my stop loss to break even. If price comes back to my entry, I'm protected, no loss, just a partial win. And that's completely fair. And I do want to give you tools to do that. But I don't want you to be doing that if your TP1 isn't hit. If price closes back above quarter level and is still hovering near it, I'm allowed to re-enter the trade, ideally with a limit order. So if price is like constantly retesting an area like it's just bouncing there and you get stopped out, just re-enter. This is why we scale in, because if you didn't take the full loss, then there's no problem with re-entering the trade. So this lets me recycle the level or double dip on clean setups without chasing or over trading. So basically, if I enter at 150 and it hits my take profit, I'm allowed to re-enter again at 150 to recycle the level because the level is still strong. If TP2 is hit and then price reverses, I've already booked the majority of my position, 90%, at TP1 or TP2, depending on how you're trading it. And TP3 is a 10% runner. So once again, this is how we try to book profits and be consistent. But this is ultimately up to you, how you want to manage your trade. This is just more for people who are not profitable yet. Your edge doesn't just come from where you enter, it comes from how you exit. This 3 target system provides you with early confidence, core equity growth, asymmetric upside. You're not just placing orders, you're managing risk and reward like a professional. This system allows you to thrive even in inconsistent markets. So this is just how I do it, but this isn't the best way. I know Lance Bryson has his own way of managing risk, which is all based on expected value, and he would like to get most of his size off when expected value changes. But you have to ultimately trade in the way that works for you, and that's what works for him. You'll find what works for you as you continue to trade and find more experience. But this is just what I do. That's what he does. But what works best is what works best for you. So, example set up on Solana. I'm not sure if I actually took this trade or not, but this is how you would do it. So this is 115 if I'm looking at this properly. So limit order here, full size here, TP1 here. If that's how you want to go about it, this looks like to be a 1-to-1. So you either take in 90, 80, whatever you want to do. Just take some off here. This is the next one. This is the next one. This is the example of a way of scaling out. I believe this is an actual trade I took on the SPY. I entered, let's see. I think I got entered here and I scaled in once we got this pop. And then look, it even put me in drawdown, but then hit the TP, hit the next TP. Easy as butter. I don't think I had a TP3 on this one, but yeah, this is, not every trade is going to be this easy and simple, but like the more you do it, eventually you'll get trades like this, so like here's one that you could have taken where you got a nice push up against a level, limit order here, boom. You could have entered more on the break of this high right here, catching the momentum, and then it went straight to this next level. I like to trade level to level. So I believe I took a loss on this one. So as you see here, I entered here. There's I think a demand zone here that I want to try. And then I got clapped. So it completely failed. So it completely washed me out. But guess what? I already was planning for if this was going to lose or not, with a limit order right here. So boom, I entered in. Did I size in? I'm not sure if I sized in. Actually, this trade was still open. So this trade that I have here was still open. I probably closed it for break even. Yep. So I closed that for break even, and then I held on to this one. It looks like I added here. So there's 2 entries, and then I don't know if I have a resolution from that, but I end up winning that trade. So this is no, I did not catch 5R on this trade, but I did scale out. So so I entered right on my first position here, and I entered in the rest of it at 145. I think I took a good amount of it off here, and then I was just clipping. I caught a really big move, but I didn't take it all off because I saw the potential on this candle for a big move down, and that's exactly what we got. So Jupiter, same thing. I entered at quarter level, 0.475, entered TP, easy as butter, and then I end up holding this trade, I believe. This is a nice 1-to-1 on Bitcoin. Literally, I got in at the exact bottom, like dead bottom. Just beautiful trade, and called a nice 1-to-1. I don't know why my brain just froze right there. DIA, and I sold here, took profit on this one, took profit here, and then I was just scaling out. I was covering into the weakness, by the way, so that's when my reward is the highest. So you gotta scale out when your reward is the highest, because you never know where the bottom is. People just say, you know, people will look at my soul trade and be like, why don't you just hold? Because I don't know when the bottom is coming in. You never know when the bottom is coming in. Trailing your stop with these highs is a completely different strategy that I do not trade. Nothing wrong with that. It's just not how I trade. Sand, they caught another one. I don't know what level this is. Looks like it was at, yep, quarter level 30 cents, enter. And I held this one actually. So held this one, took some profit here, and I held it. Popcat, this was a daily break and retest, I'm pretty sure. Got in a little bit early, right at that 42.5 level. Took profit here. NASDAQ, literally, look at this entry, guys. Come on, this is called sniper entries with limit orders module. I'm not lying to y'all. Like, here are the receipts. I got in at the dead bottom of this, and let me tell you, there's no way that you can anticipate this happening. Okay, like, this is luck. I plan to enter it here, but I don't know where the market is going to exactly turn around at. I just say, hey, it could turn around here, and it did, and it popped straight up. I didn't even have time to scale in. It was only, you know, it was only $100 right there, and I didn't even have enough time to fully scale in. I think this is after I clipped. I'm not sure, but yeah. So it popped, and I recycled the level. I left this pending limit order here. Boom, tag me in again, straight up. So the key takeaways is limit orders work. They will fail like all tactics do, but if you stick with it, you will be entering with unbelievable sniper entries. Size in when the expected value changes. That's all that I have for this one. I hope I brought you immense value. I'll see y'all in the next one. Almost done. Okay, module 17, everything about candlesticks. Let's get into it. Objective is to teach you how to read candlesticks with clarity and context so you can understand what they actually reveal and what they don't. You'll also learn how groups of candles form institutional footprints like rally-based rally or drop-based drop, and how to use those formations to map out potential future trades. The purpose of a candlestick. Candlesticks represents price movement within specific time frame. Each one shows the open, high, low, and close. They reveal the battle between buyers and sellers. Candles show how price move, not why, not what comes next. Think of candlesticks as evidence left behind, not predictions. Okay, so we got the body, the wick, the color. The body is the range between the open and close. The wick, the shadow, sometimes referred as the extension beyond the body, showing price rejection. And color, bullish, close above, open, bearish, close below, open. A long wick with a small body shows indecision or rejection. A long body shows conviction. So, candlesticks basics. The open of a bullish candlestick is right here. The close will be always above the open. The bearish candlestick, the close, which is down here, will always be below the opening price. So it indicates weakness. This indicates strength. The wick or the shadow represents rejection. So that represents weakness on a bullish candlestick. And on the bottom of it, it shows strength because buyers are able to push this up. At the top of a bear bar indicates weakness of the bulls, strength of the bears, and on the bottom represents the strength of the bulls and the weakness of the bears. because remember, it's rejection. So think of a wick as a no-go. Okay. So we have indecisive patterns, which are doji bars where both the bulls and the bears are strong. And then we have spinning top formations. Then we have the bullish hammer. So the hammer is a reversal candle. So you would think up next. A dragonfly doji is similar to a hammer, but the bulls did not have any price action above where the close was. There's, the inverted hammer, which you'll usually see mostly in stocks. The Marubozu, the engulfing candle. So the engulfing candle is when the candle completely engulfs the one next to it, showing significant strength at a certain price. I didn't go over the Marubozu too much because it changes sometimes. So we'll get back to that one. So the Harame is how the inside bar is usually on the bar next to it. So it's also a reversal sign. So I like how the arrows are going up because it shows you that pretty much all you need is a candle to be going in your direction for the expected value of your trade to change. So whenever it's going in a red, if the candlestick is red, the price is probably going to keep going down until you see a price reverse, and then the order flow is going in a different direction. So this is the morning star and the evening star. I don't really like these examples too much because there's a gap here, and the evening star is not usually like that. Let me see if there's another. No. All right. Well, in general, the reversals of the candles is really what matters the most. And you simply, I believe it was Tom Holgard, who's another professional trader. He said that obviously there's more nuance to it, but he just simply waits for the candle to be in the direction that he wants to take a trade. So he used white and black bars. So if the bar is black and he wants to short, he has his entry signal. 3-line strike. So a lot of these you'll just see in stocks and not so much other things, but the most important one is the hammer, the engulfing, the morning star, evening star, engulfing again, and shooting star, quite honestly. Like Harami sometimes, but everything else is just really not important. So then we have patterns now. So we have a bull flag. So we have a uptrend, and then price starts to fall in a flag pattern. That's why it's called a flag. So it's in the shape of a rectangle, I believe. And once it breaks out, it kind of give you like a signal here to buy. I mean, if it's like at a key level, then sure, but you don't want to just be taking every flag and buying every flag that you see. So then we have a pennant. So mostly it looks like a triangle. Here's another triangle. Here's the cup and handle. So these are circles followed by a breakout. Inverse head and shoulders, which most of the retail traders will be focusing on, and head and shoulders as well. So it looks like a head and shoulders, shoulder, head, shoulder. This is a falling wedge pattern breakout. You'll see cup and handles mostly in stock market. You'll see ascending triangles in stock markets. Sometimes in forex, you'll see it a lot in crypto. Consolidation is, you'll see this in every market, which is just price in a range. Indecisive, symmetrical triangle. It's kind of like a neutral pattern. Whereas the ascending triangle is that there's price has stopped making lower highs and is consolidating at a certain location and is making higher lows, and then eventually is going to break out, retest, and go break out of that range. So what candlesticks tell you and don't? What they do tell you, how price reacted to a level. That's what they do tell you. Who had the momentum, buyers or sellers, and whether a move was impulsive or weak. What they don't tell you is what's going to happen next. Okay, I'm going to say that again. What they don't tell you, what candlesticks will never tell you, is what's going to happen next. Whether a level will hold or not, and and if a pattern is guaranteed to play out or not. Candles only make sense when seen inside of a larger framework: structure, trends, key levels. I don't trade candlestick patterns in isolation. I use candles to confirm reaction at quarter levels or supply and demand zones. I'm watching for signs of rejection, strength, or failure. A good candle setup still needs context, trend, structure, timing. So I'm not gonna talk about rally too much because we did actually talk about it, but this is essentially what it looks like, which is a drop base rally. So it's dropping a base rally. So trend, range, trend, rally, base rally, uptrend, consolidation, uptrend. So this is a range. It creates demand zone, so it creates high probability reaction zone. So a lot of scalpers will be taking setups like this because the price is already in motion. It's already going to its next destination. So these are good for when price is trending, it's in transit, and you're trying to get inside of the move. Drop base drop, so trend base drop. If it pulls back in here, good area to take sales out of. Here's another one, rally base drop. So this usually happens at the top of a level and price is too weak to continue on. Candlesticks are tools to understand behavior, not predict it. Don't overanalyze every candle. Look at the story it tells inside your system. Use candle formations like rally base rally and drop base drop to build better zones. A pin bar at a strong demand level with Confluence means something. The same pin bar on its own, probably nothing. Candles are one piece of the puzzle. You use them to complete your structure, quarter levels, and your bias. So I hope this was a very beneficial candlestick. It was a pretty quick one because candlesticks are those things like, yeah, they give you information, but like they're way overblown. Like people just sit there and memorize so many of them. Like it's not that big of a deal, guys. Like just spend a week learning the different candlestick patterns and then move on. Don't be sitting there trying to learn every single type of pattern there is. Like there are so many patterns. It's just ridiculous. It's not gonna make you money. Like, come on, be for real. All right, see you in the next one. Okay, module 18. This is about prop firms. Our objective in this module is to expose the reality behind prop firms and what they advertise versus how they actually operate, and help you decide when and how to leverage them responsibly if you have an edge. If you have an edge. So this is why this module matters. Prop firms are marketed as the solution to small account problems, but they are not designed to make you succeed. Without a proven system and emotional control, you will fail over and over again. This is about knowing the business model you're stepping into so you can play it smart. If you don't have positive expectancy, you're not ready. Prop firms challenges expose flaws quickly: poor entries, overtrading, lack of edge. You must already be consistent in a personal account or demo environment. Prop firms are for execution, not experimentation. You're not trading 100K, you're trading with 10K risk. Okay, let me say that again. If you have a 100K account, you are trading with 10K risk. If the drawdown limit is 10K, that's your real account. If your profit target is also 10K, you're being asked to grow your account by 100%, not 10%. Come on, pay attention. This is important. Pay attention. You are not trading with a 100K account. You're trading with 10K risk. So all these influencers on social media saying, I have $1 million account size, I'm operating with. No, simply no, they're not. They are not. Okay? No. $2 million in simulated funds. Okay. No, that's not true. It's just not true. If you have a 100K account and you can only lose 10K of that account, then your actual account is 10K. Okay, I know it's a hard pill to swallow, and there's gonna be so many different arguments about this in the comment section, but they're wrong. I'm telling you, they're wrong. That's a completely different level of difficulty than most traders realize, especially because they're trying to do this in a month. They're trying to grow their account by 100% in a month. Come on, guys. Like, come on. Prop firms make money off traders who buy challenges repeatedly. They often B-book your trades, meaning they don't actually place them on the real market. The true edge is in marketing, not your success. This doesn't mean that they're scams, but you need to understand their incentive is your failure, so your objectives are not completely aligned. Okay? And I know of very good prop firms that are completely not scams. They're legitimately, people are getting payouts from them. Okay? But that doesn't mean that the prop firm is your best friend and that they want to actually supply you with capital because they want to see you to be a good trader, succeed and grow their capital and the narrative, right? Okay, so how to choose the right prop firm. Look for the firms that publicly say they A-book profitable traders. This means if true, they send winning trades to the real market. Avoid prop firms with hidden rules, poor support, no transparency or leadership. Like if you don't see anybody getting payouts, avoid. Research, review terms and real user results. Depending on when you even watch this, there's probably been more prop firms that have blown up. So many of them have blown up. There's that one prop firm where the owner got called out because when the investigators went to investigate his business, he said slip them to hell, guys. I don't remember the name of the firm. It doesn't even matter because they're not in existence anymore. He said slip them to hell. Does this sound like someone that you want to do business with, that you want to work with, that actually cares about you? All right, come on. So my recommendation: prove your edge before touching a prop firm challenge. Okay, I'm not telling you to avoid them completely, because if you have an edge, why wouldn't you? Forward test your strategy under pressure. Only take a challenge once you're already hitting your metrics consistently. Treat it like a funding interview, not a get rich opportunity. If you pass, don't change. Keep executing the exact same system every time. Prop firms are a tool, not magic doors to success. You need an edge, data, and emotional control before applying. You're trading a capped risk amount, not the full advertised size. Their business model is built around your failure. So choose firms wisely and trade with discipline. And if you have an edge, then go for it, because the most that you could ever lose is your capital that you put forward, and the upside is way higher. It's always if you have an edge, it's just gonna be worth it for you, because you're gonna have a larger account size, and how you grow the account, it'll benefit you. But once again, this is if you have an edge, a repeatable system, and you know that you can make money in the markets which most traders cannot do. They simply cannot do. And that's why these prop firms are getting rich, making millions of dollars off of people's hopes and dreams of actually getting started with more capital than they have. It's just, come on. All right, that's all I have for this one. I'll see you in the next one. All right, so this last module is called Putting It All Together. So this is current price action right now, right today. The Nasdaq just closed with an enormous bullish engulfing candle. I mean, my God, what strength. This is the candle that it just closed with right here. Like, wow. Okay, so I'm getting a reading of bullishness on my indicator. Like, everything's green. It's currently 4 o'clock, so the market is frozen. It's closed right now. This is the 1 hour time frame, and the interesting thing is that I actually did take buys right here, but I thought I had to go do something, so I closed the trade because I didn't feel like I was going to be able to monitor it. So anyways, then once I finally came back, I placed a limit order here, but price never came back. So right now my indicator is telling me to take buys, which I don't think I would buy right there. I would probably wait for a pullback for something like this, so that if price happens to reject here and it starts trending down, I can enter with a limit order here, or maybe it does a little bit of this type of stuff, then pops back up, hopefully does a retest and then goes back up here. But I would most likely wait for a pullback because it's kind of just consolidating at resistance right now. So why would I be buying? Well, because the market's in an uptrend right now. It's really strong. Like it's just tremendously it's strong right now. And I want to be in those buys. I want to be riding that up wave. I want to be riding that trend. So ideally I would wait for a pullback, but I have two ways of entering the market with discipline, but also with fluidity, because you need to be able to be flexible, because there's nothing wrong with waiting for the market to come back to your entry if you would like to take a buys at a certain limit order, not at a certain psychological order price. There's nothing wrong with that. But in the circumstances of today, I woke up and the price was like right here. And in fact, let me go to the 5-minute time frame and show you exactly what I saw. So I saw this demand zone right here, and this is also from my order block. This is from my indicator. The Confluence indicator makes these order blocks. I saw this demand zone here, and I'm like, probably be interesting to take some buys off this level. We're in the uptrend, so the moving averages support the price action. We broke structure here, so this was a swing high that got taken out, and then we also made another swing high right here because we pulled back, which formed this demand zone right here. So let me delete these. So as you can see, we bounced one time, two, strong reaction out that zone, came back again, retest again, and then that was the bottom. So I was buying at the bottom, didn't even realize the bottom. But you gotta make sure that you can be at the computer when you're taking certain trades, guys. So let's break this down even further. So there was supply right here that the market was running into and finding resistance, rejection, resistance, rejection, resistance. Finally broke through it, but there's still supply here. Broke it, retested, engulfing candle on the 5-minute at 8:15, and then the market opened up, and then that was all she wrote. So that shows you that there's accumulation happening on this asset. Like if you were to draw the speed of accumulation here, we started to go pretty much parabolic. If you were trying to connect all those lows, like we went straight parabolic right there. And being able to understand the price action and being able to be fluid with the price action and knowing where to get in and why to get in and where to put your stop, we can even talk about that more. So I believe my entry was going to be like somewhere inside exactly in this zone, and I believe I was actually trying to have a smaller stop loss of something like, it wasn't that small because you need to have it adjusted for volatility, but it was probably something like this. And I was actually targeting these highs up here because I saw that we kept bouncing off this level. So there's nothing wrong with entering at a valid location, but I always want you to be thinking of the next trade. What happens if I lose this trade? Where am I going to try again at? So for me, if I entered here and it just tanked out, I was either contemplating buying again in this demand zone or here. But I have the flexibility and ability to try 3 times in one day if I wanted to. If you do not plan for 3 trades in a day, and you just go and blow your back out with that first position, you go high leverage, you go, I'm just going to risk my whole account on this one position, try to grow it real quickly, you're going to blow up. If you've learned nothing else from this course, is to think in probabilities. And for you to think in probabilities means you always have to think of the next trade, and you'll never risk your entire account on a trade because you're always going to be thinking of the next trade, always. So as you can see, this just kind of ripped, and this is just gone. It was just gorgeous, just ripping. So this would be a valid play right here if you was trying to look for a nice one-to-one. This is the demand zone right here. And if you are someone who like, I don't really want to be on the 5-minute time frame, no worries. 15-minute is just as valid, And you can see that this is a base rally demand zone that formed right here, that broke that high. And you can see that we came back and retested it with an inside bar on a 15-minute, went straight up, shooting star, bearish engulfing candle, but came down, made another inside bar to indicate that buyers are still here, and it held on a 15-minute, and then they ripped. Rally, base rally yet again. Doji, indecision, boom, boom, just gone. And then look at the momentum shift over here. Look how that expected value changed. I'm telling you, we're going to put it all together. We're putting it all together right here. I think that looks right. So you can see the rounding price action right here. You can see that formation happening there. Like this, to me, I would have been licking my chops to at least try something right here, to do something right here, because there's so much exhaustion, there's so much momentum shifting. Like, yeah, like for sure, this is what you want to see if you want to go long, because this is bears indicating that there's weakness at resistance. Imagine showing weakness at resistance. Ew, what's that? So I would have put out this as support that we're forming here, limit order right here, sized in once that expected value changes somewhere. Let's do something like that, because you are at resistance, so you want to keep your scalps pretty reasonable and not be trying to go for a 2-to-1 when you're scalping. Really do not suggest that. Scalping is about high win rate, so you're thinking about the next few bars anyways. So weakness, enter here, size in when we break the bar, when we start to break this bar high. So you possibly even would have gotten in right here once we start to break those highs, but then we got pushed back down again. So then you would have been panicking a little bit, because that absolutely happened. Like, we started to break those highs, but then we came back down. So that's the risky part about buying when you're breaking highs, even though you're on the right side of the market, because the market is making new highs. That can happen. Anyways, it did the exact same thing here. It's just that this time it closed at the high. It did the same thing. It broke above these highs of this candle. This candle broke above the highs of this candle. So boom, broke above the highs. This candle broke above the highs, made a lower low than this candle. We're starting to see weakness, new highs again, new highs. So it's very strong. It was very strong the entire day. And that's why we got this candle close right here. I do highly recommend having at least 2 time frames on your chart. See how we just went in on the 5 and 15 minute, and then on a 1 hour is just barely anything here. Like it's not even significant of anything that's happening. My indicator is still loading right now because it has a longer look back period to give you really accurate and high quality results. Let's see what else. So price ended up dropping into this demand zone. So this is what I mean by Confluence. Like, this key level would have been on my radar, this level right here, because there's a demand zone right here. There's a key QP right here, quarter level 22,750, and we double bottomed at it. And this is in the context of a longer uptrend. So on this day, which was Thursday, Thursday and Friday, the market had just an insane sell-off, just absolute heinous capitulation down here. And if you would have been trying to buy the dip on each one of these candlesticks, you would have got clapped. You got smoked 100% every time. So like context matters a lot. Like you don't want to be the only one buying when the market is weak and selling off, and you don't want to be the only one selling when the market is strong. So the context really matters here. It matters a great deal. The moving averages on a 1 hour time frame were lagging because it's the 1 hour time frame. But if you go to the 5 minute time frame, those flipped a long time ago. Those flipped on at Monday at 2 a.m. and now you would have been on the right side of the market intraday to catch that wave up. So it's like multi-time frame analysis is extremely important, and the ability to be going through each time frame trying to figure out what's happening matters a lot. Let's look at the 4 hour time frame now. Let me get rid of this. On the 4 hour, look at that. Look at that demand zone. Look at this candle on the 4 hour. Amazing strength. So you got multiple consolidation of support over here with multiple demand over here. This is a morning star pattern right here. So let's say that you're an extremely busy person, but you saw this candle forming at 4 p.m. You could enter there. Your stop loss is somewhere below this demand zone. And the toughest part about the higher time frame trading is that your stop loss is going to be so big, and you would have just hit a 1-to-1 today when the market open. You would have just hit a 1-to-1. Now you could have just placed it below the prior bar lows just slightly there, but there is also the chance that the market can come back and retest this demand zone, and you would have possibly gotten stopped out at the risk of just trying to have more reward on a trade. And then your 1-to-1 is like down here somewhere, which is a lot better. And then this ended up running for a 2.5 R. But being able to, let's say if you're a swing trader and you want to possibly get in at this location with a tighter stop loss, well, number one, you're gonna have to set an alert, and you're gonna have to be on standby, being ready to enter this trade. Number two, I would recommend, if you're trying to trade a higher time frame like the 4 hour, you don't necessarily need to go to the 5 minute. I would recommend something like the 15 minute or the 30 minute time frame. It's like just enough detail to give you a good story, a good narrative, a good idea of what's happening at a certain key level. So if you had this key level mapped out, you're like, yeah, I like this area right here. I'm going to look for strength here. What I do is I try to buy as close to this zone. I highlight it with a rectangle tool, and you'll be able to see this on a daily chart. So let's say I saw this key level here on a daily, because we had a massive consolidation here. So I know everyone's gonna be trying to buy here, which everyone was trying to buy here. We say, okay, I want to wait for price to get here, and then I'm going to wait for confirmation that buyers are in the market and taking control. This would have been your candle right here, but keep in mind that you need to, one, set an alert, and two, you need to always be at you need to be ready to come to the charts. And if you work a job, that's gonna be really hard to do, because you have to analyze what's happening here. The moment in which the trend actually changed was basically right lower low, right about here actually, because we started to stop making lows right here. We were trending down, and then we formed this low pattern right here at 5:30. So this could have been your entry candle. Now this could have been your entry candle as well. It's the exact same price, and instead of your stop loss being like 150 pips, which is honestly not a big deal on NASDAQ because it's moved hundreds of pips, you could have had, I'd say, a stop somewhere safely below this low, and this trade would have been up 3R if you would have held that whole time. I don't know if you had the psychology to hold that long, but at minimum you could have caught a 2-to-1 if you wanted to. I wouldn't have held until just right here, because if this is a higher time frame move and you're looking for some type of retracement on a higher time frame, so let's say from swing low to swing high, pulling out the fib, you were looking for a retracement of at least half, at least 50%. Oops. You're looking at, if you would have held for that 50% retracement, you would have called a 3.96 R trade, which is excellent. That's a phenomenal trade, quite honestly, really good. And the thing about it is, the lower time frames are there for you to reduce your risk based off of the formation of candlestick patterns that are happening there. But you don't want to suffocate the trade because you're trying to max extract one single trade, giving up the probability of winning the trade just because you want it to have a super tight stop loss. The stop loss is there to invalidate your trade, but you don't want to invalidate your trade in the exact place that the market is probably going to reject and show strength. You're just going to get stopped out for no reason. So having a stop loss like this so you can try to catch a 6R trade is absolutely ridiculous, and don't do it. Having this is much more better, and I've taken trades like this with the stop losses. I would even call this a tight stop loss, because I like to usually have my stop loss a lot wider, because I'm okay with having reduced reward. I just want to make sure that I'm in the trade. But there's nothing wrong with having a trade like this with a stop loss like this. So let's look at this now on a 30-minute time frame. Very excellent candlesticks happening here, and the 15-minute definitely gave you the best entry, with the 30-minute giving the second best. Now if you would have got in on this bar, and see the 1 hour, the 1 hour is showing a little bit of weakness at the top of these bars here, but I still think that this is a really excellent candle. I think this is an excellent bar here. It's very similar to the 30-minute. Now, when you go above the 1 hour, you're going to start getting candle closes a lot higher. The 2 hours still actually gave you a pretty good candle close. Quite honestly, that's pretty good. But it gives you collapse storyline about what was happening in this direction with a doji right here. So this might not have been the best entry signal here. But yeah, this was definitely an evening star reversal pattern off on a key support level, at a key psychological level, with probably divergence happening on the oscillators right now. So the momentum is shifting. So we didn't really talk about that too much, because I don't like talked about oscillators too much, but because I feel like this becomes the main thing that people depend on, and I really want you to focus on the price action. I really want you to focus on the price action. So the 2 hour actually wasn't bad. I'm surprised. Now look at the 4 hour. We already talked about the 4 hours. So, you know, as you can see, the higher the time frame that you move up, the lower your reward gets, and the wider and further away your stop loss has to be, just so you can catch that move. So yeah, I feel like this is a pretty good way of trying to put it all together for you. You just want to be making sure that you're kind of like having multiple things in your favor if you was trying to take this trade. So we have the supply and demand zone. We have the key psychological level that had, let's see, based on a 4 hour, it looks like it had 19 reversals. So that's pretty good. And so the 4 hour moving averages supported it. Key psychological level. There's divergence on the oscillators as well on the 4 hour. And there's bullish candlestick patterns printing here. And it's probably a harmonic pattern. Let's see if I can find a harmonic pattern. Maybe. Let's see if you go here. Kind of like a wonky M shape. I wouldn't really think about it too much. Yeah, it retraced 50% already. So that's pretty impressive, quite honestly. I would assume that it's probably going to pull back tomorrow. So hopefully this has been a helpful module for putting everything together. I know that's just one trade example, but It's really just going to be contextually dependent upon what you're trading and how you're trading it. I can't go over every single market because I don't trade every single market. If you would like access to these indicators, once again, it'll be in the description box below. I will see you all in the next one. Thank you for completing this course. I sincerely hope this has brought you immense value and has leveled you up. The journey ahead will be difficult, but if you have the grit to endure the pain, you will succeed. You will succeed. Remember, it's not about massive wins, it's about consistency. Consistency creates the luck. Consistency creates the luck. Consistency creates the luck. I want you to tell yourself that every single day. To stay in touch with me, join the Discord. It's free in the description box below. Follow me on Twitter at xtradersage. I accept those donations via crypto wallet in the description box below, because let me tell you, it was a freaking pain in the ass to make this course, but I did it for you guys. I do it because I love y'all. I do it because I want y'all to succeed. I would do it because I want y'all to stop getting taken advantage of by these people who don't give a freaking crap about you. And my philosophy on life is, I'm a spiritual dude, and I believe that we're all connected, and I believe that we all come from the same source. We're just fractal natures of the same infinite creator, the same source. So by helping you, I help the whole, and by helping the whole, I help myself. And that's the key hidden gem right there. If you made it this far and you listen to this, listen, this is some real esoteric key stuff right here. Listen up. By serving other people, you inevitably serve yourself. By putting good energy and good love and vibrations out there, you inevitably will receive those energies back to you. They will come back to you. It might not look the way that you think you want it to look, but it will come back to you. By serving the whole serves you. All right? One love. If you want access to those indicators, they'll be in the description box below. Follow me on Twitter. Hit me up on Instagram, YouTube, all the jams, all the spaces, all the things. I love y'all. Trader Sage out.